A lack of an expected rebound in sales in India. That didn't come to pass, and so we'll watch to see how that one performs, Guy.
Okay, so banks and Burberry, bit of Ericsson, plenty of single stocks to watch out for. European equity markets are about to open for the Friday session. Let's take a look at the opening trade and figure out exactly what we are looking at. A bit of catch-up, as Crudy says, a few single stocks to work our way through, as Anna's been indicating. FTSE 100 fairly flat at the get-go. Are we going to see more upside? The expectation is the CAC's going to outperform this morning. Where is that outperformance going to come from? Is it the luxury sector continuing to climb? The stock 600 is up by 0.2%. The Spanish market is up by 0.4%. We'll see what the DAX does. We'll see what the SMI does. They probably take a little while to get going. The CAC 40 could be an interesting trade. Are we going to see a read across from Burberry into the rest of the market, to those China comments which they've been making, which sound a little bit more positive than anticipated, read across into the rest of the sector as well? Or are there other areas? Airbus could be maybe a bit of a drag in terms of the French market this morning. So plenty to talk about. There's a kind of macro top-down Trump story. There's a bottom-up single stock story as we work our way through earnings, both colliding when it comes to the market open. And we're up by, on the 600, 0.3%. What's going on below the surface, Crudy?
Well, the one index we haven't mentioned yet is the FTSE MIB, and that is higher by a whopping 0.6%. And a lot of those gains already are driven by the banking story. We're going to get into the nitty-gritty of that in just a moment as we start to see some of that volume shake out. But Anna, just from the broad stock 600 perspective, luxury seems to be in the driving seat this morning. Perhaps that explains some of that French outperformance.
Yeah, absolutely. LVMH is there. You can see Richemont is higher. To your point, the French market, Hermes is higher. So Hermes and LVMH over in Paris are a little higher. I don't have an opening price on the CAC 40 or the DAX just yet, so we're just waiting for those to come through. But we are expecting then, or we are seeing beneath the hood, some positivity around the luxury sector, and all of this no doubt linked to Burberry, as we're waiting for the Burberry share price to open up as well. So we've got a lot of things that we're waiting for this morning, essentially. Ericsson still not open, Burberry not open, BNPS not open, so Monte Paschi is not open, but we do have Mediobanca up by 3%, so that's the M&A story out of Italy coming through a little bit.
And we should mention Monte dei Paschi is now seeing a volatility halt around the opening auction, so we are waiting for the prices around that as well. But remember, one of the biggest pieces of that kind of Mediobanca deal is their stake in Generali as well. So you're looking at some of the movers within the FTSE MIB. Generali is higher by about 0.7%, one of your biggest index contributors to that story as well, as is UniCredit, because remember, this is as you can see on your board, the four companies, kind of, I'll go from bottom to top, that are all basically invested in each other. UniCredit has a bid for Banco BPM. Banco BPM has a 5% stake in Monte Paschi. Now Monte Paschi talking about this Mediobanca takeover. All of them, as we wait for that the Monte Paschi opening, kind of in positive territory this morning, Guy.
Absolutely. There's a bunch of stocks we're watching on the 250 that are still yet to get going here in the UK. We're going to watch very carefully what happens with Burberry, still not open, as Anna's indicated. Actually, the share price was reasonably positive going into the numbers, which I think is interesting as well, in terms of the momentum maybe coming in to this story. But it does seem to be a read across, which is interesting. It's interesting that Burberry's having this positive effect. The China comments seem to be being taken quite well. That's obviously been the Achilles heel of the luxury sector. We'll talk to Andrea Felstead a little bit later on about how important the US has become. China's definitely taken a sort of a back seat, but maybe that narrative returns, maybe a more positive picture.
Whilst we're talking about banks, we were just talking about the Italian banks, worth just lingering on another line that crosses the Bloomberg terminal this morning. Commerzbank would review a proposal from UniCredit if it comes. Not entirely clear where that line is coming from at this point, but that is interesting to throw into the mix as we watch the attempted creation of a third big bank in the Italian market, there are other players with other intentions, and UniCredit is one of those.
Yeah, certainly something we're keeping an eye on. Commerzbank shares higher by about 0.8% in today's trade. Let's talk about that kind of banking consolidation story, that deregulation story on both sides of the Atlantic and how it feeds into these markets. Joining us now this morning, Maria Waitlist, head of equity research over at State Street Global Markets, joins this program. Maria, a pleasure to have you on as always. I think the big picture topic for at least this week has been, what does Donald Trump mean for these global markets, especially as he's drive equity indexes on both sides of the Atlantic to these extreme highs? How much of this is really due to those deregulation ambitions that he has?
Yeah, good morning. I think that's probably the most difficult question to answer, what Donald Trump means for markets, because so far he has announced lots of kind of executive orders, but like the most important question on tariffs hasn't been answered yet. So it's every day we watch the Bloomberg or other news outlets, and there are lots of kind of conflicting information. I'm putting tariffs on, I'm not putting, I'm being friendly with China, I'm doing this with Canada. So there is still very little clarity, and I think market is taking it a little bit positive because expectations were for very aggressive tariffs on day one. So there is a little bit of kind of relief rally based on that. In terms of deregulation, it's something that we need to see before we really believe it, because I mean, again, expectations are high, so it's about delivering as opposed to kind of talking.
So in terms of that delivering story, though, I think that brings us right back to this banking consolidation question here in Europe as well. We're seeing this massive surge this morning in some of these Italian banks, certainly in the French ones. Now we're getting headlines out of Commerzbank as well. But this is a question, as Guinan reminded me, that has been going on for years, if not decades. Do you trade the hopes of banking consolidation in Europe?
Yeah, and I think that's a really important question, because we know the consolidation needs to happen, and I think institutional investors already traded on those hopes, because I mean, banking stocks perform quite well. I mean, they have lots of cash, they're strong. But what we see is in State Street custodial holdings, institutional investors already bought a lot of banking stocks. Banks are the most crowded sector in Europe, so institutional investors kind of positioned for it. And now again, the question of delivery, and I worry there could be quite a lot of setbacks. So far we've seen kind of politics getting kind of interfering, particularly in Italy. But yeah, banks are healthy, banks have money. Can they grow? Big question marks. Investors are very much positioned for the yes answer.
Okay, so what else is that data telling you? What has it changed post-Trump? Since the election, since the inauguration, what is that custodial data telling you about how investors are positioned? Has it changed significantly as a result of his arrival?
Yeah, that's really interesting, because if we think back to kind of end of last year, when everybody were writing the kind of year ahead outlooks, everybody were extremely positive on markets, on equities. I mean, tech, favorite sector, U.S. exceptionalism. Then we had a little bit of a setback, and now we're kind of returning back to all-time highs. Institutional investors have not panicked. They stayed with trades they had. The U.S. still the kind of the preferred place to be. Tech is a kind of crowded place, but investors not selling out of it. Big positions in European banks, but not very much else. So it's still very concentrated in mega caps and quality and growth. That's the kind of the trades we had at the end of last year, and investors sticking with it. Maybe like activity is a little bit slower because of this kind of wait and see. We need to see what will happen. But people are not unwinding positions. People are not finding. We're watching very carefully shorting interest from security lending data. Again, no big shorts position. People are really just waiting.
Okay, so because we probably don't know yet, it's too early in this process to really get a view of what is happening here. But are they adding to these positions?
Gradually, not in a big volume, but I mean, we're not. The point I'm trying to make is that nobody changing anything, and yes, tech is still the most bought sectors since the beginning of the year. So people adding to that position, people buying quality. Quality kind of makes sense even in a world where you expect like more shallow hiking cycle. And if you think what's quality, it's our Max 7 stocks. So that kind of position getting bid up a little bit more again.
Can I ask you about luxury names, Maria? And this takes us on to a China conversation, doesn't it? Because really interesting the way that the Burberry numbers are being received this morning. So that stock up as much as 15% out of the gates, now around 11% higher this morning on my screen. But this is having a read across into the rest of the luxury sector. Kering is higher, Swatch, Moncler, LVMH, all these names trading a little bit higher, as if this is, yes, sure, there's some specifics perhaps around the turnaround of this business, but it is being adopted by the markets as a positive luxury, and that probably means positive China story. How would you play into that?
I mean, we know that institutional investors have been underweight European luxury stocks very, very significantly. So there is like people exited the sector last year, and I think a little bit like position squaring is there, and kind of maybe closing your shorts. So that's perhaps important. I have to say I'm still a bit skeptical about kind of major China turnaround, because what we know the problem with China was that very, very depressed consumer sentiment, and we haven't seen kind of a big recovery, and the kind of the policies that Chinese authorities have implemented was kind of trying to stimulate the demand. Haven't seen kind of major improvement there. So I think it's probably more of position squaring than really kind of, okay, now we're a little bit more positive on China.
On China, though, Maria, is there a cyclical story that can get you excited about China, or is there just too much of a structural headwind given the geopolitics?
I mean, we are generally concerned about China kind of overall consumer indebtedness, lack of like consumer confidence. So that's a big issue. And as I said, the policies that have been implemented, they're really not that. I mean, it will take a long while for them to kind of inspire kind of domestic activity there. But geopolitics is probably the biggest kind of medium-term hurdle to get through, because I mean, tariffs almost kind of binary. Is that will they do it? Won't they do it? And what would be response? So I think until we get clarity there, it would be very difficult for investors to start closing that underweight position.
Maria, great to catch up. Always a pleasure. Thank you very much indeed. Maria Waitlist, Head of Equity Research at State Street Global Markets. Call 6 looks like this morning. As Anna's been indicating, luxury stocks certainly on the front foot. You can see that represented very well by LVMH, up quite nicely. But LVMH isn't at the core of the story. Joe Easton's here.
So it is another big day for the luxury stocks, kind of reminiscent of what we saw around a week ago when we got those numbers out of Richemont. We're seeing the whole sector rising at the moment. Burberry up 13.5% now. Big move on that one. Kering as well. A massive read across, up 8%. And some of the other stocks, as Guy mentioned there, LVMH, Moncler gaining as well. It does look like the more beaten down stocks in the sector. So the Kering's rising with Burberry, the ones that have suffered the most, coming back up, a real boost for the company. The sales not as bad as expected, still actually declining by around 4% in the latest period, but actually much better than analysts were expecting according to the numbers on that. So that's the relief we're seeing, finally, a bit more relief coming through into luxury today. Then one sector going the other way, this is telecoms, telecom infrastructure. Ericsson slammed, it was down almost 10% at the open, now down 7.5%. Now India, still the weak spot in terms of their infrastructure, and analysts in the notes I was reading saying that the Vonage business that they bought from the US in 2022 not paying off enough quick enough, and that is actually also part of the weakness. They haven't seen the results coming through from that new units. That is hitting the stock as well. We're seeing Nokia coming down. Nokia reports next week. We'll get numbers from them, so that is also an interesting read across on that one. Then the Italian banks, we can't get enough Italian banking M&A news. We are seeing Mediobanca coming up almost 3% at the moment, but take a look at Monte dei Paschi, down 9%. That is the acquiring company, so it would be around 13 billion. I think I read the figure that it would be paying out, but it is all in shares, so it's an all-share deal. So dilution looks to be the takeaway from that one. Massive dilution for investors in Monte dei Paschi, and therefore that one really slammed. But we're seeing positivity in the other banking stocks that we have seen doing a bit of M&A, reported speculation on M&A, including BPM, UniCredit, those ones a little bit higher at the moment. Then one that we hadn't touched on was Rolls-Royce getting a big submarine contract in the UK. So we tend to think of them more doing the aerospace engines for the jets, but they also have a submarine unit as well. And they've got a big contract from the UK government announced last night, or reported last night. So therefore, extending the gains, a stock that's doubled over the past couple of years. Rolls-Royce edging very slightly higher in London this morning.
Joe, thank you. Joe Easton from our equities team. Talking about the Italian banking sector and much besides, we will focus once again on Italian banks, though, coming up. Yet another Italian banking takeover attempt then. Monte dei Paschi offers to buy Mediobanca in an all-share deal. Joe's been through the market response in the short term. We'll get the long-term view. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome back. You're getting French economic data. Let's talk about the breaking news that we've got coming through. In some ways slightly better than expected, but in some ways actually telling a familiar picture for France. So manufacturing PMI 45.3, that's up from 41.9 and better than the survey number. However, the services number drops to 48.9, which is worse than the last number we had at 49 and worse than the survey number. That takes the comp number to 48.3. This is the fifth month in a row that France has got a sub-50 comp number. That is not painting a particularly good picture for Europe's second largest economy.
Yes, absolutely. Lots of those numbers then below 50 in contraction territory when it comes to the French economic story. We are also keeping an eye on what's going on with oil prices, given what we heard from President Trump overnight. Oil is heading for its first weekly decline of 2025 after President Trump said he would ask OPEC to lower prices. Let's get more from Bloomberg's energy reporter Anthony DePaola, who can shed some light on all of the themes at play here. So President Trump asking OPEC and the Saudis specifically, name-checking them, for more oil. He's done this before. Is there anything different about this request this time around?
Yeah, hi, Anna. Yeah, oil is kind of topsy-turvy this week as we saw oil increasing at the start of this month based on that prospect of some restrictions on Russian oil, so taking oil off the market. Now, as soon as this week, Trump is coming in talking about drill, baby, drill in the United States, and also asking the Saudis to bring more oil on the market. There is that concern there. He's done this before in his first term. This time, he's giving a little bit of a carrot as well this time. He's asking the Saudis to increase oil production to bring the cost of the oil down, implying that will reduce inflation, and then saying he'll be able to reduce interest rates. So, of course, interest rates would be beneficial for people that are borrowing, like the Saudis. We're seeing a lot of debt on the market as the Saudis try to finance a lot of infrastructure build out and really a transformation of the economy to prepare to get away from oil. So there is that kind of side of, if you give me some more oil, that will bring costs down. We'll be able to reduce interest rates, and that will help everyone. So that's that kind of carrot part. A little bit of a stick part is he's saying that those high oil prices have been helping Russia in the war against Ukraine, and that OPEC Plus and the Saudis are in part responsible for that. Of course, let's remember Russia is a member of OPEC Plus, and they would be impacted by that. So that does put OPEC Plus and the Saudis kind of in a difficult pickle there, Anna.
So, Anthony, speak to us a little bit about the other things OPEC Plus has to take into account. Talk to us about break-even prices, for example, when we're looking at Brent crude at about a 78 handle.
Yeah, the break-even prices, particularly for Saudi, are going to be higher than where we are now. As I mentioned, they've got a lot of infrastructure and big economic transformation projects to finance, so that's requiring a lot more capital. Other things that they are going to have to take into consideration is, again, Trump's policy towards those countries that might be subject to sanctions. Russia already is, Iran already is. Would those be tightened, and would that take more oil off the market? So if OPEC is going to be bringing more oil onto the market, they're going to want to be sure that they'll be able to have a market for that, and that it won't end up in storage, because that's something that weighs down on price as well, too. So if the point is to bring more oil onto the market, reduce prices, drive Russia to the table, well, if there's a negotiation, that possibly leads to some lifting of sanctions and then more Russian oil coming to the market. We're talking hypotheticals here, but these are the things that the Saudis and the wider OPEC Plus group are going to have to be walking through when they're considering that decision.
Anthony, does the market believe Trump? It's fascinating to watch, actually, the price reaction. You did see a drop, and in some ways that drop has stuck when it comes to the Brent price.
Yeah, we are seeing people that are taking some of the hedging some of the longer bets for lower prices. So there is some protection there in terms of the market towards potentially lower prices. The market is also kind of scratching its head about the whole drill, baby, drill context, asking whether the U.S., which is already producing near record levels, whether there's more space to bring more oil on there, whether the independent producers in the United States will bite on that at these prices. And again, that question mark around Russian, around Iranian production, whether that's going to be coming back into the market or being restricted, that's a real question mark overhanging. So I think we'll probably see this oil bouncing around. Traders are telling us they expect more volatility this year than we saw last year when we were in a very tight range.
It's interesting. Also, investors in U.S. oil have wanted money back, not oil back. Discipline's been the main watchword over the last few years. Bloomberg Energy reporter Anthony DePaola, thank you very much indeed. Let's go from barrels of oil to banking.
Let's do it. We're getting headlines here across the Bloomberg terminal that Monte Paschi shares are down as much as 10% in trading in Milan. This comes after Mediobanca says that the Monte Paschi's all-stock offer bid is being viewed as hostile. So you can really see in the kind of sea of Italian banks that we're keeping an eye on, real underperformance coming from Monte Paschi. Those shares down about 9% and falling. Let's bring in our managing editor for Southern Europe, Tommaso Ebhardt, joins the program. Tommaso, is this a surprise?
So the bid is a surprise, not too much to our readers as we scooped about it overnight, but generally speaking, yes, it is a surprise because Monte dei Paschi is coming for a very tough period. It was nationalized in 2017, and this is a sort of renaissance for the oldest bank in the world, bidding from the Mediobanca, who is seen as the investment banking jewel of Italy. Yes, Mediobanca sees the bid as hostile, as we already reported in our original story. This was not agreed with Mediobanca, but the biggest Mediobanca investors are also the biggest Monte dei Paschi investor. We are talking about 2 billionaire families. The Del Vecchio family, the Ray-Ban owner, they own almost 20% of Mediobanca and 10% of Paschi. Then you have the Roman tycoon Caltagirone. So this is a bid by a smaller bank to buy a bigger one in Italy. Quite surprisingly, no one could have expected it a few months ago, but things are rapidly changing in the Italian banking industry.
So things are rapidly changing, Tommaso. You've been through some of the investors they have in common. Who are the other actors we need to keep an eye on? Because clearly consolidation has been a wider theme, not just between Monte dei Paschi and Mediobanca.
But first of all, we have to look at the government reaction. We suspect the government will be quite supportive of such a deal because the Italian government has tried for years to create a third banking group to rival with Intesa Sanpaolo and UniCredit, to have a third banking pole. They've tried to do it with Monte dei Paschi, then Orcel arrived and made a bid for Banco BPM, which had just bought a stake in Paschi itself. So Paschi is clearly central to the government plan to create the third banking group, and the Italian government is still the biggest investor in Paschi with almost a 12% stake. So let's keep an eye on what Rome says.
What do you think Andrea Orcel makes of all of this? Is he in any way involved? Is there a ripple effect that happens out of this deal into the other deals?
I mean, in Italy, in the Italy banking industry, they say that Andrea is looking at everything. But as we know, a couple of years ago, Andrea Orcel was trying to buy Paschi from the Italian government, and talks collapsed at the very last minute. Then he decided to go after Banco BPM, which is bigger than Paschi and based in the wealthy Milan region. Now the Italian government is reviewing that bid with its special powers, and the Italian government will keep a close eye on Monte dei Paschi. So at the moment, clearly, Orcel is not involved directly in this deal, but he's the person who somehow generated a ripple an effect in the country by making a move on Banco BPM.
Okay. And we are seeing those ripples in the markets this morning. Bloomberg Managing Editor for Southern Europe, Tommaso Ebhardt, thank you very much. So Monte dei Paschi is down 7.8%, so moderating, paring those losses just a little bit. Mediobanca as the target, up by just over 3%. Interestingly, UniCredit is gaining this morning, up by 1.6%. Let us tell you what is coming up on the programme. We'll talk more about the BOJ, but actually we'll have a wider conversation about FX, because there were a lot of wider FX themes in play this morning. We've seen the BOJ's move already, their rate hike. We've got data out from the euro area in the shape of the French PMI. We're going to get the German PMI coming shortly. We'll break down all those numbers, what they mean for FX markets. Where does the strong dollar trend go from here? Yusuke Mieri is going to be joining us. That conversation next. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf, through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Bloomberg Invest is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
We are seeing German PMIs cross the Bloomberg terminal as we speak. The manufacturing PMI rising to about 44.1. The estimate was 42.7. Services PMI rising to 52.5. The forecast there was 51. So contraction continuing in the manufacturing PMI in Europe's largest economy. Off the back of that, though, when you look at the euro picture, Anna, you're actually not seeing much movement. 104 still on that handle.
We do have a stronger euro. We have a stronger euro this morning, and it has continued to strengthen with this data that has dropped. And I wonder if it's the, this number of manufacturing. Yes, it's still firmly in contraction territory, but it is quite a bit above the estimate. Whether this suggests something a little more positive, or if this is entirely maybe a dollar story, because we see a fairly sizable dollar move overall. Of course, the yen in focus because of what we heard from the BOJ and that dollar move. So maybe none of this is to do with the Europe data or the BOJ, and it's all just the dollar trade.
Almost certainly that's a huge factor. But broadly, the PMIs are slightly better. And they're not. They are still, to your point, contractionary. I think the comp number in Germany is just now positive, but
barely.
We're barely positive. Basically, we're kind of stagnating. But at least we're seeing maybe signs of improvement. The French number, that's 5 months in a row we've seen contraction coming through. But maybe just at the margin, things are starting to improve.
So not as bad as expected. It's equal to good.
Right, well, no, exactly. Yeah, precisely. Is it getting worse? Is Europe rolling over, or is it stabilizing?
Yeah.
Because then you've got the factor of inflation to fold into this as well, which still looks fairly sticky, which is interesting also, that comes out of this.
Absolutely. Let's get an update on both of those dimensions then. We're joined now by Bloomberg's Jana Randow for more on the European growth and inflation story, what this means for the ECB. Jana, your thoughts then on this data, and we're seeing a little bit of positive euro reaction to it, as if the market is clutching at the straw that is a better than estimated manufacturing PMI number, even if still in contraction territory.
It's certainly a ray of hope, I would say, but I would say it's much too soon to talk about recovery or even a turnaround in what's been a really bad period for the German, but also for the Eurozone economy. It's a sign of stabilization. You're right to mention that. We're seeing that the manufacturing sector is contracting at a slightly softer pace, which is good news. But again, it's still contracting. And in Germany, on the services side, we're seeing a little pickup there at the start of the year, which is encouraging. But then looking at the composite number, it's just barely above 50, and that gels with what we heard from the Bundesbank actually earlier this week. where they said, yeah, the economy probably contracted at the end of last year, and stagnation is essentially the best that we can hope for the German economy in the first quarter as well. So we're far, far from that recovery that everybody is so desperate to see.
So, Jana, you mentioned the monetary policy side of that equation. We, of course, are coming up, I think we're about a month out from the German election as well. What kind of fiscal policies do we need to see to really see some more improvement in these numbers?
Yeah, I mean, of course, we need to see some spending there. Public spending has actually helped prevent an even worse outcome for the German economy last year. But what is more important actually than fiscal policy is private investments that are very sluggish and that really need to improve big time to help the economy when you think about it in a cyclical way, but also to fix all those structural issues that the German economy is facing when you think about energy transition, digitization. And there, the government's real job is to make that happen. You can talk about easing regulation, the regulatory burden. Coming up with some certainty, actually, for investments, because that is the main obstacle for companies. So there's a lot to tackle for the new government, and fiscal policy does play a role, but I would say there are many other things that need to be fixed as well.
Jana, can I just go to the inflation story? Because we wrote a nice piece overnight talking about sticky prices in Europe and how the ECB is going to be reacting. The PMI data always comes with a comment from Hamburg Bank, and they reference with when we talk about the German numbers about inflation. On the price front, this is a quote, on the price front, there is no relief in the service sector. Input prices increases have accelerated, likely due to higher CO2 tax that kicked in on January the 1st, affecting sectors like transport and hospitality. Does the ECB look through that? Is the ECB going to look through some of this inflation and focus on the growth story?
It's difficult to say. I mean, they have their eyes on services for sure, and they are actually expecting a certain repricing. Madame Lagarde was talking about certain latecomers. If you think insurance contracts, for example, they reprice once a year. Services is something that's eyed very closely. That needs to come down. It's in the Eurozone currently running at a clip of 4%, which obviously is much too high. So something needs to happen there. When you mentioned carbon prices, that of course was expected. That was priced in. That is not much of a surprise. But some of the other drivers of services prices, we need to see some improvement there, maybe it's January is too soon to pass judgment there, but March will be an opportunity to see whether that disinflation story that the ECB is currently still expecting is playing out.
The comment is that actually companies have got strength enough to pass through some of these prices to clients, so maybe that is something to be concerned about. Jana, thank you very much indeed. Jana Rando joining us out of Frankfurt. Yuski Miari, FX strategist in Mura, joining us around the table. A little bit of a move in the euro this morning on the back of maybe this data, but the bigger move appears to be being driven by the dollar. Is the dollar kind of at the center of everything for you right now?
At the moment, exactly, yes. I mean, Trump's policy, I think most of the clients that I talk to talks about only tariffs these days. So, I mean, tariff concerns have been moved the dollar stronger in Q4 last year, and now we're seeing the retracement of it because he's not too, aggressive about the tariffs these days. So that is, dollar move and the tariff concerns, those are driving the G10 FX markets.
In terms of what does drive the euro, is there an expectation that actually, unlike over in the United States, we don't see a pause, that the ECB is going to kick in with a significant number of rate cuts? Or is the inflation story enough maybe to cause the market to pause and rethink that strategy?
I think if there is no tariffs on the euro, from US to the euro, then I think we could see a continued retracement in the euro. It could go to like 1.06 and even higher. However, if you see the growth in the euro area and the ECB's policy reaction, still they are concerned about the local growth being stagnant. So if there's if there's like a 5% tariffs from US to the EU, and then ECB continues cutting, then I think the medium-term trend of the euro is still to the downside.
So everything comes off tariffs?
it comes off tariffs, but it's almost, I feel like we're having a little bit of a reversal of the dynamic we saw in 2021, where the increase in commodities, it was very supply-driven inflation. This is different. We're talking about a demand-driven inflation this time around, unless you look at Europe and then the natural gas prices, or unless you look at Japan and the energy prices. Does that build in a correlation, a stronger inverse correlation, as I'm working through it in my head, between commodities and how you trade the yen and the euro?
Yes, well, if you see the correlation between the dollar and the commodity price in general, they tend to correlate pretty well. So if commodity prices are actually going lower because of the Trump's, energy policies to lower the energy prices, then the dollar strength story could ease a bit. But I think people are still concerned about the growth stories when we talk about the euro dollar, especially low growth in the euro area and resilient growth in the U.S. So commodity price is an important factor, but I think what the market is right now focused on is more about the growth between the U.S. and the euro area.
So how much growth is too much growth coming out of the United States? How much of deregulation or resilience would undermine that dollar strength story?
It's difficult to quantify, but with current GDP growth continuing, and even a modest pickup, I think that could, people think that, okay, the Fed is unlikely to cut. If you see the market pricing, it's now pricing in around 40 basis point cut for this year. But if you asked me the same question like about 3 weeks ago before the CPI, it was less than 25 or like around 25. So if we see even a modest uptick in CPI and modest uptick in growth, then I think the dollar story will just continue.
Okay, so that's the dollar side. And let me focus a little on the European side of things, because we've had this strong data out of, take that back, not strong, better than anticipated data out of certain parts, certainly Germany on the manufacturing side. And we've seen traders then pairing their bets around the ECB as a result of this. Is this enough to make you rethink what you do on the ECB, what you expect from the ECB either next week or further down the line, or we're still clutching at straws when it comes to the European growth story?
Our base view is unchanged. We think the ECB will likely cut by 25 basis points next week and continue cutting by each meeting. As we discussed here, PMI has been stabilizing rather than recovering. And we also have to discount the fact that PMIs these days tend to perform well in Q1 and Q2, even though those are seasonally adjusted. It could be the reason due to seasonal adjustment during the COVID pandemic period. But still, I think the market is somewhat discounting that seasonal adjustment factor when taking in today's PMI figures.
We're still waiting for the UK PMI. That comes, I think, 9:30 London time, so in just under an hour. Consumer confidence was pretty weak overnight. And we've seen a lot of volatility and negativity around the pound, and that bond market story ran for a couple of weeks. How much negativity are you expecting the pound to price in, or not?
This is a pretty difficult question. I mean, if you see the UK growth overall, especially the inflation side, inflation has been sticky, and that was the reason why the BOE was difficult to cut compared to the ECB, right? But we had a mini debt crisis again, which has put the pound to the downside. That seems to be easing, and the market have acknowledged that, okay, the BOE is likely to cut in February by 25 basis points. I think that, at the moment, relieve the market. But if that concern comes again, then I think that's going to be a big trouble. But at the moment, we're relatively positive on sterling against the euro.
Let's talk about the Japanese yen. So the press conference was fascinating to follow. Came in, I think there was an expectation of pretty much what we got. He sounded initially a little bit hawkish. That seemed to be the tone. But by the end of it, I'm left wondering when the next rate hike is coming through. So what is your sense of kind of where we are coming out of this press conference in terms of the cadence of rate hikes from the BOJ?
Yeah, I think our view is that the BOJ's rate hike is going to be once in 6 months. I think that's like the optimal, appropriate timing for the BOJ to hike for the next hike. BOJ hiked in July last year, now January, and I think they're looking for a July hike again. But if you closely listen to BOJ governor's speech, he didn't clearly mention when it's going to be. Yeah. He left the door open. And I think that's related to one political calendar that we have in Japan in this summer. So we have upper house election due in July 2025. So that could, make the BOJ's rate hike pass less smooth. And if that's the case, maybe BOJ may have to hike in June or maybe delayed to September. So I think the BOJ left the door open to have the every meeting live.
Do we still need to be talking about levels for currency intervention? Give us a range on the yen if you can.
Yeah, I mean, like, in terms of the intervention, I think there's no, like, explicit level that could trigger the MOS intervention. And at the moment, if you closely listen to MOF officials, like verbal interventions, I think 160 is not the level that they will come out. It could be a bit higher. But at the same time, the BOJ is also cautious about the yen weakness these days. And he mentioned that he implicitly mentioned that one of the reasons why the BOJ hiked today was because of import prices going higher because of the yen depreciation. So with the combination of the BOJ and MOF still vigilant about the yen weakness, I think dollar yen's top side is relatively limited.
Great to see you. Thanks for stopping by to update us on a range of different FX stories that we're watching so carefully this morning. Yusuke Miyari, FX strategist, joining us from Nomura. Coming up, we're going to take a look at today's big take, which weaves together Elon Musk's scrutiny of the new Air Force One that Boeing is currently building and is behind schedule on. He's pretty good at engineering. Kind of, how does that relationship work? How is Kelly Ortberg going to deal with Elon Musk staring over his shoulder? I think that's a really interesting conversation. We'll talk about the numbers from Boeing as well. Yesterday, GE out with figures as well. All of that up next. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Let's talk about airplanes. President Trump is displeased by budget overruns with the next Air Force One. He's got some interest in this one. Meanwhile, Silicon Valley wants to rethink the Pentagon's war strategy. It all comes together in the form, you could argue, of Elon Musk. Elon Musk paying a great deal of attention to this Air Force One program, which is behind schedule. There's a fantastic big takeout on all of this today. Bloomberg's global aviation leader, Benedict Camel, joins us now to talk about all of this. Benny, if Musk is paying attention to Air Force One, which is a big Boeing project, which it's struggling with, but it's got lots of other projects it's struggling with as well, how far does Musk's potential interest in Boeing extend, do you think?
Well, that's what's not quite clear at this point. What we know, what our reporting shows, is that he showed up at the Air Force One site in Texas late last year in December, and he had a look at the new Air Force One that's being built there. Being built there very slowly, much slower than Donald Trump or really anyone had hoped for, far more expensive, far more complicated. And he was there with Kelly Ortberg, we found out, to get a sense of where the project is. Now, you could think that that's a good thing. You know, Elon Musk knows how to fix things. He knows how to get things into the sky. So for him to take a look at what Boeing's up to, that could be seen as good. But let's not forget, he's not anyone. He's a competitor. He has SpaceX. He's also known to sometimes break things and then reassemble them in a very different way. Just look at X, or formerly known as Twitter. So this is a bit of a double-edged sword, really, for Boeing. It could go either way, and that's sort of the complexity for Kelly Ortberg, the Boeing CEO. How does he navigate that? Excuse me.
So, Benny, at the same time as we got these kind of developments, we also had an earnings report coming out of Boeing. Walk us through those numbers.
So the company's really only supposed to report earnings next week on Tuesday, but they came out, this is the second time they came out ahead of time. So late yesterday, they came out with a set of numbers, not the full set, but at least sort of a teaser that gives us a sense of just how bad things are. Now, it's not a massive surprise because we knew that the fourth quarter would be ugly. That's when they had that big strike, and really production was pretty much not happening for the duration of that quarter, and you could see it in the numbers. Revenue is not where it was supposed to be by all three measures. The loss was big again, and then surprisingly, fairly big additional charges in the defense business. We've paid a lot of attention to the civil business, but the defense business is also not doing well. That includes the Air Force One plane, more cost overruns there. It also includes the aerial refueling tanker and a couple of other programs. And the question really is, at what point might they finally be able to ring-fence these contracts that are bleeding money? That's another big task ahead for Kelly Ortberg.
So that's the challenge ahead. What about the opportunities? I think your team, Benny, has an interesting scoop on some asset sales that could be attracting some suitors. Run us through that detail.
Yeah, so really the question for Boeing is, will the company stay whole? Will they stay where they are now? Might we see some disposals around sort of the edges, or a more wholesale sort of remake of the company? One asset that is highly profitable and that has attracted some scrutiny is a business called Jeppesen. It's navigation software, navigation maps. That's a business that's actually making money. That's a rare occurrence inside Boeing these days. And they've attracted some interest from both strategic and financial buyers. The bids are in, the preliminary bids. Companies like GE, RTX, but also sort of some private equity firms are sniffing around that. Again, it's not clear whether Boeing will actually want to sell it. Ultimately, they could earn a nice bit of cash off that, but you know, once it's gone, and then you're left with the rest. So maybe there's a way to keep it, to keep building it up, and then eventually at some later point sell it, or maybe just hold on to it. They do have that extra funding that they got last year, $24 billion, and that really saved them into the fourth quarter. So they have a little bit of wiggle room to wait, and they might see just where do the bids come in. Is it attractive enough to offload it, or might we keep it? That's something we'll keep watching in the next couple of weeks, and it's something that investors will ask about when the company properly reports earnings on Tuesday.
Benny, thank you. Benedict Camel, Global Aviation Editorial Lead at Bloomberg. Let's pivot to the luxury sector. Burberry shares are soaring this morning. The biggest gainer on the European stock 600, in fact, this after the luxury goods maker reported a much smaller decline in sales than had been expected in the latest quarter. We're joined now by Andrea Felsted, who covers luxury for Bloomberg Opinion, so writes about this stuff day in, day out. Andrea, thank you for joining us. So how much of this is Burberry specific? This is a business with a new creative director, newish, and it's undergoing a turnaround. How much of this is the wider landscape?
It's probably
bit of both. The US, Americas, as they call it, they actually saw sales growth. That was also the same with Richemont. The American consumer, it was probably the first to go into the luxury downturn. It seems the first to be coming out, helped by, you know, roaring stock market, crypto. They seem to be willing to spend on luxury. We saw that with Richemont last week. So they're definitely getting a lift for that. They do seem to be doing a few things. They've had some interesting campaigns, although the, you know, interestingly, the Always Burberry weather campaign was actually started off by the previous management and sort of tweaked a bit and amplified, they say, by the new management. They're focusing on their outerwear, their scarves. They seem to be doing well. They also had a big markdown program, a big sale, which also contributed sort of low single digits to their comp. So it's probably a bit of both. Luxury definitely seems to be turning a corner a little bit, led by the US.
What about China?
China's not getting any worse, so that's good. But it's not really improving yet. It's sort of bumping along the bottom. All the action this year will come from the US. You know, the US consumers have got to carry that bling baton until China's ready, hopefully, maybe the second half of the year, maybe next year, to pick it up.
Sorry, got a bling baton, actually.
Very shiny. Maybe don't look it in the eye.
Quite sparkly.
Maybe Burberry will start making them. Walk us through that kind of turnaround story in terms of really tackling and appealing to the American base. There's a question of the new creative designer and whether he could maybe bring Burberry into a more mainstream arena. Is that happening?
There are signs it's happening. I actually was the only person that liked the previous iteration of Burberry. I thought it was great to have
You weren't the only one.
I was the only one. I was the only one out of all the markets. I really was. I liked the fact you had a UK CEO. I liked the fact you had a UK designer who really seemed to get Burberry's Britishness. And it wasn't a tacky version of Britain. It was a cool, quirky. You know, I do wonder whether some of the work they put in the last 2 years actually just, you know, it did. They probably went a bit too fast, a bit too far on the price increases and the handbags. But I actually wonder whether they did start to build a base and suddenly it's starting to take off. It started to take off, but unfortunately they made that, you know, they had that rather knee-jerk CEO reaction, and the new management are just making a few tweaks, and it's starting to work. But you've got to put that work in elevating the brand, energizing the brand, and probably Daniel Lee and what they were doing did sort of pave the way. But that's a controversial view. No one agrees.
They're definitely leaning on the check in terms of what's on the website right now. Arnaud was at the inauguration.
Yeah.
Like, does that just go to your point about the importance of America?
Exactly,
is there something more than that? How important is it? Just to be, the fact that he was there? He's clearly kind of close to them, but is it a reflection of just how important the US is going to be?
It really is. Yes, the US is really going to be the growth driver this year. They don't want anything to damage that, like tariffs. You know, I mean, luxury isn't that exposed to China tariffs because most of the manufacturing is in Europe. But if there were some broad European tariffs, as he sort of hinted at, that would be really damning. You don't want the US, you don't want any problems in the US, while China is struggling.
You know, Arnaud was late for Paris Fashion Week as a result of being at the inauguration. That was, I was reading, you know, so that's where the focus of...
And that takes us beautifully onto the weekend, what we're going to be looking at this week. Paris Fashion Week, is it a big deal? What are we watching for here? What's going to be cool? What's not going to be not? I'm telling you the wrong question.
It's always a big deal. I mean, one of the things that I think people will be watching, they'll be trying to read the tea leaves or the sequins to see if there are any more designer changes coming. We've had this big, you know, turnover of creative directors. And that's because really for the last 5 years, they haven't had to work that hard to get sales. They haven't had to bring out new products. But, you know, when people are cutting back, they really have to work hard on those. But quiet luxury has been terrible for luxury because you can't rely on your logos to sell things. You have to work.
You need the bling baton.
Yeah, you need the bling baton. You need bling back, really, to help them. Goodbye quiet luxury, hello bling. That's what they need.
I'm going to be watching the downhill. I'm going to be watching the football.
The downhill, that's not a football reference, is it? That is the kids' ball.
That's the kids' ball downhill.
Okay, just for
that'll
clarity.
be my Sunday evening to watch that.
I'm going Australian Open finals. That's where
that would be good.
That's
really
where
looking forward to that.
We're going to talk about this on Monday. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
And market movers, live from Davos, Switzerland, for the World Economic Forum. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua, live in Davos for our final day of coverage from the World Economic Forum meeting. Now, this hour we'll speak to the EU's Economy Commissioner, Valdis Dombrovskis. We'll also bring you exclusive interviews with the chief executives of Euroclear and FirstRand. But a lot of the focus here has been on Donald Trump, on some of the things that he's been telling also the virtual audience here, tariffs, China, oil. Now, the week that started off a little bit fraught with risks is actually ending up on a positive note. Now, global stocks at a record high. The U.S. president appeared to soften his approach towards tariffs on China. And then the other thing we really need to spend a bit of time on his BOJ, with the yen strengthening after the Bank of Japan raised interest rates. Now, a couple of other things we're watching out for is, of course, European benchmark. Look, that index climbing also for an 8th day. It's on track for a 5th weekly advance, and that's despite a lot of the concerns that we're hearing for European chief executives about what Trump tariffs mean for them. A couple of market stories. Shares in Banca Monte dei Paschi slumping after the Italian lender launched a takeover bid for Mediobanca. We'll get to that in a second. We also have some data. Euro area January manufacturing PMI rising to 46.1. The estimate was 45. Remember, anything that's actually below 50 is still a contraction, so nothing to write home about. And then Euro area January services PMI also pretty much unchanged at 51.4. Now, European luxury stocks have been boosted by Burberry this morning. The company's shares actually soaring after picking up a U.S. demand, and that boosted result, raising investor hopes for a luxury market recovery. We've been following Burberry very, very closely. First, they have a new chief executive in charge, but secondly, it has really been slammed over the last 6 to 8 months, the share price. So we're seeing a nice recovery from Burberry, 16% higher. Now, talking of share moods, Monte Paschi also, those shares have fallen sharply after it launched an all-share takeover bid for the Italian lender. Now, it's the latest step amid a wave of deals news from the country. So if you look at Mediobanca, it is not listed. And then what we're seeing, of course, for some of Monte Paschi, actually Mediobanca is listed at 16.1, gaining some 5%. It is, of course, listed, and Monte Paschi down some 6.8%. Now, it's been a week here in Davos dominated by President Trump's first days days in office. In a virtual address yesterday, the U.S. leader demanded OPEC lower oil prices and the world cut interest rates. Now, he repeated his tariff threats. He accused the EU of going after U.S. tech firms. Now, the U.S. president also delivered a surprise jab at Bank of America's Brian Moynihan, who was sitting on the stage here at the World Economic Forum.
I hope you start opening your bank to conservatives, because many conservatives complain that the banks are not allowing them to do business within the bank, and that included a place called Bank of America. They don't take conservative business. And I don't know if the regulators mandated that because of Biden or what, but you and Jamie and everybody, I hope you're going to open your banks to conservatives, because what you're doing is wrong.
Well, let's get more with Sridhar Natarajan, Bloomberg's chief Wall Street correspondent. Sri, so you've been following all of the bankers here, and they have like a complex relationship, I would say, with Donald Trump, but a lot of them are really happy that there's going to be deregulation and animal spirits. And then there was this weird moment where Brian Moynihan was on stage and the president was in the White House, and he got this jibe about not banking conservatives. What was that about?
Complex relationship. That's exactly what's the right term to use here. Brian Moynihan, the CEO of Bank of America, walks up there with a bucket of praise for the 47th president and the 45th president of the United States, Donald Trump. And instead, the president turns around and pours cold water on him. That is why this is complex. All bank CEOs, much like corporate America, much like the tech CEOs, all business leaders have been trying to say positive things about Donald Trump, trying to make it sound like everything he's doing is the right thing. And they've perhaps understood that flattery is the best way to get good results out of this president and hopefully out of this administration. Yet, Donald Trump used that platform where he was ostensibly addressing not just the American CEOs, but the global business audience to rail on these banking leaders. Brian Moynihan, who was on stage here in Davos, but also Jamie Dimon's JP Morgan, saying that they're shutting out conservatives because this has been a pet peeve of the Republican base that elected Donald Trump and brought him back to the White House. It was an interesting moment in stage to make that point, but that is Trump, true to form, unpredictable.
Yeah, unpredictable, but also it is strange, as you say, because it's basically shaming him in a public forum. I mean, those kind of conversations usually behind closed doors where the chief executive decides that he can do something about it. Does it hurt the credibility of Wall Street? Will they fight back? I mean, how do you see this relationship ending?
Much easier to answer the will they fight back question. Absolutely not. Look, they know that there's no way that this president will stand criticism. In fact, many people have gone out and said, and it's been obvious, that he's a little bit thin-skinned about criticism. Flattery is the only way to go forward. And look, they want a lot out of him. Their hope is that when you have the two sides of Donald Trump, the trade wars, the tariffs, the unpredictability, the volatility of policy, the policy whiplash, which can be bad for business, and weigh that against the possibility of banking deregulation, broader deregulation, tax cuts, that would be much more important to them on the longer term and could weigh out all the negatives that Donald Trump brings out. So that's what they're hoping, or if they can goad him in that direction, they are willing to take whatever punches comes along the way.
Sri, do you see a real divide between European bankers that are frankly quite depressed about regulation, being unlocked in the U.S. whilst they have to deal with some? And is that, divide between Wall Street and Europe going to widen significantly?
I mean, you just have to look at the kind of conversations you've had with business leaders all through the week. The European business leaders who have come on TV shows here and elsewhere, the tone, the confidence and the vibe that they've been expressing, and compare that with the rah-rah optimism of the American business leaders, it's clear. Look, the numbers show it. IMF expects, just bumped up its growth forecast for the US, 2.7%. Eurozone overall, 1%. That's a very clear divide there. And that's why the phrases that we have seen come out of this is peak confidence, peak optimism, cautious optimism, even if you want to be a little conservative out of the US, but peak pessimism out here in Europe.
Yeah, and also massive kudos, of course, to our Italian team who broke the story of Banca Monte dei Paschi making this offer for Mediobanca, which frankly was quite unexpected because it's the smaller bank trying to buy the big one. But, how is Wall Street looking at some of these concerns that we can't get cross-border, but you could see quite a lot of domestic consolidation in Europe?
I think for a while it's been clear that for the European banking industry to be able to compete with the American banks, you need larger banks. You need to have stronger players. Cross-border deals have not had much success. There's always seems to be a lot of obstacles on that front. So instead, let's focus on creating domestic champions. However, this one's interesting, and the Italian banking landscape in general has been interesting. There have been so many interesting deals. This one, obviously, is fascinating because it's a smaller bank making a play for a bigger bank. A few months ago, you had UniCredit making Banco BPM a takeover target, which itself was going after a domestic asset manager, and then you have UniCredit with what it's trying to do in Germany. So a lot is happening, but in this deal in particular, It seems a little challenging because the premium is only 5%. Analysts have already come out and said there are not a lot of synergies at play, so they don't really see how this can easily succeed. And if you also look at the holdings of the two companies and the two different billionaire clans and the cross holdings across the two companies, it makes you wonder whether, while the proposal might be aggressive and creative, will it actually get done and get over the line? It doesn't look quite like that. And the stock market reaction that we've seen would also suggest that it may not quite get there.
Yeah, it's very clear. Mediobanca, I think, up some 5%, and actually Monte dei Paschi down some 6%. Shri, as always, thank you so much for joining us. Sridhar Natarajan, Bloomberg's chief Wall Street correspondent. Now, coming up, we'll speak to the chief executive of Africa's biggest bank, First Rand. We'll get her thoughts on the South African economy and the impact of Donald Trump's policies on the continent. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bloomberg Invest is back. Join me, Sonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Welcome back, everyone. Now, the South African President, Cyril Ramaphosa, says he expects to find common ground with his U.S. counterpart, Donald Trump. Now, the South African Reserve Bank governor warned here in Davos that U.S. protectionist policies could fuel inflation and put pressure on the rand. America is the African nation's second largest trading partner after China. Well, someone who's positive about South Africa's prospects over the coming decade is Mary Vilakazi, the chief executive of First Rand, Africa's biggest bank by market cap. And Mary joins us for an exclusive interview. Thank you so much for joining us. There's a lot of concern out there. There's also a lot of optimism. Frankly, this is like a Davos I've never seen before because you have these competing forces. How much do you worry about the macroeconomic outlook because of possible Trump tariffs?
Thank you for having me. I think, as the Reserve Bank governor pointed out from South Africa, we worry about the inflationary impact that the tariffs and the other policies that I think are going to be driven by the U.S. Although, having said that, I think we still have to watch the execution of what Trump also says. So, I suppose one has to make sure we don't completely get ahead of ourselves. But what is positive from the focus on the U.S. growing its economy and doing whatever it takes is that I think it's forced a lot of countries to sit back and say, how are we going to grow our own domestic economy, which in Africa has been neglected for a long period of time. So it's good, though, that for South Africa, we were already on a path of economic reform. So if it was 3 years ago, I think it'd be paralyzing. So I think, yeah, it's going to be inflationary. The dollar's going to be strong. That's not a good thing for emerging markets. So I think the competition for capital is going to be real, and that's what we also need to grow the economies.
So is there, I mean, I can't tell whether it's a good thing because it means that it needs to act, right? So we're hearing that from a lot of European leaders, whether it's a kind of impetus to challenge or whether you think there'll be a downturn and then, parts of Africa can rise.
Well, I think in general, I'm in the camp of the people that it will get better. Because I think people will respond. Nations will also respond to what's happening globally. Of course, it impacts the global growth because then we're not probably growing at the potential or what we were used to. But I think that's just the reality we have to get used to in this new world that we find ourselves in. It is going to be very difficult for countries that have high levels of debt in Africa because I think with a strong dollar, that's not a good thing. And then I think ultimately, for me, the bigger concern is what happens to U.S. debt.
Of course.
That's got huge ramifications, I think, for us in South Africa as well.
So does it mean that you're preparing your bank to, you're shifting things to make sure that you're prepared for any eventuality?
I think we've been prepared. We've been preparing for quite some time because I think the number of shocks, the frequency of shocks impacting financial markets is something that's of concern. And the focus, making sure that we're resilient, I think has been a very big focus of our bank and the sector. I know for sure. So, we have to make sure that we adapt. But as I say, we're very mindful of what happens with sovereign debt because that's got serious knock-on effects. Yeah.
Are you planning to invest in South Africa this year? And if so, how and how much?
So that's definitely high up on the agenda. I think with the economic reforms, for a first time, I think they've got significant projects that are on the way. I think the need for lending to help the economy is quite significant. Mm-hmm. I think we would need more than the banks can actually facilitate. But, I think we have to make sure that we make a compelling case against all these other competing needs. But certainly, I think there are projects that we can see that haven't come about. Household confidence has improved. Business confidence has significantly improved. So, high up on the list of investable opportunities for the bank is the South African economy.
And so that means fixed investments, basically. You're really seeing opportunities because of some of the structural reforms that have been put in place. How do you see the outlook for South Africa, after the election cycle?
It's been very positive. I think we went into the election cycle with a lot of uncertainty. And I think emerging from a period whereby the ANC lost elections for the first time after 30 years, and then quickly coming on to realize that they need to get other parties so they can govern, and then prioritize growth. I don't know how long in South Africa we have gone on without the government indicating that economic growth is a priority. So I think it's been very encouraging. Of course, the government of national unity has its own vulnerabilities. Mm-hmm. But I think beyond what plays out in the public, I think there's real commitment to making sure that it works. So, as business, I guess we are rallying behind supporting the government's agenda because I think that's greatly aligned to what we have been wishing. And I think the impact of the structural reforms is going to, that's the only way we create jobs, something that's been stagnant in South Africa, and also just so that we can go back to growing the economy beyond the 1% area that we've been in. So I think if one looks out, 3 to 5 years' time, I think the South African economy would have recovered. And we're seeing encouraging signs day by day.
And with that comes opportunities. Thank you so much for joining us today. That was Mary Vilakazi, the first round Chief Executive. Now, coming up, we'll speak to Euroclear's Chief Executive, Valérie Urbain, on the potential impact that President Trump will have on Russia's frozen assets. So that's a good conversation on money moving around for reconstruction. That's next, and this is Bloomberg.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
While speculation is mounting on President Donald Trump's potential impact on Russia's frozen assets. Now, this comes after he announced a 90-day executive order suspending foreign aid to countries, including Ukraine. Now, Belgium-based clearinghouse Euroclear holds the bulk of Russia's frozen assets. The chief executive, Valérie Urban, joins us now for an exclusive interview. So thank you so much for joining us. I mean, this is extremely critical moment, actually, to see what President Trump wants to do in Ukraine. Without the support of the U.S., it's going to be very difficult to see some kind of peace agreement or pushing back Russia. Where do you stand on the negotiations on the frozen assets? This is basically, you know, the idea that you could take the frozen assets to help reconstruct Ukraine.
So first of all, I would like to say that this war is a tragedy, and all our thoughts go to the people who are impacted by the war. Now, since the start of the war, we have always been dutifully respecting the international sanctions, and as a practitioner, we have the duty, the obligation to really inform properly all the decision makers, the policy makers, about the unintended consequences of various decisions. And so as far as the confiscation of assets is concerned, it's a debate which is on for almost 2 years now. And fair to say that on our side, what we have also tried to defend is the rules of law, and to make sure that, you know, the rule-based system that has really underpinned the trust in the financial markets remain. And so this is why, you know, talking with the different authorities, we are putting in front of the people, you know, the sovereign immunity as well as the asset protection.
Yeah. Can you give us so first of all, how many of these assets, like how big are these assets? What are they?
Well, it is really the reserves of the foreign reserves of the Central Bank of Russia, so it is sizable, you know. And indeed, these securities, which now have been transformed into cash, actually, have been immobilized for now since the start of the war. Now, the first thing which has already happened is the payment of the windfall contribution, meaning that all the revenues, the interest revenues that we are earning on these immobilized assets have now, you know, been given to the European Commission through the windfall contribution to already, you know, support Ukraine in its reconstruction or if anything what they need.
How do you see Donald Trump's presidency changing all of this?
Well, I think Donald Trump will certainly, you know, put pressure to negotiate with Russia, and of course, everybody will welcome, you know, the peace. So I think, unfortunately, I think where I stand, I don't have really any control on that. What is important is to see how the negotiations unfold and how we continue to inform as best as we can the decision makers on the unintended consequences, knowing that there could always be also countermeasures from Russia, which could further destabilize the financial markets.
So, for example, I mean, should the member states be responsible for guarantees in case Russia then reclaims some of these assets back?
That's a very important point, and indeed, this is part of the unintended consequences. To make sure that if we seize the assets, it's not only the assets which are being seized, but also the liabilities, are put together and are taken, because otherwise, Euroclear could be at a certain point of time faced with the fact that the assets are gone, but the Central Bank of Russia is claiming back its securities or its cash. So indeed, that's why it's a complex matter, because you really have to look at all the different angles of the equation.
I mean, I know right from the start you highlighted the risks, for example, of EU member states deciding to confiscate the assets. I mean, recent voices say, look, some of the risks that were talked about at the time did not materialize. Why do you think that is?
Well, can you?
Is it more like of a timeline? So, for example, the voices, including Mr. Dombrovskis, who will have in a very short while said, look, the assets were immobilized, but the risks surrounding them, so either reclaiming or not, or going lost or legally disputed, that didn't happen. Could it still happen, or is it a matter of time?
It can still happen, and I mean, we have seen the case in the case of the Iranian assets, where 20 years later, I mean, the claim has come in. So I think this is not something which is theoretical. Now, the timeline is not yet there, this to happen.
So what do you see as, what do you think is the right way forward?
I think the right way forward is certainly to start more negotiating the peace, and then probably these assets will be an element in the negotiation. But I think this is what has to start, certainly.
I mean, do you see enough people talking about this here? This was, talked about as one of the top risks of how to deal with Russia and the confiscated assets. But
I can assure you that many people are talking about that. Yeah. So I think it's very much very high on the agenda of everybody. Yeah. And so indeed, I think everything which is related to sanctions, related to the way forward with the assets, all of that is really part of the conversation, of the daily conversation, I would say, by all different decision makers.
Do you think we're closer to a resolution? Because you can talk and talk, but not want to find commonality, right?
Yeah, but I think, I mean, to come to a resolution, you need the two parties to agree with that,
So let's see. So your work is not done.
No, not at all. And I still believe that this could last for some time.
Okay, thank you so much for a very important interview. The Chief Executive Officer there of Euroclear, Valérie Urban. Coming up, we'll speak to EU Economy Commissioner Valdis Dombrovskis on Donald Trump's tariff threats and how the EU plans to respond. That's next, and this is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Good morning, everyone, and welcome to the final day of our special coverage live from Davos for the World Economic Forum annual meeting. I'm Francine Lacqua. Now, President Donald Trump has made fresh tariff threats against the European Union. This after he criticized its trade practices and regulations, describing them as unfair. EU finance chiefs, however, have warned against hasty retaliatory measures in response to the threats. Where I'm very pleased to be joined now by Valdis Dombrovskis, EU Economy Commissioner. Commissioner, thank you so much for joining us.
Good morning.
Were you in the room yesterday listening to Donald Trump?
Indeed, I was there and listening to both the speech and panel debate.
And so what did you make of his speech and also the questions that were asked from chief executives?
I would say there were no major new announcements, but in any case, it's clear that we will need to engage closely with the Trump administration. EU and US are strategic allies. We have been working closely together for decades. If we discuss economic cooperation, EU-US trade and investment cooperation is largest in the world. Yeah. And together we make 42% of the world GDP. So there's lots at stake economically.
Yeah. But Commissioner, do you know if the new Trump administration has already reached out to the EU for talks, or has there been a phone call?
There had been contacts at different levels of administration, and certainly will engage intensively because what President Trump has now announced regarding the tariffs, that federal agencies in the US need to study the topic and then come with some reports and suggestions. So it also gives us more time for engagement, for working with Trump administration and hopefully finding constructive solutions.
How do you think the Trump policies will actually change the European economy?
If it was to go in the direction of global economic fragmentation, it's going to be damaging not only for European but for global economy. There are estimates that if this global economic fragmentation would take place, meaning trade focusing within certain geopolitical blocks, it can lead to a decrease of global GDP by 7%. It's like taking Germany and France's GDP combined out of the world economy. So it's indeed a damaging scenario, and we should work to avoid it.
I've heard a lot of pessimism, actually, from European chief executives. You worry about, pessimism now, worrying about what happens in the U.S., impacting capital expenditure in Europe, and therefore being a self-fulfilling prophecy.
Well, one thing is clear that also in the EU we need to work ourselves to strengthen the competitiveness and resilience of European economy. And all in all, European economy has been resilient in consecutive economic shocks, starting with COVID-19 pandemic, then economic implications on Russia's aggression in Ukraine, which are mostly felt in Europe. And economic growth in EU is continuing despite all this, and this year we expect around 1.5% growth. Obviously, it's relatively slow growth. Yeah. But then there are also structural issues like relatively slow productivity growth, which we had already for decades, falling behind US and also China in terms of productivity growth. And we need to address it. And that's why the new European Commission now, in a new mandate, we are putting lots of focus on strengthening EU's competitiveness.
But Commissioner, do you believe that Europe, for example, should cover the American part of the bill of financial support for Ukraine if Trump cancels its contribution?
Well, there I would say that the financial support for Ukraine, at least for this year, is secured, both through the EU's Ukraine facility, but also through G7 loan. And from this G7 loan, a U.S. contribution was $20 billion, which are already transferred to the World Bank, and $1 billion is already transferred to Ukraine. So we do not expect that this money would suddenly not be available. So the money for Ukraine is available for this year.
For this year, but what about next year? I mean,
well, certainly we'll need to engage with the Trump administration to discuss for the coming years. That's very clear. In any case, EU's Ukraine facility goes till 2027. But what is more imminent right now is a question of weapons supplies, ammunition supplies. It's something Ukraine needs right now, and it's important that these supplies continue.
When you look at the next 12 months, what does Europe need now to counter some of these tariffs? You talk about competitiveness. Do we need to spend more? Should we do away with some of the debt management mechanisms of certain countries?
Well, first of all, as I was mentioning, we are working with the Trump administration, and hopefully we can avoid certain damaging scenarios. But then, in terms of the EU, we'll be outlining our approach how to strengthen EU's competitiveness with so-called competitiveness compass, which we're going to put out later this month. And obviously, it covers many areas. It's not only about budgetary spending. It's many issues which we need to address: reduction of administrative burden, addressing our relatively high energy prices, labor skills, and so on and so forth.
But it must be frustrating that Europe has been so slow. And again, even if the tariffs don't hit Europe, we think that capital moves to the U.S. instead of Europe because it's just more attractive with more growth.
Well, and that's exactly what we are currently now working to change, to make competitiveness of European economy a priority, and indeed to make European economy stronger.
What's your hope for Germany? So we're 6 weeks away from the election, actually 4 weeks away from the election there, and Germany, I guess, needs to be stronger for the good of Europe.
Well, indeed, Germany is the largest EU economy, so what happens in Germany affects the entire EU. And there is also, I would say, acknowledgement in Germany itself that they need to invest more in infrastructure, in their technologies, companies, and this is what we are hoping is going to happen.
All right, Commissioner, thank you so much. I know you have a lot of work ahead of you, given the next 12 months. Valdis Dombrovskis there, the EU Economy Commissioner. Now, the European Investment Bank also says it expects to double the amount of investments it facilitates for defense and security this year. Now, this comes after years of underspending by European Union member states. Well, I spoke with EIB President Nadia Calvino, who says the region is seeking to jumpstart the industry.
We're already walking the talk. Last year, we mobilized 1 billion euros in investment for the security and defense industry, and we expect to double that amount in 2025 so that we can really support SMEs and the large innovative contractors in Europe.
Do you have already very specific projects that you could point to, or is it too soon?
We have already invested in a number of projects that have to do with military mobility, infrastructures, also space, satellites. We are currently studying a number of projects. I hope that and I'm confident that in the course of 2025, we're going to see large European projects that will surely make a difference to Europe's defense capacity.
Do you also expect some of these defense investments to happen in Ukraine?
Well, our scope of activities is inside the EU when we're talking about security and defense. But obviously, what I can also say is that our support to Ukraine is unwavering. And we have already disbursed 2.2 billion euros in support to Ukraine since the beginning of the war. We implemented a 600 million security program for the winter in the energy sector. I was with Minister Marchenko earlier in the week, very impressed that with all these attacks, there have not been blackouts in Kiev. And I think that this unanimous support from the European Union is surely going to continue in the course of the year and until, I hope soon, we see the peace in our eastern neighborhood.
What about some of the investments regarding climate change? So does it move away from the U.S. into Europe, some of the private money that you can then support?
Well, you know, I think that climate action and the green transition has moved into a new phase. It's no longer driven only by grandiose objectives or political commitments. It's much more driven by technologies and business cases. I think that companies have realized that there's a business case. In the case of Europe, it's a no-brainer. We need to become independent from fossil fuels. It's a matter of security. It's a matter of competitiveness. We need to have the cleanest and cheapest energy sources possible. As I said a moment ago, we need to master our own destiny, and that means relying on our own forces. And that, I think, makes it clear that European companies will continue to lead the green transition, and we will seize all opportunities in this regard.
But what does Europe need now to make sure that, for example, startups that are flourishing stay and grow in Europe and maybe IPO in Europe rather than going elsewhere?
Well, that's the area where there's a bigger gap vis-à-vis the United States. This has been identified in all relevant reports. And so we're working together with the Commission and with the Member States to foster this capital markets union, to see how to mobilize money from the cradle to maturity of these companies. In the first instance, research with grants, but then venture capital, venture debt. We are already active in all these areas, but we also need to scale up our support to successful, innovative European companies so that the bright ideas, companies, technologies that are born in the EU, they can grow and prosper in Europe.
What's the right way, actually, to kickstart Europe? I mean, there's a very big divide between American investors who are very excited about deregulation and some of the animal spirits really coming back in full force in the U.S., and Europeans who feel left behind.
Well, I think that deregulation is not the solution for everything. You know, there's these sort of magic words, you know, that everybody is counting. No, in the case of Europe, we need to reduce red tape, to simplify the rules, to recalibrate green reporting standards. We're also working and engaging with the European Commission to make sure they're fit for purpose. But what we need is integration, investment, you know, and Europe starts from a very strong position. We are a trade powerhouse and innovation powerhouse. When we're talking about clean tech, health tech, we're second to none. So we should be also more self-assured. We have a strong basis on which to build. If we are united, we will be successful.
Well, that's the European Investment Bank President Nadia Calvino. Coming up, we'll look at how markets have responded to President Trump appearing to soften his stance on tariffs on China. That's next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Well, global stocks rallied. The dollar weakened as President Trump appeared to soften his approach towards tariffs on China.
We have one very big power over China, and that's tariffs. And they don't want them, and I'd rather not have to use it. But it's a tremendous power over China.
Well, for more, let's bring in Bloomberg's Valerie Teitel. Valerie, break down the market impact that these comments had. A lot of whipsawing.
Exactly, Francine. A lot of it has been in the FX market. A lot of heat has come out of the recent dollar rally. The market really doubting whether we actually see any of these tariffs on paper anytime soon. It's led to a big move lower in the 5 days since Trump was inaugurated, down nearly 1.6% in the last 5 days. And not helping this situation is the better than expected PMI data we've gotten out across Europe. We flip the board and just check on how the euro is faring. A big leap higher in the euro, up 0.8%. And in the pound, that's from the PMI data coming in better than expected, dashing some of those fears about sour economic data continuing here in Europe. And lastly, Francine, adding more fuel to this dollar weakness, it was what happened in the Bank of Japan decision. Yes, they hiked rates, but they also upgraded their inflation forecast. That hawkish signal to the market saw dollar yen to the downside, down 0.3%.
Valerie, thank you so much. Valerie Teitel there with some market moves. Now to some other stories making news. And Boeing has reported fourth quarter revenue that missed estimates after last year's bruising strike that idled almost most of its aircraft production. Now, preliminary results show sales were $15.2 billion, less than $16.8 billion expected. Well, Boeing took a hit of over $1 billion in charges tied to the strike and also updated investors on the impact from troubled defense programs. And Tesla will release a software update to about 1.2 million of its cars in China to fix issues with the electronic power steering and rear view cameras that pose safety risks. Well, that's about the half of the fleet that Tesla has sold in the country in 2024, and that's according to the China Automotive Technology and Research Center. Now, President Trump has used his return to the White House to press OPEC nations to bring down prices by increasing production. He also wants greater domestic supply. Let's bring in Will Kennedy, Bloomberg's senior executive editor for energy and commodities. Will, thank you so much for joining us. I mean, I thought it was quite interesting that he kind of went after Saudi Arabia and saying, like, look, they should have, done something for the price of oil even before the election to help out. Just hours after Saudi Arabia said they would invest $600 billion in the U.S. What's that relationship going to look like?
It's a really interesting question, and it will be, as it was in the first Trump term, a very important relationship. This is an old tune that Trump sang throughout his first presidency, and it appears that he's going to keep singing it during his second presidency. But there are a lot of things that we don't know yet, and whether this is just rhetoric, and there are bits of his energy policy, principally about what his sanctions on Iran and Russia are going to look like, which will determine how this plays out. Because obviously, if oil production were to fall from other OPEC members, Iran in particular, that might give room for Saudi Arabia and other OPEC members to increase production. And let's remember, the policy aim of OPEC is to bring more oil back into the market this year if it can. Now, the tension is going to be that Trump clearly wants much lower oil prices. Saudi Arabia, the UAE, want prices to stay around the $80 a barrel mark, we think, and perhaps even a bit higher.
Well, I mean, I guess what's missing in what we heard from Donald Trump, and it's the first time, his thinking is, look, if the price of oil is lower, it helps him out. It also squeezes more Russia, which helps with Ukraine. Do we know what he's prepared to do about it?
No, we don't at the moment, and I think at the moment it is just rhetoric. He will want to speak to Mohammed bin Salman, of course, and as you said earlier, it's a complicated relationship with investment and arms and all sorts of things in the mix, and he'll want to work out what his policy on Russia and Iran is. But I think it just shows that reflexively, Trump is always going to put pressure on OPEC. He wants oil prices to be lower. He sees it as a key part of his fight against inflation.
Well, what should we be watching out for in the next couple of weeks and months? What do we know about also how much extra oil will be drilled in the U.S.?
This is the other part. I mean, of course, Trump rhetorically has said, I want to unleash oil production in the U.S., and he is going to do lots of things. We saw through executive orders to try and make that easier in terms of deregulating the industry. But most people in the industry think that actually scope is limited for that to happen. The Permian, where most growth has come from in the last decade, that big oil field, shale oil field in Texas, is maturing. It won't grow as fast. Oil companies aren't willing to invest that much. They're going to concentrate on profit. So that may not be as spectacular as he hopes, which again feeds into this OPEC path, because if he's not going to get the oil production from the US to the scale that he's sort of asked for, it may have to come from elsewhere.
Well, thank you so much. Bloomberg Senior Executive Editor there for Energy and Commodities, Will Kennedy. Now, coming up, it's been a week. It's certainly been a week and a half here in Davos, dominated by President Trump's first days in office. We discuss the key takeaways from the World Economic Forum next. This is Bloomberg.
Bloomberg Invest is back. Join me, Sonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. I'm surprised they didn't do before the election. That didn't show a lot of love. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. I really would like to be able to meet with President Putin soon and get that war ended. We've been having massive deficits with China. The EU treats us very, very unfairly, very badly. My administration is acting with unprecedented speed to fix the disasters we've inherited from a totally inept group of people. My message to every business in the world is very simple. Come make your product in America. You and Jamie and everybody, I hope you're going to open your banks to conservatives, because what you're doing is wrong.
Well, U.S. President Donald Trump weighing in on the Fed, oil prices, and of course plenty more as he addressed the World Economic Forum. Now, Trump has dominated, frankly, the conversations here in Davos. We discussed the week that was. I'm joined by Chad Thomas, our Bloomberg Europe executive editor, but actually more than that, he's our Davos Tsar, because he organized and sent headlines and got the scoop. So, Chad, you're still standing. And you look far too
beautiful
fresh.
Last day, you know.
Yeah, it is a beautiful last day. I mean, yesterday was incredible. So I tried to get in. So you had basically 4 chief executives on stage with Donald Trump from the White House kind of being beamed in. I tried to get in, and it was full. It was impossible to get in.
It was the seat to get this week here, even though he was only being beamed in, but you had the CEOs on stage. You had to have a white badge, basically, to get in. You have one of those, but even you didn't get in. It was packed. People wanted to hear what he had to say.
And he's been dominating the agenda because of the inauguration, because of tariffs, because of concerns over inflation and geopolitics the whole week.
Basically, it's really interesting to see how, even though he didn't come here, he dominated the discussion here in Davos. That was what everyone wanted to talk about, and every morning I think people were waking up at 4 or 5 to see what executive orders did he sign overnight, what did he say regarding tariffs. There was always a new country that was where there were tariffs threatened. Tariffs seem to be what is going to be his go-to method to try and get people to do what he wants. The threatening tariffs on Russia if they didn't fall in line in ending the war in Ukraine. It's clear that that is what he's going to do when he wants something from various countries.
Yeah, it also reminded me that then he gave an interview and saying, but you know, tariffs are not the only way for China. Is that's how he negotiates, but you're unclear whether he follows through. Like, you don't know, what's policy and what's a negotiating tactic.
China is the really interesting one here, Francine, because if you had asked people 2 weeks ago, what's the country that he's going to probably come out and hit really hard, they probably would have said China, but he's actually been really soft on that. And then with TikTok as well, and saying, well, do they really need to sell their U.S. operations? It's something only that, kids use to watch videos. It's interesting that he has been soft there. He wants China also to help to end the war between Russia and Ukraine, and he thinks China has a lever there to play. So he has been softer on China this week so far.
I mean, I heard one chief executive saying, like, he's assuming that the presidency is just going to be one big transaction, right? So yesterday we saw the Saudis give $600 billion or pledge $600 billion to invest in the U.S. But then the president still saying that he wants OPEC Plus and Saudi Arabia to do more to lower the price of oil.
Yeah, it is going to be very transactional, and there was also that moment with the Bank of America CEO Brian Moynihan where he really took him to task, saying that they weren't, lending to conservatives in the way that he wanted. So he definitely isn't afraid to call people out. He isn't afraid to say, this is exactly what I want. And the thing is, even if you give what he's asking, there's probably going to be another ask.
Yeah, and all of this mostly in public forums. So again, that changes the dynamics.
Yeah, it's not behind closed doors. Yeah.
Chad, thank you so much. Chad Thomas there, our Europe executive editor, and of course, the man who's put Davos and our coverage together. Well, that brings us indeed to the end of our week of special coverage from Davos. Up next, Bloomberg Brief, Manus Cranny in New York, and this is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning from our global headquarters in New York. I'm Manish Krana. You're welcome to Bloomberg Brief. Let's set that agenda. Softening this stance, President Trump says he'd rather not use tariffs against China. Global stocks rally to a record high, and the dollar drops. Not done yet. The Bank of Japan raises rates and inflation estimates, boosting the yen. And as the World Economic Forum is wrapping up in Davos, President Trump challenges the world to come to the table, negotiate, and deliver. Good morning. We're just shy of those record highs in the S&P 500. The calls, clarion calls from President Trump to the world at Davos. Lower oil prices, lower rates. He knows more about the Fed, and he will be speaking to Jay Powell. The elixir of life, more so for the FX market than the equity market, is rather not putting tariffs on China. The risk is this, the flow into the U.S., fourth week of inflow, $7 billion, driven by large caps. But I take you to the bond market. Again, jaw-boning rates was the stance from the president yesterday. 463 is where we are. Don't forget, we've rallied almost 20 basis points in 2 weeks. We've given some of that back. Hoisington, still very bullish on bonds. They see slower inflation. And to the FX market, this is ground zero for the reaction function from the utterances and the narrative from President Donald Trump. A couple of things going on here. The yuan gets a Trump bump. He dials back, let's say, his veracity, his vocalness on the possibility of tariffs. He'd rather not put them on China. The yen is strengthening, but it's given back quite a bit as the Bank of Japan raises rates to the highest level since 2008. And Morgan Stanley says that there's a silent plurality out there that wants to sell the dollar. We're down 0.5% on those tariff comments. We're also keeping an eye on Texas Instruments. Some stocks on the move this morning. They've given a disappointing earnings forecast hurt by sluggish chip demand and higher manufacturing. Boeing also falling after preliminary numbers show disappointing revenue as a result of the company's strike and defense business. MicroStrategy rising along with other crypto stocks. This is President Trump signed an executive order creating the working group to advise on crypto policy to the White House. In just a few moments, we'll talk more about that Bank of Japan decision with Mark Dowding of RBC Blue Bay Asset Management. Later this hour, JP Morgan's Kelsey Barrow joins me around the desk. It is our top story this morning. President Trump softening his tone on tariffs against China, saying this on Fox News: "We have one big power over China. That's tariffs. I'd rather not use it, but it is a tremendous power. It is a tremendous power over China." Mark Dowding is the CIO, the Senior Portfolio Manager at RBC Blue Bay. Mark, there's no doubt about it that this week has been quite significant in that we've had no actual tariffs. We've had a softening in the language on tariffs. We have this Goldilocks on steroids narrative from HSBC. Do you share the exuberance for risk? Are you a little bit more judicious?
So look, I think that Donald Trump has been well behaved over the last few days. If you sort of take it at face value and compare it versus what some investors may have been fearing a week ago, but at the same time, I think it'd be foolhardy to extrapolate this too far. I think that we're going to see a president that is going to be synonymous with volatility. I think that sometimes what comes out of Trump's mouth can depend on what side of the bed that he's kind of waking up on. And so, although he's sounded more conciliatory around tariffs in the course of the last few days, or we haven't had any early delivery in terms of action, I think it would be pretty foolhardy and complacent to actually sort of jump to a narrative here that you're not going to get anything coming down the pipe over the course of coming weeks, because this has been a very consistent theme coming from Trump and Trump's team, really in the whole sort of process leading up to the inauguration over the course of the past year.
You would say February the 1st for Canada and Mexico is the show and tell moment.
So I think it's an interesting moment. I mean, Trump called out this as a date in the White House, and so that's the end of next week, obviously. So we'd expect to see some news next week in terms of how he looks to proceed there. My own thinking would be that you probably would end up with something like an executive order giving some notification of tariff on Mexico and Canada, but maybe at a lower rate than 25, or with the date pushed well back a few months, and then being contingent on policy action coming out of Mexico City and Ottawa. So we'll wait and see how that evolves. But I think that the message with Trump is that there'll be days where and weeks in markets where we are trading the good side of Donald Trump, and then there'll be a week where we're trading the bad side of Donald Trump. I think that's the reality, and I think that markets can overreact, both in terms of being too complacent at times and too pessimistic at other times. But I think it'd be a bit churlish to think that the world's problems are suddenly fixed and this is going to be a bed of roses ahead of us in 2025. So if markets are strong, our sort of general template here has been, look, don't take too much risk at the minute, but be inclined to sell risk when markets are strong and look to buy into market weakness. That's the way you think you make money in 2025.
Well, let's just evolve that, because you have closed you've made it very clear, you've closed your short position on duration. My question to you is the bond market complacent? We've had this rally. I don't think it's a lot of people are fully on board with this rally in terms of positioning. So do you trust this rally that you've had in duration over the past couple of weeks?
Well, I think the thing you need to remember about the bond market is you've got cash rates at the Fed sitting around 4.3. You've got two-year rates sitting around 4.3. So for there to be a big catalyst towards lower yields here, you really need to believe in a Fed cutting cycle. Now, you do get a big Fed cutting cycle, of course, if there's a growth slowdown or recession. That would take rates a long way lower. It would also take risk in the other direction as well. My own way of looking at the US economy at the minute, it continues to have plenty of momentum. So that being the case, I'm not sure that you're going to see much of a move down in inflation. And you could see a situation where rates are kind of going sideways. So my template when it comes to the bond market is, if you're looking at the two-year part of the curve, if you end up with yields rallying all the way down to 4%, so that yields are well below cash, that's where you pick to go short. Similarly, if that two-year rate goes back up to 4.5%, this is where you want to look to get long. But at the moment, we're sitting in the middle of the range. So sit back, relax, chill out for a little bit, and wait for the opportunities to come your way.
chillax and relax. Let's talk about the JGB and the Japanese market. The hike was as expected. The rates are the highest since 2008. The yen rallied, gave some back. How do you look at this? Do you think that this is a hawkish hike, given the narrative around inflation that they've given to us?
Well, I think the way that we're looking at this is part of a sequence of hikes that we'll see in Japan, which represents a normalization of monetary policy in the country. The one thing that I would sort of say, though, is I feel that too many market participants have got into their mindset that Ueda is a super dovish central banker, partly because he's confused markets and disappointed on timing before. But as you see sort of balance of risks on inflation moving more to the upside, we do expect the BOJ to actually act in a more sort of hawkish fashion going forward. So we certainly are looking for a rate hike again in July to 75 basis points to 1% again next year. When you speak to the Bank of Japan about where they think neutral rates in Japan should be, yes, they've got a broad range, but in the middle of that broad range is actually cash rates around about 1.75% based on the dialogue that I've been having with BOJ members. So that means that today we're a long way from a neutral policy in Japan. There's further to go on Japanese rates. And I feel that investors maybe have overlooked this. It's been interesting speaking to other investors. It feels like people have stopped focusing on Japan because they've been sort of too in the thrall of Donald Trump. So I do think it's time to look a bit more closely at Japan again. I'd be bullish at Japanese stocks, still bearish on JGBs. But also, interestingly, I think this could be the moment where the yen starts to move stronger. The yen is very undervalued, and we've been looking for this closing of rate differentials to occur. And particularly when I look at the valuation of the yen against the euro or against the pound, this is a cross that I really
Mark,
like.
just before we go, because we're up against the clock, the bullet train has left on being long yen, but what kind of velocity is in that? What kind of move can you see? If you want to be long yen on the crosses, what scale of rally do you expect?
Yeah, so euro yen currently at 161. We see that going to 145 come the end of the year. I think the gains against sterling could be even larger. So this would be the conviction trade of the year for me when it comes to FX.
Mark, thank you very much. Mark Downey there of RBC Blue Bay, giving you his calls for 2025. Other stories trending on your Bloomberg terminal. This is what we got. Shares of Burberry surging after pickup in US demand raised investor hopes for the luxury market recovery. Retail sales fell 4%, but the drop was less than expected, with the analysts expecting 13% drop. Still, the label warned that the economic environment remains uncertain and that its transformation is at early stages. JP Morgan increased CEO Jamie Dimon's pay to $39 million in 2024, a year in which the bank beat its own record for the highest annual profit in history of American banking. A regulatory filing shows the board granted him $1.5 million salary and $37.5 million in performance-based incentive compensation. President Trump signed an executive order creating a working group of key agencies to advise on crypto policy at the White House, recognizing the industry's role in the U.S. innovation and economic development. It will submit a report to the president within approximately 6 months, recommending a regulatory framework. Coming up, President Trump softening his tone on tariffs against China.
China's already paying a lot of tariffs because of me. And when you add them up, I would say, they're paying a lot. They've paid hundreds of billions of dollars, so they've already started at a higher base.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
We have one very big power over China, and that's tariffs. And they don't want them, and I'd rather not have to use it, but it's a tremendous power over China.
President Trump shifting to softer tone on tariffs against China. It says he's threatening 10% levies as soon as February the 1st on his second day in office. Chinese assets getting a boost this morning on the back of the remarks. You can see stocks up 0.7%, and the Hang Seng up nearly 2%. Ros Matheson joins me, and the currency obviously reacting. Ground zero for reaction function, Ros, is in the currencies on anything to do with tariffs. Look, before he took office, 60% was the number on the table. Here we are. He really is talking about, I'd rather not have to use tariffs. Markets are optimistic. What's your take?
Well, it's interesting because he has gone back and forth a bit on China, but there does seem to be this bifurcation in a way going on where he's very, insistent on putting tariffs on countries like Canada and Mexico, very strong comments yesterday about Europe. But on China, he's taking more of a slow approach, if anything, and a bit of reluctance to come out very quickly with any kind of action against China. And that's perhaps he wants to take a wait and see approach when it comes to the relationship with Xi Jinping, the president of China. There's been a lot of conversations already between US officials in Trump's orbit. Chinese officials talk about deals on things like TikTok and so on. And also it's very clear that Donald Trump sees Xi Jinping perhaps as a way to lean on Vladimir Putin in Russia to get to the table on Ukraine. He wants Xi Jinping to use his economic leverage with Vladimir Putin because Donald Trump has promised to bring this war to a close pretty quickly, and now he needs to deliver. So there's all of those factors perhaps going on for Donald Trump, but equally he can and does change his mind pretty quickly. And if he thinks that the US is being held at a disadvantage when it comes to China, he's got China hawks in his inner orbit as well, including folks like Mark Rubio. He will act on China and he will put tariffs on China, but it's interesting to see that for now he's taking a slower, more gentle approach.
Well, he went straight, with a mallet towards oil prices and OPEC. OPEC didn't show me much love. Oil, if you look at the chart on oil, down 1.7%. He's made a big call on Saudi Arabia and on OPEC to deliver lower oil prices. How practical is that, or is it more jawboning at the start of more pressure? He's got form when it comes to pressure on OPEC.
He does indeed. He's been saying this for a long time, including in his first term in office, always wanting lower oil prices to benefit the US economy when it comes to things like inflation. So that's a familiar refrain for him. The question is, will OPEC, and particularly Saudi Arabia, which has that really big voice in the room on OPEC, respond? And they've been really, really reluctant when it comes to production to kind of walk back output cuts. And for Saudi Arabia, that's important for its own economy to have perhaps higher oil prices. So you've got Saudi interests here versus Donald Trump's interests and whether OPEC responds. And maybe does Saudi Arabia take the call that perhaps we could let a bit more oil go, perhaps let prices go down just a little bit, perhaps as a nod to Donald Trump? But do they fundamentally want significant weakness in oil prices? It doesn't seem so.
No, not at all. They've got Vision 2030 to pay for. It's been slow going on the cabinet picks at these hearings. We've got Rubio over the line, John Ratcliffe over the line at the CIA. What's on the slate for the weekend? Scott Bessent's critically important, isn't it? And it's assumed he'll fly through.
Well, that's right. There's only been a couple so far, so there's a lot in the hopper for the weekend and into next week. You mentioned Scott Bessent, but he's expected by everybody to get through, and that might come on the weekend if the Senate does decide to stick around. I mean, earlier, in fact, we'll have Pete Hegseth probably late this evening in the US. That will be very closely watched because you do have 2 Republican senators who've come out publicly and said they will oppose his confirmation at the Pentagon. But of course, you need 4. You need all Democrats to vote against a nomination and 4 Republicans. And so far, others don't seem to be coming out. But that one probably is obviously trickier than some of the others, given all the backdrop of concerns around his suitability for that role. So you've got Hegseth, you've got Bessent coming possibly this weekend. In the early part of next week, you've got Robert F. Kennedy Jr. on Health and Human Services. He'll have a tough time probably in terms of his views on vaccines. But again, not a lot of no one's really coming out and saying we will oppose his nomination. Tulsi Gabbard, equally for national intelligence, she will get grilled in her hearing, but you're not seeing, Republicans rush out to say they oppose, pretty much sensing the mood music there when it comes to Donald Trump. So it'll be interesting to see how Pete Hegseth goes, but Bessent, as you said, is expected to sail right through.
Maybe these nominations are not the hill for any of them to die on. Unity at the moment behind President Donald Trump. Ros Masterson, thank you very much.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Time for the front pages now. This is what making news headlines around the world. First up, Financial Times leads with President Trump putting pressure on the Fed to cut rates. The Fed has signaled a slower pace of rate cuts this year. Some officials concerned that Trump's plan will hinder their efforts to bring inflation back to 2%. He certainly didn't hide that during his conversation in the Oval Office yesterday. He knew rates a lot better than the person running the Fed. Next up, the Washington Post reports that the Trump administration moving to abolish a Pentagon office responsible for promoting civilian safety in battlefield operations. The Army has begun drafting a proposal to defund and potentially de-establish the Civilian Protection Center of Excellence. The move suggests that incoming Defense Department leaders may attempt to loosen restrictions on military operations worldwide. And Bloomberg, we lead with Boeing, suffering another quarter of losses after reporting its results. That was a surprise announcement. Sales came in at $15.2 billion less than the $16.76 billion that was expected by Wall Street. The company's defense business endured a $1.7 billion charge. Benny Camel has been tracking the story. Benny, this is a litter bin of charges and exceptionals. It's the second time Kelly Ottberg has done it. Why is he trying to clear the decks? Do we know anything more about the health of the business after this deck clearing?
Well, the health of the business is not great. I mean, that much can be said. The full earnings are due on Tuesday, very early in the morning in the US. And this was sort of a teaser. It gave us a sense of where things stand. We always knew that the fourth quarter would be difficult. Remember, they had that strike that really destroyed production pretty much throughout the entire quarter. So we knew that the numbers wouldn't be great. What people then noticed was that things weren't looking good, not only in the civil side, but also on the defense side. And that's what has people worried a bit. The stock dropped somewhat after the close yesterday. Had a dismal year last year, so that slide sort of continues. So he's gotten some of the bad news out of the way, but there'll be lots of questions on Tuesday. Just how does he see the path forward? How is he going to get this company out of its rut?
Just square it away for me. He raised $24 billion in capital in the run-up to this before Christmas. Does he need more capital?
Well, for the time being, he seems okay, but just imagine for a moment if he hadn't raised that capital, they would have run out of money at the end of the year. They had another cash burn of $3.5 billion in the fourth quarter. That's marginally better than what people expected, but still, it gives you a sense of just the cash burn rate. So they really needed that money to stay afloat, as it were. And they have that money now. That gives them that safety net to move forward. They've got about $24 billion in the bank. That's still there. So they can move forward. And they're also looking, that's a separate story that we've reported, they are looking at asset disposals. So they do have some room to maneuver, but make no mistake, it's not a lot.
No, there certainly isn't. Benny, thank you very much. Benedict Camel there on the very latest from Boeing. Quick snapshot of oil. Yesterday was a particularly important day. They're not showing us a great deal of love. That was the line that Donald Trump used when he was at Davos. He called on OPEC to help bring down the price of oil. He called on Saudi Arabia also to assist with that. Oil tanked by 1.7%. That's that drop that you saw there. Small reprieve this morning. Bring down the price of oil. Bring it down now. It is responsible for the war and an enduring war between Russia and Ukraine. So tying the politics of oil to the politics, obviously, of war. Coming up, embrace the current bond market. Embrace your inner bull. That's the view from JP Morgan's Kelsey Barrow.
what legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Manish Cranny. Let's set that agenda. Softening stance, President Trump says he'd rather not use tariffs against China. Global stocks rally to a record high and the dollar drops. Not done yet. The Bank of Japan raises rates and inflation estimates, boosting the yen. As the World Economic Forum wraps up in Davos, President Trump challenges the world to come to the table, negotiate, and deliver. Good morning. We did make a record high in the S&P 500. There are calls from Donald Trump for lower oil and lower rates. Stocks give a little bit back this morning. You've seen a flow, $7 billion into U.S. equities for the fourth week in a row, according to Bank of America. Roll it over to the bond market. As I say, Donald Trump, the President of the United States, calling for lower rates. He's prepared to talk to Jay Powell about that, calling for lower oil prices. We're down a tick there. By the way, the bond house, the vintage bond house, Hoisington, still bullish on bonds. They see slower inflation. Roll it over to the FX market. This is the ground zero reaction to the headline that Donald Trump would rather not use tariffs on China. It doesn't mean that he won't. It's just his current state of play in week one. You can see that the yuan strengthened, and likewise the Bank of Japan raised rates to the highest rate since 2008, and they called for higher inflation estimates. And the dollar dropped, and I love what Morgan Stanley say. There are some silent plurality out there to sell the dollar and buy the euro, buy the yen, the silent plurality. Who are they? Make themselves known. Maybe Kelsey Barrow knows who they are from JP Morgan. Brushing off concerns about the prospect of the Fed under-delivering rate cuts. This is what she writes. A resilient economy has led to another year of strong returns for income, with high-yield debt outperforming, and the U.S. aggregate bond index set for a fourth consecutive year. Kelsey is in the house. She joins me around the desk. Good morning. Good to see you.
Good morning.
So great channel my inner bull, and I can achieve that. Can I achieve that bullish return in bonds with a Fed that potentially remains on hold?
Yeah. So when we wrote that at the end of last year, we were doing we were looking back at the year, and the narrative throughout the year was how many cuts will the Fed deliver, and this consistent fear that the Fed would under-deliver on cuts. And I think that that is really missing the point of where we are in the broader cycle of the bond market. Yields are actually quite attractive here, and you don't need the Fed to be cutting rates aggressively to be able to collect carry and get a strong income, strong, steady stream of returns in a fixed income portfolio. So if you look at investment grade credit with yields of 5 to 6%, high yield around 7%, loans around 8%, those are yields that you can achieve with companies that have very strong balance sheets, that have been improving those balance sheets. And you don't need additional Fed rate cuts to collect that income.
So this is going to be a year of where I clip coupon rather than get a pickup?
That is probably most likely the case.
Two things for me happened this week. One, there's this narrative around gradualism. You just heard overnight President Trump saying he'd rather not put tariffs on China, but doesn't mean that he won't. And there was a very solid 20-year demand auction. There was an auction that went very, very well. For you, when you look at the bond market, which is sending you a more important signal? Because one of them is very variable and one of them is very factual.
Yeah, I think there's a few things that have stabilized the bond market in the last few weeks. It really started with the CPI report. That inflation data is what got us really off the brink. It felt like the move higher in yields was getting to levels that I think were a bit unsustainable. I was looking at the 30-year real yield above 2.5%. Approaching 2.6%, which is the highest yields for that instrument really since the inception of the product. So you're getting to these unsustainable levels. The first thing that got us to kind of reconvene was the inflation data. That inflation data, the CPI data, the translation of that data to PCE, which is the Fed's preferred metric, that was all very encouraging. Now, the second thing that came through was there was a lot of anticipation of day one activity from Trump. We certainly got a lot of executive orders, but in terms of their immediate impact on the macroeconomy, I think there was a sigh of relief there. And so those who had positioned very short-term, very tactically, those positions have been cleaned out. So from a positioning perspective, we got to very oversold levels, and some of that has unwound, and we've gotten to a place more of stability. This week has been fairly slow. Next week, luckily, things pick up. We have the Fed, we have the PCE inflation report, and we have ECI. So a lot to look forward to, and I think that this stability we've seen in yields around here, let's see how that holds when we start to get new fundamental data, because right now, all we're doing is speculating.
Yeah, and it's great for headlines, and it fills a conversation. One line that came from Larry Fink in Davos this week, which is the fountain of all conversation this week, is that it would be naive to think the biggest risk, he says, is to believe that we are past the high point in inflation. Now, that is critically important in terms of what kind of bonds you want, whether you want to actually pick up some tips. Tips had the highest yield since 2008 this week at an auction.
Yeah. So there's a couple things that I'm watching with inflation. So we still feel comfortable generally with the disinflation path. The thing that I'm watching is wages. So the wage data to me encompasses really what the Fed is most concerned about in terms of inflation. Because when it comes to tariffs, you know, that's something that's one out of their control. That's not really a demand-led inflation. And what the Fed is concerned about is cyclically oriented inflation. That's what ultimately is going to be sustainable. If you have a one-time price increase, but on the other side of that, you have demand drop off, you know, that's not necessarily the type of inflation that is sustainable. Whereas if there was a reacceleration in wage inflation, that's where you start to get the self-fulfilling type of inflation that the Fed is particularly concerned about. Now, what I'm seeing on the wage front is not yet any signs of a reacceleration in wages. I think actually they continue to moderate. So this is probably the biggest risk for the bond market. It's the thing that we need to be most vigilant about. But at the same time, as it stands today, I do think that we're generally in a 2 to 3% inflation world. It's not a below 2% world, but a 2 to 3% inflation world. And I'd be watching again that labor market and the wage data before I would start to get concerned that we're really seeing a reacceleration in inflation.
And it's interesting because you look at the recurring claims, the highest in 3 years at 1.9 million yesterday. Let's just round off with this. Katie Koch from TCW yesterday, she came up with a great line. Current account deficit here of 67% in the United States is tolerated as an economic miracle. But in France and the UK, it's seen as a financial crisis. The question is this a year when that privilege is challenged, when that privilege of the US bond market is really challenged?
It could happen, but I don't see it right now. So you just highlighted the very strong 20-year auction earlier this week. I mean, it's a sign that there is still fundamental support. There's tolerance. The U.S. is the reserve currency, and it's hard to see what is going to come up and replace that. So this may not be the year. But on the other side of the coin, the way I've been thinking about it is, you have the deficits and the Treasury, the U.S. government's fundamentals, they've been deteriorating. The deficit has been rising. That's not something that we've historically seen when the economy is operating at such a strong pace. But what it's done on the other side is actually allowed corporations and companies and people to deleverage their balance sheets and make them stronger. And as a bond investor that invests in corporate debt, invests in securitized credit that's linked to the health of the consumer and the consumer's balance sheet, this is actually a time where they have gotten themselves in a very good place. So you have, on one side, companies and people who are in very strong places in terms of their balance sheet. And you have the Treasury, which is not in a good place, but it's in a place that can be supported, at least for some time, because we are the reserve currency of the world.
And of course, we have Scott Bessent coming in as Treasury Secretary, and we have a whole new division called Doge, so the bond market is something else to lean into. Kelsey, thank you very much. Kelsey Barrow there of JP Morgan Asset Management on the bond market. Good morning from New York.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising chorus conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We have one very big power over China, and that's tariffs. And they don't want them, and I'd rather not have to use it, but it's a tremendous power over China.
Sound is power, in a beautiful word. President Trump had floated 60% tariff on China on the campaign trail. That was down to 10% when he returned to the White House, and now he says he'd rather not use that card. Meghan Crane is in Washington. It's an interesting shift, isn't it, Meghan, between his preparedness to go full throttle with Canada and Mexico, but his reticence to go sort of DEFCON 6 with China.
Yeah. Yeah, good morning. I think it reflects, the fact that China has some power in this conversation as well, probably certainly more than Canada and Mexico do, to the size and global influence, size of their economy. And Donald Trump is sort of running into that head first, right? He's talked a lot about tariffs against China and very hawkish on China, but when push comes to shove, he maybe wants to have a friendlier relationship.
Yeah, well, 10% tariffs would knock 1% off the Chinese growth, so that's a repercussion for the world. Now, look, Trump's cabinet, it's set for some controversial hearings over the next couple of days. We think Besant will be no problem at all, but Hegseth already has had a few dissenters. What's going to be most closely watched for you, Meghan?
Well, so the full Senate is set to vote on Hegseth today, and I will say that by the time they get there, through the get a hearing scheduled, go through that painful process, get a vote scheduled in the full Senate, they're almost positive to be confirmed. I'd be really surprised if he didn't get through today. The Democrats are sort of slow walking this process in order to slow down things on the back end for later nominees. So they need 30 hours between them. So Kristi Noem, for example, won't be voted on until Sunday. But I'm really looking more for the people who are coming up next week, the much more controversial, Hegseth was controversial, but other very controversial nominees who haven't even had those hearings yet.
Yesterday's presentation at Davos, it was a packed room. You couldn't get in there. But he really sort of went hard and heavy on oil and war with Putin, and he tied these two together very well. But he made demands for lower oil prices, more action from OPEC to bring down the price of oil. Do you think this is a starting point for his negotiation with Saudi and Putin?
I'd have to leave a lot of that to our colleagues who are more experts on the oil markets, but I think that, Donald Trump does do this sort of thing a lot, right? He'll put forward his most aggressive stand and work his way back. He comes from a business background, and that's how he does things. He certainly was laying a marker yesterday at Davos, and we'll sort of see what happens going forward, how much power he's able to exert.
Okay, Meghan, thank you so much there. Wrapping up the politics, it's going to be a busy weekend in Washington. That is Meghan Crane on the ground there. A little bit of breaking news for you from Novo Nordisk. This is what they're saying. The shares rise 8% after some trial results come through. This is on amycretin trial results. This is one of their obesity drug trials. The data that they've given to us is an early stage clinical trial showing that people treated with amycretin achieved an estimated body weight loss of 9.7% in 20 weeks, 16.2% in 28, and 22% in 36 weeks. So this is all about the battle for supremacy in the GLP-1. So on fire this morning on their obesity drug trial. Over in Austin, Tesla has launched a refreshed version of its best-selling Model Y here in the US and in Europe as its efforts to reverse the first annual sales decline in over a decade. The launch series, the version of the new vehicle, starts at under $60,000, and the deliveries are set to roll out in March. Craig Trudell is tracking the story. This is the first sort of shake-up in look and feel in Tesla that we've seen, and one of the biggest high-volume cars in 5 years. Is it enough to sate those calls for freshen up your outlook?
I think they absolutely needed to do this with the Model Y. As you say, this is a vehicle that's been out now for half a decade, and I think particularly on the exterior, that vehicle has started to look a little bit tired, and so this is something that every automaker does, and something that I think Musk has sort of bristled at the sort of conventional wisdom that you need to do this, and yet I think we've seen that sort of the rules of the laws of gravity in fact do apply to Tesla, that they can't necessarily get away with leaving the look of their vehicles untouched. as long as he might like. And so, this is an example of, some of the rules that apply to some of the other car makers applying as well to Tesla, that people want a new look vehicle, even if it's really just, sort of little tweaks here to the look of the cars that you're making.
It's maybe a touch of the Apple syndrome, nothing prophetically new here, just repainted. Look, they launched this refresh 2 weeks later in the US and Europe than they did in China. Any particular reason on the lag on East versus West? Is it to do with the demand cycle?
Yeah, I think we've seen this actually in the past. Tesla did something similar with the Model 3, and I think in that case it had more to do with the fact that the refresh Model 3 was going to be ready sooner in China, and so it was a pretty straightforward thing. In this case, I think it is interesting because the Model Y and it is going to come out in March, both in US, Europe, and in China. So it's not necessarily a case where, the Shanghai plant has a head start over the others. I think the simple answer might be that, it matters to consumers in China to sort of, feel, that little extra bit of sort of, being treated special, of getting a first look at what's new from Tesla. And it matters to Tesla to sort of signal to its consumers in China, especially given the fact that that is where, Elon Musk says himself, they're facing the most competition. It's the most cutthroat, and they really are having a hard time keeping up with BYD, as is the rest of the industry.
It also comes down to what do you believe the true valuation of Tesla is. It's either autonomous driving robo-taxis rather than a lick of new paint and a few tweaks on the car, isn't it? I mean, that's where the core valuation is. That's why Dan Ives has got their max valuation at 650. It is about robo, and it is about autonomous driving.
Yeah, and I do think that is something that we're going to hear, almost certainly next week when Tesla reports earnings, is, the sort of attempt to downplay and get people to pay less attention to this idea that, vehicle sales actually dropped last year. I do think Musk, kind of wants to have it both ways, where he does want to get people excited about this year and talk about, this potential for growth. And yet I don't know that we necessarily have the fresh, metal in the showrooms to deliver that. He wants to sort of, offer some cover in the event that he misses his numbers by saying it doesn't necessarily matter whether I'm growing my sales because we're going to make our cars self-driving and the rest of the industry can't.
He certainly does like to have it all ways, not just two ways. Craig, thank you very much. Craig Trudell there in Washington. We got more earnings rolling in. We got American Express set to report before the market opens. Charlie Wells is standing by. Charlie, what do we expect from Amex? Have they grown the base? Are you loyal to Amex? Good morning.
Good morning, Manus. So the pressure is on for this credit card company. Their shares reached a record price this week. They're up 75% from a year ago. And this is not just a credit card story. This is an Amex positive story. They have got a 53% premium on price to earnings compared to their peers. And a lot of that comes down to what we're expecting to see today, which is strength in fundamentals and consumer spending up. And not just any consumer. These are the ultra premium Amex consumers who are in a lot of ways insulated from some of those price pressures that a lot of the other credit card companies face, and they have seen a little bit of a slowdown in spending. Now, what else investors really like with Amex is that kind of subscription model that this company has. They've got these customers who are willing to shell out almost $700 in fees for credit cards. Amex brings in a bulk of their revenue from those fees, so the pressure certainly is on because that share price has been performing so well recently.
Well, there's certainly a long list of things that you get if you sign up for Amex Platinum here in the United States of America in terms of what you get, buybacks with Uber, etc. But if there is a premiumization to this card, what stands in the way of this share performance given this sort of premiumization of the product?
Man, so there is a lot of downside risk here, right? Because expectations are so high. And I think some of the concern here comes down to credit quality, right? So a long-term play, and this has been really interesting that Amex has been doing, is they have been marketing to Gen Z and millennial consumers in that higher income bracket. Now, of course, that in the long term could create these customers who are customers for life. That is something that Amex has been known for. But in the short term, they've got a little bit more credit risks from some of those more established consumers. We've also got the issue issue of competition to look out for with Amex, of course. Other credit card companies are well aware of that subscription model. I'm not going to name the name of my credit card, but I have seen them try to roll out some of these, more subscription-style features recently. And let's not forget consolidation in this industry, right? We have the news, from last year about that Capital One Discover tie-up, and that merger is rolling along. So the industry is certainly changing. It's paying attention. And of course, any misses today could significantly hurt that share price because expectations have been so high with Amex.
Charlie, thank you very much. Charlie Wells, let's see what the Amex numbers are. They will drop before the bell. I'll cover it during surveillance. Charlie Wells on the earnings. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
It's Bloomberg Brief. I'm Manish Cranny here in New York. A look ahead for you today. First up, as we've just been discussing, American Express, then First Citizens Bank. They'll report their earnings before the bell. We get to the U.S. PMIs at 9:45 Eastern Time, and then you have UMich sentiment and existing home sales coming through at 10 a.m. On the micro movers, this is what we've got for you. Texas Instruments extending their loss as the outlook points to ongoing weakness. Intuitive shares also down after profit margin forecast missed the estimates, and they warned on potential impact from new tariffs could be material. Now, Boeing, they came out with early report. They're talking about defense charges, hammering the fourth quarter earnings, and certainly missing estimates. But the story of the day goes to the yuan and the one line from Donald Trump with Hannity yesterday, which was tariffs. They're a very big power. I don't want to use them. I'd rather not put tariffs on China. That gives the yuan a bit of strength, but the question is, how long does that endure? Surveillance is ahead.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Having Donald Trump come into office is a very welcome change, and we hope that we will let market forces drive.
Generally speaking, he's looking to stimulate investment in the United States and really foster more innovation, more growth.
A lot of the Americans at the moment are actually saying, I only want to be in the U.S.
Every marginal dollar around the world is looking at the U.S. as a significant opportunity.
A very strong U.S. economy is a good thing for the world and the world economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning from New York City for audiences worldwide. This is Bloomberg Surveillance. I'm joined by Danny Berger today. I'm Amber Hordern and also Michael Purvis of Tal Backen. Joining us for the hour, John and Lisa are making their way back from Davos. I made my way back from Washington, D.C., where really all the policy uncertainty is emanating, but Donald Trump touching basically every part of global financial markets. Futures this morning are a little bit softer, but this, of course, comes after yesterday. S&P 500 hit a record high. First time U.S. stocks had its all-time high for the year. So first time we hit that record for 2025. Starting this morning, a little bit softer, taking a little bit a touch softer this morning on equity futures. This comes as Donald Trump seems to be taking a step back when it comes to tariffs and some of the tone he's striking. He seems to be in negotiating mode when it comes to tariffs, and persuasion mode when it comes to interest rates, jawboning the Federal Reserve and really global central banks that he wants lower interest rates. Danny, take your pick if you're an investor on what you wanted to hear out of the White House.
Oh, by the way, not just rates, but also oil too, telling Saudi and OPEC that he wants them and he will ask them to lower prices. Anne-Marie, if we had said 2 weeks ago, you would have had this sort of jawboning from Trump, and it would have been the first week of his presidency, we would have expected extreme volatility everywhere. We would have imagined that the bond market would have had a bigger reaction of him trying to jawbone the Fed. Instead, it's been calm. Yes, there's been some choppiness, but we've been trading in a range. I think Ian Lincoln of BMO really nailed this heading into this week, that markets saw the inauguration as an event risk, and we just needed to get past it, and once we get past it, we can kind of continue on this rally, and we did. We reached all-time highs, as you said.
And the dollar is lower. Around the world, currencies are taking, Michael, this breath of relief that he is really starting to tone down the rhetoric when it comes to tariffs.
Yeah, it's really interesting just to think that the Euro stocks is up a lot more year to date than the S&P 500, right? So I think there, certainly there's a lot of sort of classic Trump trades coming out of the election that worked for a little bit, and then they kind of U-turned and they're back to really stasis right now, or where they were just before. So yeah, I think it's going to be very interesting. One of the things that I'm really focused on is, okay, so he was softer on China yesterday. But he's never going to go completely clear and resolute, right? Because then he loses his negotiating
he's in
leverage.
Mode. And
right.
Here's the quote. We have one very big power over China, and that's tariffs. And they don't want them. And I'd rather not have to use it. But it's a tremendous power over China.
Right.
So he's full on negotiating mode.
Right, but he cannot lose that power, right? So will we ever have absolute clarity as to where he's going to be with tariffs? He always has to keep something back. And as we all know, Trump can, pivot very quickly. So I guess to my mind is how does that uncertainty principle, if you will, in a world where the economy, the markets want clarity, CEOs want clarity, right? How does that uncertainty principle filter into things like bonds and things like equity?
But this is the irony of it, is that there is so much uncertainty. And how often do we say markets hate uncertainty? But the market is concentrating on this big business growth environment we're going to be getting, on the animal spirits coming up. That seems to be the concentration. And do we get this kind of roundabout thing where because markets are lulled by the calm, it allows Trump to go harder on tariffs because markets are giving him the green light. They aren't sending yields higher and making him put the brakes on.
Absolutely. I think in these first few weeks of the Trump presidency, what I think we're going to be experiencing is Trump needs to test the boundaries of the markets. He can go here, he can go there, say this, that, but he needs to understand what the reaction function of the bond market is and the stock market is. The tricky thing is right now, we've got a great, let's say, we still had Biden as president, but there wasn't an election in November. It was just sort of more of what we had last year. Look, you're looking at a strong economy, looking at strong employment, you're looking at a pretty healthy consumer, you're looking at great, so far, really strong corporate earnings. So you have to take that away from the sort of the new animal spirits and dissect it. So, if those fundamentals change a lot, right? Just nothing to do with Trump policy. Just if they do get weaker, that's where we're going to have to see yet another way of where the reaction function is to the markets. It's a moving target.
Well, as he's testing those markets, let's take a look at where they're trading this morning. This Friday morning, happy Friday. It's been a week. So we do have S&P 500 futures a touch softer. This, of course, though, as yesterday, U.S. stocks hit its first all-time high of the year. And global stocks are really liking, when it comes to Trump testing the markets, they're really liking this idea of potentially signaling at the moment that tariffs are being used as a negotiating tool. Of course, the euro dollar, 104. One at one point was 105. We did get some better PMIs out of Europe, but really this is a dollar weaker story because of that tariff story. 10-year yield. Basically, what's happening with the 10-year yield is nothing. The U.S. bond market ending the first week of Trump's second presidency pretty much where it began, 4.62%, let's say 4.63%. And crude, something Danny talked about at the top of the program, Donald Trump drawing down the crude market. Oil is set for first weekly drop this year. He's telling OPEC, put more barrels on the market. Coming up this program, Margie Patel of Allspring Global Investments with stocks at fresh all-time highs. Terry Haynes of Pangea Policy as Trump softens his tone on China tariffs. And Steve Englander of Standard Chartered as the BOJ hikes interest rates. We begin this hour, though, with stocks at record highs after President Trump said he would rather not impose tariffs on China. Margie Patel of Allspring Global Investments writing, quote, Trump administration has announced many changes to regulations and new initiatives. It is too early to judge their effects on the economy and financial markets, but we believe many will reinforce the areas of the economy which we have expected strong growth. And Margie joins us now. Thank you so much for joining us this morning. I would love to just get your reaction to the past 24 hours and what surprised you the most about what we've heard from 47th President Donald Trump and the second administration seemingly touching every part of global financial markets?
Well, I think that's really coming out strong and stating a lot of his positions, and positions that, as you pointed out, maybe he doesn't expect to be achieved, but it's a good place to negotiate from. And I think the most important thing, frankly, is that the idea of higher taxes is totally off the board. That was a big risk to the market last year looking out into 2025. So I think that's the number one important thing is no increases in taxes and maybe even some lower taxes as well as lower regulation, which of course will be very positive for the markets.
Margie, you are describing a status quo of sorts, though, just an extension of the tax cuts. And Anne-Marie got to this when she was reading some of your thoughts. How do you disaggregate the strength that this market is pricing in and the continued strength of equities, just being a good business environment from a strong starting place versus actual policy? How dominant will politics actually be for risk assets?
Well, I hope not too strong. I hope that the changes that are made will, in fact, reinforce the areas of strong growth that we've seen. And I think this year is going to be another year of continuing trends where technology is very strong, data center investments is very strong, improving the electrical grid is very strong, and we'll see more investment in our domestic energy sector. So those were all in play last year, and I think they'll continue. And this will be another year of surprisingly good profits and a surprisingly good equity market.
There has been a shift, though, over the past month or so. Since about mid-December, Margie, what you've seen outperform, it's been energy, utilities, industrials, financials, cyclical parts of this market that are sensitive to growth. It is this extreme growth optimism that we're pricing in. Does that continue on, or do we have an event that makes us run back to the safety corners of the Mag 7?
Well, I don't think it's extreme optimism. I think when you look, basically, putting aside the politics and what we may get out of the new administration, is the U.S. economy is really in good shape. We're growing at a sustained level of, say 2.5%. And there are signs that growth may even be stronger, maybe closer to 3%. So that's really very, very positive, and that would allow the stock market to be up, say, 8, 10, 12% conservatively this year, maybe even higher. So I think the surprises might be continued growth and maybe even stronger than we're expected. Maybe that's what the market is really telegraphing, is continuation and further strengthening, particularly when we see these other areas that have broadened out a little bit.
Margie, one question for you. We're dealing with a very high valuation on the S&P 500, and through a lot of the sub indices there, it's about sort of top 2% valuations here. Do you see at multiple compression as sort of something that's going to happen, or do you think the market will, the earnings will be so explosive this year that it will actually bring the multiple down to more normalized levels that way?
Well, I don't think the market is, an average doesn't tell you the whole story. If you look, you have a relatively small number of stocks that have very high growth, earnings growth of, say, 20%. Those are the ones that are trading at big premiums for PE. And then a lot of the market that's actually having very low growth has a relatively more modest PE. So when you put it together, it looks optically a little higher. But I think the market is fairly priced. And I think that a lot of the uncertainty that we have has really gone out. There's a more positive outlook. I do think, though, last year we had a lot of our total return in the Standard & Poor's, which was up 25%, was due to expansion of the price earnings multiple. I think this year we'll probably see more companies whose earnings are high will get a higher stock price, and not that expansion in PE, just really look more dependent on the profit growth of companies.
Gotcha. So PEs are going to stay where they are, but are you bullish on the rotation away from big tech into the more cyclical parts right now?
Well, I think only those cyclical parts that are part of this more secular change in secular growth, which is, I think, the reshoring back to America is real and it's going to continue. I think the investment we need for data centers is a decade-long process, and also the electrical grid, which looked very stable for a long time, now suddenly looks as if we'll have growth in demand for power, and we need to strengthen the grid, expanding it. So that's a lot of additional revenue for the industrial sector, and technology is part of that. So we think those will continue. And then energy, domestic energy, it looks now as if there was sort of a cloud over that energy sector, I think is actually more positive. We may see more investment from the energy sector.
It's something Washington, D.C. is definitely focused on, whether it's AI data centers or just unleashing more when it comes to American energy. Margie Patel, thank you so much for your time this morning, of course, of Allspring Global Investments. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Morning, Anne-Marie. The Bank of Japan raised its policy rate to 0.5%, the highest level in 17 years. The decision fueled expectations for future rate hikes and strengthened the yen. The central bank warned inflation will move at a faster pace in the coming years compared to its previous forecast. And shares of Burberry surging after a pickup in U.S. demand raised investor hopes for a luxury market recovery. Retail sales fell 4%, but the drop was less than expected, with analysts expecting 13%. Still, the label warned that the economic environment remains uncertain and that the transformation is in its early stages. And JP Morgan Chase CEO Jamie Dimon got a pay bump in 2024. Dimon earned $39 million in salary and performance-based compensation, up 8.3% compared to the year before. In the same year, JP Morgan beat its own record for the highest annual profit in the history of American banking. And that's your Bloomberg Brief, Anne-Marie.
Shonali, he's not the only one, right? 39 million seems to be the magic number this year.
You have David Solomon as well, but David Solomon and John Waldron got those $80 million incentive packages on top of that 39 million, Anne-Marie.
Ooh, all right, banking's doing well. Up next in the program, a softer approach on tariffs.
We have one very big power over China, and that's tariffs. And they don't want them, and I'd rather not have to use it. But it's a tremendous power over China.
He'd rather not have to use them. That conversation coming up next. You're watching Bloomberg Surveillance.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Good morning. Happy Friday. Markets this morning, futures are a little bit softer, but of course yesterday we had U.S. stocks hitting their first all-time high for the year for 2025 and really around the world, just taking a sigh of relief after comments from President Donald Trump basically saying that he wouldn't really want to use tariffs. He could, but he doesn't really want to do that. And that's where we begin our political discussion this morning. Under surveillance, a softer approach on tariffs.
We have one very big power over China, and that's tariffs. And they don't want them, and I'd rather not have to use it. But it's a tremendous power over China. China's already paying a lot of tariffs because of me. And when you add them up, I would say, they're paying a lot. They've paid hundreds of billions of dollars, so they've already started at a higher base.
Here's the latest. President Trump revising his message on tariffs on China, saying he'd rather not have to use them. Trump previously, of course, threatening 10% tariffs as soon as February 1st. Terry Haynes of Pangea Policy writing, tariffs will happen for three reasons: economic unfairness to the United States, not producing products in the U.S., and or to help achieve U.S. geopolitical goals. Terry joins us now. So, Terry, is Tariff Man just in full-on negotiating man mode?
Good morning. I think my advice to markets has always been, look, this is never going to be all of one thing or all of the other. And the approach is going to vary by country and product for the three reasons that you've kindly put on the screen. So basically what Trump would like to do with regards to China might be very different than what he wants to do with, say, Canada or Mexico. With China, what this is about an outstretched hand saying, look, you deal with your proxies, you deal with Iran, you deal with Russia, you deal with the Mexican cartels coming across. We can reach deals and accommodations here. But if we don't do that, then, I've got some powers and some abilities to ramp up pain on you. So, this isn't an all one or all the other decision.
So help market participants, though, that are watching this and a little bit confused. The executive order talked about a review for April 1st, but then Trump talked about potentially enacting tariffs February 1st, which is next week. So how do you view the timeline of potentially what is going to be his tariff policy?
I'd encourage markets to look at both dates instead of just one. I think the question probably revolves around, tweaking existing tariffs, making sure that China understands sincerity of intent, with the idea that in a couple of months, what might happen is something larger and more systemic.
Terry, though, just the facts of this first week have just been so much more carrot than stick for China. I mean, we could go through all of them, giving TikTok a reprieve, saying it doesn't pose a national security threat, inviting a high-level Chinese official to the inauguration, threatening 10% tariffs instead of 60%. Why soften? What is the aim? Why go after this approach instead of doing the hardball negotiation that Trump said that he would do on day one?
I don't think it's been all carrot or all stick. I think it's been some of both. You can look at the Stargate AI announcement as a perfect example of that. Something that said to China, among other things, look, game on AI. I'm going to go big and I'm going to go hard, and I'm going to attract a ton of investment into America by doing that. Whether it be with and beyond Stargate, you even have the proposed Saudi investment. So I think there's a lot of sticks going on here as well, but the sticks are much more deeds rather than words.
Just on that investment, Terry, as you mentioned, both Saudi committing an investment or vocally saying so, as well as this AI Stargate venture. We saw in the first iteration of Trump similar announcements. However, the follow through didn't always come to fruition. And you had kind of some of these players learning that you could make announcements to placate Trump without going all the way through. Does that change in this iteration of Trump? Well, do you see a Trump administration that wants to enforce some of these spending commitments more forcefully?
I see an administration and a president that understands that he's got exactly 4 years and no more, and he wants to maximize his impact. So there's much greater focus this time out.
Are you reading the tea leaves here within the White House that Bessent is really emerging as a very strong and clear voice, and the more overt trade hawks are losing some position right now? And is this something that the markets can take comfort in, or is it going to be sort of an unstable condition?
Hi, Mike. Good morning. Couple of things. One, Anne-Marie always very kindly brings up that I came up early with this team of rivals concept when Bessent and Lutnick and others were brought in. I look at tariffs again as very much a country-specific, issue-specific, product-specific sort of thing, and I would not look at the early returns here as a sign of Bessent winning or losing. I think it very much depends on all of those things.
Gotcha. Okay.
Well, he hasn't even stepped foot in the door yet when it comes to Scott Bessent, right, Terry? He still needs to be confirmed. Potentially it's going to happen this weekend. Howard Lutnick over at Commerce has a hearing that he still needs to go through. So in that sense, is that also what's pulling Trump back from enacting these day one broad-based tariffs? He actually needs his team in place, and at the moment, they aren't.
Yeah, I think there's a little bit of that. At the same time, nominees can always advise informally, and I don't mean under the table in some secret way. I just mean that they can advise on where they think things should go without having the power to actually do anything about it or have any levers in their hands, because of course they're not confirmed, as you point out. But it is a little bit of a in development sort of thing when it comes to Trump's advisors generally, and that may be playing a little bit of a role here. But I do think that with regards to China, the main thing here is that Trump's putting out that he'd much rather negotiate out a lot of the large issues, geopolitical issues, and if China's willing to do that, he's willing to play. But at the same time, his patience is not going to be inexhaustible.
I want to also pivot to what's going on regards to the Fed. I'm sure Jay Powell was happy that the Fed is in a blackout period ahead of their meeting next week, because not only did President Trump go to Davos and say he wants lower interest rates and he thinks lower oil will be the means to that end, he then told reporters, I think I know it certainly much better than the one who's primarily in charge of making that decision. If I disagree, I will let it be known. Terry, is it too early for him to be jawboning the Fed? Is there concern about Fed independence?
Well, it's too early, not for President Trump, certainly. But Fed independence, I think, is not an issue here. It is not going to be an issue, and the fundamental reason why is that the Fed gets to make its decisions independently, so that's Fed independence. But the Fed is not a creature of the president. The Fed's power doesn't derive from the president; it derives from Congress, and so the president really doesn't have any ability to meddle in any of those things. Now, I'm well aware of sometimes in the past, whether it be President Truman or President Nixon, where that's in fact happened. I really don't think it's going to happen here. What's going to happen is that should Trump try to cross that line, Congress is going to slap back at him pretty hard, and Congress has shown the ability to resist Trump's blandishments on all kinds of things, including the pace of nominees so far, right? He wanted nominees in 2 months ago, and they should go immediately, and, we've just talked about many nominees that haven't even gotten confirmations yet.
Just to stick on the point of the Fed, Terry, perhaps it's not an issue for now, but should we look at this as a view into what happens when Chair Powell's tenure is up? That someone like a Chris Waller comes in, or someone is put in place that will be cutting rates, that will be more amenable to the jawboning coming from Donald Trump?
Well, I'd put it this way, Danny. The markets have proven to, I think, to me anyway, and the economists who buzz around the Fed, pretending to be experts on it, buzz around and say, oh yeah, there's going to be a big threat here when that happens. At the same time, I'd point out that Jay Powell very much disappointed the Biden administration. When he got reconfirmed, they thought they were getting a dove, and they thought they were getting more free money. Instead, what they got was Powell and the entire Fed becoming hawkish almost immediately and embarking on the policy path where we are now. So I would look for Governor Waller or whoever else ends up being there, continuing to exercise independence.
Terry, thank you so much for your time this morning. Terry Haynes of Pangea Policy. But of course, Danny, they had to embark on that because inflation was so high.
Exactly. And I have to say, sometimes the Fed is almost, this is a bit controversial, but a bit like a child. You tell them not to do something, and they're going to do it. So you tell them, I'm coming for your independence. They might push back even harder.
Child or punching bag?
Yeah.
We'll have to see. Coming up on the program, Trump also urging OPEC Plus to lower oil prices. You're watching Bloomberg Surveillance.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
Ready? Go.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning and happy Friday. Of course, this was the first full week, working week, for the newly elected president, and he is touching global markets around the world, whether or not it's from equities to currencies to the oil market. This morning, we do have global stocks, a little bit of a relief rally when it comes to global stocks. They're ending the week at record highs. We did have a record high yesterday in the U.S., but Danny, this morning, a bit softer when it comes to the futures.
A bit softer. Maybe there's something in this that the action this week has been an administration giving tariff policy that's not as bad as feared. But that being said, there's still enough unknowns in this market that entire interpretation of it could be rattled. Anne-Marie, you made this point. It's not April 1st that Trump has been talking about bringing tariffs onto trading partners. It's February 1st. That comes in a matter of weeks. We continue to have these event risks pop up with every time Trump kind of changes the goalposts or the timelines of what he wants to get done.
Right. It's next week. So they also need to get their personnel in place in order to potentially enact some of these policy changes. When it comes to the bond market, really no drama, as Jonathan would say, as him and Lisa make their way back from Davos, Switzerland. The 10-year yield, 4.63%, exactly where we started on Monday when Trump was inaugurated.
And that's also after Trump said the Fed needs to be cutting rates. I will demand they do so. Oil needs to be lower. The irony is you had a little bit of movement on the front end that came in. It was actually long end bonds where yields pushed higher, the exact opposite effect of what Trump would have wanted. It just goes to show, Anne-Marie, his jawboning cannot overcome the bond market vigilantes.
And when it comes to tariffs, the place that we saw the whipsaw back and forth over the course of the past week and really months, depending on what reports you were reading, is the currency market. Weaker dollar. Now, that's obviously playing out in the euro dollar, but also a weaker dollar when it comes to the yen. But that's also for a different reason.
Yeah, the Bank of Japan, and by the way, not that different of a reason, because they hiked this morning because U.S. politics allowed them to do so. This is so important for the Bank of Japan. The reporting was you had U.S. data in their hand, and that was calm enough. It wasn't a big surprise. Therefore, they could hike as long as we didn't get anything that was really volatile coming from the Trump administration. They wanted to wait until the inauguration to make this decision. It happened, but there are still fragilities there that might stop the BOJ on its tracks, much for the same reason that we could see fragility in this overall market, depending on what happens from U.S. policy.
Right, policy moving markets this morning. That's where we're going to start for Under Surveillance. President Trump telling Fox News he would prefer not to have to impose tariffs on China, still calling them a, quote, tremendous power over the country. This coming after he did threaten on his second day in office to put 10% tariffs on China as soon as February 1st. Peter Cheer of Academy Securities pointed out to this. It seems obvious to everyone now that this has become a negotiating ploy. He talks about it to rally his supporters, but is listening to those who caution about being too aggressive or too preemptive. Michael, is that what you think the market is? They're seeing this as a negotiating tool?
Certainly, yeah. They're looking at this as a pretty good setup right now. That any sort of real downside from the Trump campaign promises is really not going to materialize, and this is all, the art of the deal, and so forth. And so far, I think that's a pretty credible thing. And of course, there's a lot of good things that are coming out of the Trump agenda too, in terms of, the deregulatory push and so forth. So right now, I think things are really set up pretty well. I guess my question for risk assets like equities is, we're trading at 22.5 times earnings. Earnings are so far looking, pretty good. The economy is in, pretty good shape, but can we really sustain? Are we vulnerable to PE compression, particularly if the bond market does start selling off again, right? And I think that's going to be really, one of the big questions is, Trump might, demand interest rates lower, but he's not going to control the back end of the curve. And I think that's really where so much of this discussion is really going to go. It's, to my mind, is where's the Trump bond market put struck? And that's a discovery process that is inherently a volatile process, right? And I think that's sort of looming here. And when you're at more than 22 times earnings on the S&P 500, that just makes everything a little bit more fragile here. So, I think it's going to be an interesting winter. I think some of this, everything is good, nothing is really bad from the Trump agenda it's a little bit priced to perfection. And let's face it, what's been lifting the market up is really animal spirits right now, right?
Yeah, when everything is so good, does it mean we're more fragile? And I think that's what you're getting at, is that we are fragile to headlines, that things aren't bad. But coming back to Trump and tariffs, if it's a negotiating tactic, you have to be willing to proverbially shoot the hostage, right? You have to be willing to take the big steps and do that. And if it's an equity market that's not prepared for that, how bad does it look if he actually does impose something like 60% tariffs on China?
Yeah, exactly. And just to build on that, this is not like, okay, you're just, Trump, a real estate guy, buying a building, and once you own the building, you own it, right? This is an ongoing dialogue, ongoing relationship. I don't know what percent of consumer products in Walmart are made in China, right? But it's something where there's I call it Walmart inflationary risk, right? Where if the consumer goes into a store and has to pay a lot more for something that was made in China, whether it's their kid's bicycle or whatnot, it really is sort of a big thing. So there's this ongoing dance, but it's a dance filled with friction and tension. And what I don't know yet, and I don't know if anyone knows yet, is how does that frictional component of the Trump art of the deal gets priced into markets, whether it's the VIX, whether it's equities, whether it's the back end of the Treasury curve.
President Trump is also questioning Fed Chair Jay Powell's decision-making on interest rates and saying he'll speak with him about lowering rates at, quote, the right time.
I think I know interest rates much better than they do. And I think I know it certainly much better than the one who's primarily in charge of making that decision. But no, I'm guided by them very much. But if I disagree, I will let it be known.
Oh, shocking. If he disagrees, he's going to let the world know. You have to think Jay Powell is so excited that they're in a blackout period.
Oh, absolutely. And I'm sure he will get questions about this. And maybe we get another, one-word answer. Nope, not permissible under the law. But this is the thing. And Michael, we were talking about this in the break, that Powell, let's imagine a scenario where Powell listens to Trump and he says, Mr. President, you're right. He comes out and says, we are cutting. We heard you loud and clear. Interest rates are moving lower. You could still have a scenario where, in fact, policy gets tighter because the bond market does what it has been doing, and that is sending long end yields up higher. Perhaps he learns the lesson of the Clinton administration when it is the bond vigilantes that set policy, and the government and the Fed only have so much control.
Look, when the Fed started its cutting cycle in September with the 50 basis points, they were cutting. It was the first time the Fed had started cutting in with high yield spreads at the extraordinarily low levels that they were when financial conditions were as easy as they were. They were making history. They were cutting into low fours unemployment, right? And GDP that was around, trending towards 3% here. So now you're asking effectively, the Fed and the markets to sort of embrace this. Okay, we're going to run hot fiscal, and let's run that concurrently with hot monetary regime. That's a recipe for all sorts of inflationary risk down the road, and maybe not that far down the road, right? So if inflation, if Trump was elected to make inflation lower again, well, that may be a recipe to actually make it higher again, or at least to be perceived by the bond market. And if the, look, if what's going to happen to Trump's approval ratings if mortgage rates go from 7% up to 7.5% to 8%, because some of those things start playing out.
Right. This is going to be important to watch. But I do think inflation for them is going to be one of their North Stars in terms of something they're very sensitive of. Right. And in corporate news, Boeing delivering disappointing fourth quarter results, posting revenue that missed estimates, saying last year's strike affected the results. The plane maker also noting $1.7 billion in charges tied to programs in its defense business, and that stock is down more than 1% in pre-market. All right, now back to policy. President Trump vowing to push Saudi Arabia and other OPEC nations to lower the cost of oil. Nadia Martin-Wiggin of Svelland Capital saying this, quote, Trump would like to drive a wedge between Saudi Arabia and Russia, pushing the Saudis to increase production at the expense of Russia. Sell-side analysts seem to assume any boost in production from the Saudis would be very temporary, a few months, but what we see from OPEC is that they prefer to move slowly. Nadia joins us now. Thank you so much for joining us this morning. So when Trump comes out and makes these pronouncements, do you have an idea of what price he has in mind?
Yeah. First of all, he just wants the price lower. When we look on a historical level in terms of real prices, we're not even at such a high oil price. Even at $80, at $70, what it used to be. He wants gasoline prices lower for the consumer, and he wants oil prices just to be lower, at least than what the Biden administration had. On the flip side, he wants producers to keep producing, and especially American ones. And that's where we see him in a tough situation because U.S. production is not growing the way it has. There have been enormous efficiency gains, but still, results came out lower for the end of last year in terms of U.S. production than we had at Svelland Capital in our expectations. So at the margin, producers are not ramping up. Exxon is not ramping up the way they could, the Pioneer Resources, if there's 1 billion barrels of additional oil there. It's not coming.
Well, this is the thing, Nadia. What incentive could they possibly have? Because domestic producers are beholden to their shareholders. If they start putting out more energy into this market, prices will go down, and that's bad for Wall Street. To what degree does Wall Street just dictate this, and Trump really can't have that much of an impact?
This is when we look at the potential U.S. supply growth this year, we have it up to 400,000 barrels per day. Some forecasters have as little as 200,000 barrels per day year-on-year growth. If we have oil prices that are higher, say, above $90, which is very tricky for the Trump administration, then maybe we get another 150,000 barrels per day. But compared to the sanctions we're talking about and the 2.5 million barrels per day of spare capacity that OPEC can bring online, that is nothing. So it's really why he is correct in saying that he wants OPEC to produce more.
Nadia, it's Michael Purvis here. Just to react to Danny's point on protecting shareholder value, is there, with Trump comes less regulation and presumably some significant lower operating costs for U.S. producers. How much do you expect that to happen in a per barrel level? If the marginal cost of if oil's going to stay at 60, is it going to become 52 as that new sort of swing point as to where a producer might increase or not decrease production?
What we have to remember is, we hit record U.S. production under the Biden administration. So he hasn't been holding back the oil side. The biggest difference is about natural gas and flaring and things like that. That has been an additional cost. So that's where we see this small improvement coming forward. Now, according to the producers, their break-evens, they're fine at $60, $65 a barrel. Maybe it brings down the break-evens for some producers a little bit. And this is where, when you have support from natural gas prices, from Henry Hub, it means that you can have more support for the oil break-even because that associated gas in the shale patch actually makes money. If you add in the fact that, okay, maybe in some places you can actually flare under Trump 1.0, nothing was enforced in terms of, or minimal enforcement was happening on the flaring side, that can help at the margin. But when we're talking about the big numbers, it's not really there. As we saw yesterday in his Davos address, we had the CEO of Total asking about LNG and nat gas, not about oil.
Right, because the Europeans are also excited potentially maybe make a deal. They came out after Trump was elected, Ursula von der Leyen saying we can maybe buy some more LNG from the United States. I just want to end on potential supply constraints from places like Venezuela and Iran. What do you think the policy is going to be?
So far, Trump looks like he's going to be quite tough on Venezuela. That seems coming from Rubio. On Iran, he has managed to enforce sanctions in the past, but I think he wants the Saudis to play ball and make up for that. What we have to remember in 2018, when he sanctioned Iran, he then granted 6 months worth of waivers for a lot of countries, including Japan, that hadn't touched Iran. And what we saw is Q4 versus Q2 production jumped 2.5 million barrels per day from OPEC, including Saudi Arabia, Russia, and the US, those three across the board. And then we had a price collapse. And the Saudis are really going to be hesitant about bringing back oil in that kind of situation. So they want to see what is happening. And this is where, we think that the Saudis will think long term. And so that's the question, because Saudi Arabia and Russia are very close at OPEC now, but maybe they would like to displace Russia as a top 3 oil producer and take that away and into the rest of OPEC. But right now we have no signs of that happening.
Nadia, thank you so much for your time. Nadia Martin-Wiggin of Svelin Capital. Let's get you an update on other stories we're watching this morning. Here's your Bloomberg Brief with Shonali Bassett. Hey,
Shonali. A federal judge temporarily blocked President Trump's executive order restricting automatic U.S. citizenship at birth for children of immigrants who entered illegally or have temporary legal status. The judge called the order blatantly unconstitutional. The administration is facing at least 6 lawsuits over the birthright citizenship order. Apple and Google removed TikTok from their app stores since the app briefly went offline over the weekend. The move comes despite President Trump's pledge not to enforce a national security law that would punish U.S. partners of TikTok. Oracle has kept the app operational, raising concerns that the cloud company might have opened itself up to lawsuits and fines if the administration decides to retroactively enforce penalties. And President Trump signed an executive order to create a working group to advise on crypto policy. The order supports regulated dollar-backed stablecoins and seeks to prohibit central bank digital currencies. The group will submit a report to the president within 6 months to recommend a regulatory framework and legislative proposals, including potentially creating a crypto stockpile. That's your Bloomberg Brief, Emery.
Thanks so much, Shonali. Actually, it was the crypto ball this time last week that everyone in Washington, D.C. during the inauguration
Snoop Dogg was at it, right?
Snoop Dogg was there, and apparently everyone said it's the best ball.
I mean, I'm sorry, I don't care what it is. If Snoop Dogg's there, it's the best. It's the best ball.
A lot of people are very excited about that. All right, up next in the program, tariff worries.
Dollar yen is probably more a function of what's going on in the US than it is in Japan, really. So the question is, if people think Trump is going to be aggressive on tariffs, if people think that inflation is going to be high in the US, if people think that the Fed is going to be tough, then probably the dollar is going to stay strong against the yen.
That conversation coming up next. You're watching Bloomberg Surveillance.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look at back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of the regulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Markets around the world breathing a little bit of sigh of relief as President Donald Trump signaling his plan for tariffs. Right at the moment, tariff worries potentially not as big as they were before he came into office.
Japan is a lot more comfortable with the state of economic growth and concerned about inflation. The trend will definitely continue in terms of higher Japanese rates. Dollar-yen is probably more a function of what's going on in the US than it is in Japan, really. So the question is, if people think Trump is going to be aggressive on tariffs, if people think that inflation is going to be high in the US, if people think that the Fed is going to be tough, then probably the dollar is going to stay strong against the yen.
Here's the latest. Investors expecting further rate hikes and yen support from the BOJ after the central bank lifted its policy rate to the highest level since 2008 and raised inflation projections. The BOJ saying uncertainty around President Trump's tariff policies will weigh on foreign exchange. Steve Englander of StanChart joins us now. Steve, thank you so much for joining us. So this was pretty much baked in, but really depending on where U.S. policy goes, is that going to be the deciding factor for this BOJ?
Well, if you read and watch what the BOJ is saying, yesterday they lifted up their inflation forecast, talked about upside risk. I actually think that a lot of this is driven by what's happening in Japan. The timing, I think, is dictated by concerns over, is it going to be, full Trump or mini Trump in terms of the policy actions that he's taking and the disruption that he causes. But I think the big surprise yesterday, because a lot of people came into the meeting thinking that BOJ was going to hike and then say, we can afford to wait. They seem to have much more intensity about further hikes. We think that they'll hike twice more this year, going up to 1%.
And yet, it's a yen that's reaction has kind of disappeared from this market, Steve. Your interpretation seems to be one of a more hawkish UEDA and BOJ than perhaps this market was expecting. Are you surprised we're not seeing more strength at this moment from the yen?
Yeah, I'm actually doubly surprised because, it's not responding, obviously, to the sort of rate differential story at the short end. And in addition, in the past, it's actually been pretty well correlated with CNH. And the fact that the CNH has strengthened a lot and yen hasn't done much this week, I think remains a surprise. But I think if the market begins to think that the BOJ is serious about hiking, we'll see those rate differentials close. I mean, the rates gap between the UK and Switzerland is actually quite much wider than between the US and Japan. So I think that that story over time, I think, will evolve.
Steve, maybe we can add triply surprise to this, because this is the week of Trump's inauguration. Most asset classes have been trading in a range. The place that we've seen the most volatility has come from this currency market, whether it be dollar MEX, whether it be the Canadian loonie. That's where we've seen the action, even strength coming from the euro. What do you make of the fact that it's been FX this week, the asset class that's seen the most reactiveness to the things coming from the Trump administration?
Well, the way I see it, and if you look at what happened, say from the beginning of October when Trump presidential odds started going up till, say the middle of last week, dollar strengthened way ahead, way beyond what interest rate differentials were telling you it should strengthen. And we think a lot of that was risk premium. Markets were going into the inauguration thinking 60% tariffs on China, whatever, 10% to 25% on the U.S.'s friends in the world. And a lot of risk premium, I think, and the focus was the FX market because that was kind of ground zero for where all of this would play out. And so I think what we're seeing is an unwind of that. There's still a bit to go, but, euro could go up 1% and you could say it's risk premium. If it went up 3%, it would have to be something beyond that at this stage.
Steve, Michael Purvis here.
Hey, Michael.
This is maybe a slightly bizarre question, but do you think Trump can make Europe great again? And what I mean by that is if he goes aggressive on Europe, will it put the European countries, for example, Germany, in a place where they're going to be more fiscally expansive than they have been in the past, and maybe even put in some reforms into their economies there? Is that a scenario that we should be looking at?
It could be, but I worked at the OECD 30 years ago, and the same structural issues that are still existing in Europe existed then. It's a generation and a half ago. I do think you're right, and we think you're right, that there's a chance that, say, if we have a change in government, not to the AfD, of course, but to the center and a stronger centrist government, that they will sort of ease up on the debt situation, and they could do more fiscal expansion. If I had to bet on Europe changing policy, for whatever reason, they may change macro. They seem determined not to do the sorts of things that you and I would call structural, fundamental microstructural reforms.
Wow. Steve Englander, thank you so much for joining us this morning. Steve Englander, of course, a Standard Chartered. Michael Purvis, thank you for joining us this hour. It's a great point because also I see today France is calling for major reworking of European regulations.
Right, exactly.
They are seeing the writing on the wall when it comes to Trump 2.0.
And you've also had ECB members, if I can jump in, Villeroy and Casimir both bringing up Trump in the context of it should be a wake-up call for Europe. So policymakers are already talking about the point you're making, Michael.
Exactly.
He's pushing them up against the wall.
Right.
And they're going to have to react.
Right. And they may even compete against each other within Europe.
So just quickly, do you think now's the time then to invest in Europe?
Not yet. We got to watch it, but it could be an interesting upside surprise here.
Right. They're forcing them to basically get out of their own way, which is what I hear a lot from Trump administration officials. There's no growth in Europe. They need to figure it out themselves, or they're going to be the ones that get hurt the most when it comes to especially a trade war, because China's going to have nowhere else to go.
Right. Let's just add another voice to this. Christine Lagarde at Davos saying it wouldn't be pessimistic to say that Europe was in an existential moment. She talks about the deep reforms they need. We had the Draghi report. Maybe this is the thing that actually gets Europe to enact it, or maybe they just fight with each other.
All right, coming up the program, another hour of Bloomberg surveillance. Sarah Kunst of Clio Capital, Bloomberg's Tyler Kendall from Washington, Savi Sith of Raymond James, and Norman Rule of CSIS. You're watching Bloomberg surveillance on this Friday morning. U.S. stocks yesterday hitting an all-time high, the first record for 2025.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
The 10-year right now is giving all the right signals.
I think the market has digested where we are right now.
A lot of that optimism is priced into the markets.
People want to allocate to a little more risk, but importantly, they kind of want to get beyond the index level.
I'm a great believer in go and hunt where the others don't want to tread.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City for our audience worldwide, good morning. Good Friday morning. This is Bloomberg Surveillance. I'm alongside Danny Berger today. It's Anne-Marie Hordern. Sarah Hunt of Alpine Saxon Woods also joining us this hour. I'm back from Washington, D.C. John and Lisa are making their way back from the Swiss Alps, where everyone was talking about what was happening on the East Coast in Washington. Futures this morning are a bit softer, but yesterday, of course, the S&P 500 notched its first record high for 2025. So a little bit of a mixed picture right now, but this comes, Danny, as we are seeing the President of the United States in his first week of office pretty much touch, take your pick, what you want to trade, what you're invested in, pretty much touch every aspect of global financial markets.
You could say he tried to jawbone the bond market, talking about the Fed needs to cut rates. You could say he tried to jawbone, and I guess successfully, this oil market, saying that OPEC needs to lower prices. In all that, though, it's been a pretty calm market. I think of this thing that TD's Mark McCormick often says, that markets are serial monogamous. They can only concentrate on one thing at a time. And Anne-Marie, maybe the thing that they've decided to concentrate on is a softer tone when it comes to China. With Trump on Fox yesterday saying he'd rather not use tariffs, floating 10% instead of 60, giving TikTok more days, saying they're not a national security threat. Perhaps this is what the market is just concentrating on and hanging its hat on.
Tariff man seems to be in negotiating mode. Here's the quote on Fox News to Sean Hannity last night, part 2 of that sit down in the Oval Office. Quote, "We have one very big power over China, and that's tariffs, and they don't want them, and I'd rather not have to use it, but a tremendous power over China." As an individual in this marketplace, talking to people, is that giving the markets a little bit of certainty that this is a negotiating tool? We're not going to use just, broad-based blanket tariffs. What out of what Trump has been saying, whether it's briefing with the press, talking to the world's global elite at Davos, what has it been saying that you've taken on and said, okay, this is going to be good for us for 2025?
So I think that looking for certainty at this moment is probably not, you're not going to get a lot of it. I think
probably
that there was, I think there was a lot of relief that there wasn't this immediate, we're going to drop a bunch of tariffs on China. I think it was clear from the beginning that it was going to be a negotiating tool, but I think there was some concern that right out of the gate we would start with something that was a little bit more punishing. So I think that that's very helpful. I think the general feeling of we're going to be pro-business, we're going to be pro-this, it gives you a deregulatory push that makes people feel a little bit better about the prospects for growth. So I think overall that's the arching picture, but from a small thing, they're going to change around and they are going to continue to change around. And so that makes it difficult to pinpoint any one thing at the start.
I'm just convinced everyone on the East Coast has been too cold and their fingers have been frozen, so can't like push those buttons to trade things. No, but I mean, you're right. We haven't gotten anything concrete. There's a lot of uncertainty. Markets are supposed to hate uncertainty, but we are still at all-time highs. What happens, though, in a week's time, to the point you've been making, Anne-Marie, when it is February 1st, this new deadline that Trump has set himself for imposing some of these tariffs?
Right, because the EO says April 1st when it comes to actually reviewing some of these trade policies. But Sarah, to your point, I think what this administration is trying to project to the business community is revolution of common sense. That's how he started his speech to Davos, and he keeps talking about this golden age, and a lot of that has to do with a lot of deregulation. As Danny said, markets are still at an all-time high, although futures this morning just a touch softer. I will say, though, markets are really leaning into this idea that Trump is saying that he doesn't want to have to use those tariffs. And of course, that's been huge in the currency market. Euro dollar this morning, 104. That is massive for global currencies, not as good as the dollar. We know this is a president who would be maybe a little bit happier with a weaker dollar. 10-year yield, 4.63%, exactly where Trump came into power on Monday. We were ending the week. And crude, just under $75 a barrel. We do have crude set for the first weekly loss this week. Trump jawboning the Saudis and other members of OPEC. Coming up this hour, Sarah Kunst of Clio Capital with stocks at record highs, Savi Sith of Raymond James as airlines see mostly strong demand to start the year, and Norman Rule of CSIS as President Donald Trump continues to pressure Russia to end the Ukraine war. Let's begin this hour with stocks mix on track for a second full week of gains as Trump appears to soften his China tariff stance. Some investors breathing a sigh of relief around signs the president is open to trade negotiation. Joining us now is Sarah Kunst of Clio Capital. Sarah, thank you so much for joining us this morning. Is that what you take on from this first full working week we have of the new administration, that they're in negotiating mode and not full-on put-up-the-walls mode?
I think that with Trump, as long as there's money, there's negotiations to be had. And I think that, you know, he is a New York guy, and he has come up understanding that the best way to get things done, he thinks, is to come in with a really big threat. And then when you walk it back, you know, 60% tariffs makes 10 look okay and 5 even better. And then, you know, he probably hopes that China will offer a sweetener there. And we're seeing that with Saudi Arabia saying, hey, you know, we've got an extra $600 billion to give you. Don't look at us for tariffs. Move the oil price where we want it. And so I think that that's kind of a standard negotiating tactic. And I'm a little bit surprised that so much of the global community kind of blinked while playing chicken with that train. But it seems to be working out not as bad as people feared.
When it comes to things you're focused on, I know AI is one of them, and we did see Saudi Arabia talk about the fact that they want to invest a ton in the United States, $600 billion. Then Trump went to Davos and said, maybe make it $1 trillion. It'll sound nicer. A lot of that has to do with AI and data centers. And Trump said yesterday at Davos that he could sign the executive orders himself in terms to get the regulation approvals quicker to make these data centers. What's the new investment angle to something like AI that we've been talking about for years?
So I think that I have a really boring take on AI, which is give me a tech company that has been around at least 2 decades, doing foundational work in AI that's been public for years, and I'm interested. And so that's, you know, the NVIDIAs, the Taiwan Semiconductors, ARM. I think Intel is going to have an interesting arc here, even with the new CEO. Oracle certainly on the data center news, you know, as part of that. So I don't think when you're talking about multi-billions of dollar investments that that you're necessarily going to look at the earliest startups, although certainly there are a lot of really interesting early stage AI startups. I'm in names like Grok, which are doing some really interesting things around AI chips. But the reality is a lot of that trade for the near term is going to be in those legacy tech names who have been doing AI, who have been building these chips and building these semiconductors.
I love that you mentioned Intel, because right when you said that, Sarah, I thought even Intel, but yes, to your estimation, even Intel. There's been a lot of chatter, though, especially on the Twitter sphere, the X sphere, whatever it's called now, about DeepSeek, this new model that the Chinese have put out for everyone to use on AI. And that it's really advanced and that it looks really good. And China, by the way, TSMC right around the corner from them, the US was supposed to be this moat, that we had really advanced AI and that we were the leaders here, but we don't even have some of the production capacity. So Sarah, what becomes the US's moat in AI if it looks like China is rapidly advancing?
You know, I would say get your AI news from white papers from PhDs, not from Twitter. But, you know, the reality is that yes, there are really smart technologists in China. You know, we see with DeepMind, that's a UK-based company. And you know, now Mustafa, who's running AI for Microsoft, you know, that's a British immigrant who's moved to the US. And so we are not going to have a chokehold on every single talent, especially with the things like the H-1B visa fight. The US is not going to be the sole proprietor of smart people in AI, and that's fine. The question is, how do we make AI work for our economy? We know that often with tech, China and the US are very, very separate. And so great, let them have their developments. You know, we're doing similar things. And I think the real question is, how do you actually make it make money? Because you can build these data centers, you can pour a ton of money in, but until you're seeing it actually make a difference in sort of, hey, is it easier, you know, to file my taxes, or do I have to do less grunt work and bureaucracy day to day in my job? And you're really seeing gains there, you're sort of just throwing more money on the fire in this sort of arms race with the rest of the world that really benefits the Sam Altmans of the world, but less so kind of the average mom and pop retailer or consumer.
I promise, Sarah, I get more of my news sources than just X. Let me just set that record straight before anyone is worried. But on this point, it brings us back around to the Stargate announcement of this money being poured in with Oracle, OpenAI, SoftBank coming in. Oracle rallied decently on it. It's up 16% on the week. What do you understand as the ultimate goal, to the point that you are making? What does it actually accomplish, and what does it look like? Is it worth the excitement that's starting to be priced in?
You know, I think that a lot of these legacy tech names, they've had too little excitement priced in. When the world was focused on sort of social media, social networking, deeply consumer, you know, not as sort of tech-driven tech names, I think a lot of these names got overlooked. So I would look at the pricing and the price movement slightly different than what they're actually building and doing. If there's a commitment to AI, which there certainly seems to be globally, then you do need data centers. One thing I like, and it's a little bit different than what Oracle is doing, but one thing I like about all of this is we're bringing nuclear back online. We're looking more at energy, and that's something that's important in the U.S. You know, when you look at how cold everyone is and how high everyone's electric bills are going to be from this month, but it's also important in places like Europe, both for energy independence from places like Russia, but too, you know, you look at the prices in the UK, and so having if AI sort of spurs this revolution in clean energy and infrastructure, I think that is good. I think over time, AI will be really important and useful for us. I don't think we're there yet. And I do think that these companies need a new story to tell the street after the last couple years of everyone just being thrilled. I think there was one quarter where Papa John said the word AI like 30 times in their earnings calls and their stock went through the roof. That trick doesn't work as well anymore.
I agree with you, and I think it's really interesting that you mentioned the sort of use cases, because in the end, we have to be able to show that there's productivity, which is the big promise of AI. But I think getting back to the energy side, what's really interesting to me is that you can have this push about permitting data centers. You have to change the energy situation, because that's one of the biggest bottlenecks. And I think that that's someplace where we're starting to see some expansion. Is there an area that you're looking at within that sort of ancillary piece off of AI that you think is the most interesting?
You know, I think that there's going to be a lot of just sort of foundational sort of shift to energy things that we have sort of written off, right? We all heard about Chernobyl and said, okay, I guess that we don't want frogs with 20 heads. And it's like, okay, that was a long time ago. The technology has moved forward, and this is not something that needs to sort of curtail how we think about developing energy. So I'm interested in nuclear. I'm interested in bringing more renewables to the grid. And I also think things like hydro are going to be really interesting and important, and you see that as a big piece of where people are going globally with energy. So I think that it's an everything thing, and it's good for far beyond just AI, but we have to have that to be able to make AI development sustainable, both cost-wise and as a cost to society.
That is a big issue, I think, the cost problem. And I think that that's also someplace where building everything is very expensive. So if we start to think about what is potentially positive and what gets the market excited about what's going on right now is if you bring some regulatory issues back and you allow things to get built for less, because building nuclear is now insanely expensive. And I think that there is some place that has to change. And that's on a technology level where things can start to get better and we can start to use smaller reactors like they use in parts of Europe, as opposed to the sort of larger one-off areas that we're using now. What are the other sectors that you are fascinated by as we go through this, just as picking a brain from one stock picker to another? Kind of what else do you think is really interesting here as we start to see what this new administration brings?
So my inbox has been flooded. I'm a private company investor in venture. My inbox has been flooded with people who are buying and selling secondaries right now in private names. I haven't seen this level of it for years. And so I think that, you know, we don't know when that IPO window is going to open. You look at the filings and they haven't quite ramped up. I think people are waiting a little bit to let this administration settle in. But the reality is that the last SEC and FTC heads made it really hard for people to buy and sell companies to go public, and you have a huge backlog of that. And so while we haven't seen the Stripes of the world commit to any firm plans, we do see names like Klarna, you know, that have raised their hand and said we're going to go public soon. And I think that we are soon to see a dam break there. And that we're going to see just a ton of really interesting companies come to market, buy and be sold. And so right now that those secondary trades are you know, ramping up at a really crazy rate, which to me indicates that people expect that this year we're going to see a lot of filings.
It's a great point. On this program, the JetBlue CEO said it couldn't get any worse when it came to the FTC and basically the regulatory environment of wanting to get in and do deals, Sarah. Thank you so much for your time this morning. Sarah Kunst of Clio Capital. Danny, at one point she also mentioned, I'd love to pick up on, how much more is it going to cost to heat your homes because it is so cold? And I have literally the smallest violin for anything John and Lisa say about how tough Davos was, because it's actually colder right now on the East Coast than it is in Switzerland and the Alps.
I think you could maybe even argue that there was more snow in New Orleans and Texas than there were on the Swiss Alps too. I gotta say, I never understood why they did Davos in the winter anyway, because you want to run away to somewhere warm. I've gotten so many people saying, hey, we're doing a conference in Miami next week. Do you want to come? So for all the bosses that are listening, please let me go to conferences in Miami.
And given the fact that pretty much everyone was just talking about President Trump, I can only imagine at some point there might be a conference in Palm Beach, just a little bit north of Miami. All right, let's get you an update on stories elsewhere this morning we're watching. Here's Shonali Bassick with your Bloomberg Brief. Hey, Shonali.
To say it, guys, I will be in Miami this week. Leaving tomorrow morning. But for now, we are watching Verizon shares. They were higher in pre-market. They are now dropping about 2.3% after the communications giant's fourth quarter topped estimates. Verizon saw big gains in new mobile, phone, and broadband customers. They added over 500,000 monthly subscribers, and they did top expectations by about 70,000. Broadband was a bright spot, adding up over 400,000 net subscribers, nearly double the amount that analysts had predicted. Also watching Boeing because there's more trouble for the plane maker. They suffered more losses and charges in the preliminary fourth quarter revenue report. In a surprise announcement, the aerospace giant said its sales missed expectations. Last year's strikes had impacted results. Boeing is set to deliver its full earnings on Tuesday.
Tesla unveiled an update to its best-selling Model Y in the U.S. and Europe in an effort to revive sales. The redesign borrows elements from the Cybertruck, including full-width LED bars, and also featured improved aerodynamics and better soundproofing. The EV maker looking for a turnaround after reporting its first annual sales decline in over a decade. And that's your Bloomberg Brief.
Thanks so much, Sonali. Up next in the program, Trump versus the rest of the world.
My administration is acting with unprecedented speed to fix the disasters we've inherited from a totally inept group of people. My message to every business in the world is very simple. Come make your product in America.
Make your product in America, he says. You can get a 15% corporate tax rate. Not quite sure Congress is on board with that just yet. That conversation coming up next. You're watching Bloomberg Surveillance.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good Friday morning. Equity futures this morning a little bit softer, though we did have our first record high yesterday with the S&P 500. We're down just slightly. I will say global markets and global currencies are taking a huge relief off the fact that Trump is basically sending a signal when it comes to tariffs. At least at this moment, this can all change. That's the caveat, but at least at this moment, it looks like he wants to be more in the negotiating chair. Under surveillance this morning, Trump versus the rest of the world.
I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. I'm surprised they didn't do before the election. That didn't show a lot of love. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world. The EU treats us very, very unfairly, very badly. My administration is acting with unprecedented speed to fix the disasters we've inherited from a totally inept group of people. My message to every business in the world is very simple. Come make your product in America.
Trump with a wish list and a grievance list yesterday. Here's the latest. He's laying out his, quote, America First agenda in virtual remarks to world leaders at Davos. Today, he's set to visit North Carolina and California while his cabinet continues to take shape in Washington. To wrap this all up for us, Bloomberg's Tyler Kendall joins us now. Tyler, so basically Donald Trump leaving the White House for the first time he's in office for the second time around, and he's making a push domestically. What's in store for this trip?
Yeah, good morning, Anne-Marie. President Trump expected to take off in about 2 hours' time. First stop is to Asheville, North Carolina, where he'll tour damage from the hurricanes that hit that region late last year. Then he's heading to California to see the ongoing devastation from the wildfires there. The LA fires expected to be some of the costliest in U.S. history. The latest projections from AccuWeather putting economic loss anywhere between $52 and $57 billion. Now, President Trump has threatened to withhold federal aid from California if the state doesn't make some changes to its water policies, alleging that they could divert more water from the northern part of the state. California officials say that's not possible, nor is that the problem. But I was catching up with one Republican aide on Capitol Hill yesterday who said the general consensus is that supplemental disaster assistance ultimately will be passed, but this idea of conditioning it on either unspecified policy changes or even tying it to a vote on the debt limit, something that has been floated here in Washington, is going to prove politically difficult. Anne-Marie, House Democratic leader Hakeem Jeffries yesterday told reporters that any such provisions would be a non-starter for his party.
Speaking of political difficulties, Tyler, these nomination hearings have been running quite slow. The Democrats have been successful in trying to slow down the process. We have Hegseth moving on to the next step, surviving the procedural vote. But to what degree is it indicative, the slow pace that we're going at the moment, for the rest of Senate confirmation hearings?
Right, exactly, Danny. So we are expecting a final confirmation vote late tonight, potentially even into tomorrow for Pete Hegseth for Defense Secretary. You mentioned there he narrowly passed a procedural vote. We have to remember that in order for final confirmation, these nominees need a simple majority in Congress. Republicans have a 53-seat majority, which means that Hegseth, who lost 2 Republican votes yesterday, Senator Susan Collins and Lisa Murkowski, can really only afford to lose 1 more vote. That would even put it in dicey territory, leading to a tiebreaker and potentially Vice President J.D. Vance casting his first ballot in the chamber that way. But it is raising questions for next week as we start to get some of these firm confirmation dates for some of the more controversial nominees, including Tulsi Gabbard, Kash Patel, and RFK Jr.
What is the strategy of slowing things down? How does that help the Democrats right now versus allowing things to proceed, which they ultimately will because of the majority in the Senate? How does that play out, and what do they think that they're getting for that?
Right, exactly. So Senate Minority Leader Chuck Schumer has said that this needs to be the way forward for Democrats so that they can both make the point, but also kind of muck up the process. We know that President Trump has floated this idea of potentially doing recess appointments, something that Senate Majority Leader John Thune has indicated that he would like to avoid as he tries to take control of the chamber as the new leader. Now, Republicans have a lot on their agenda, but besides for trying to confirm these votes, they're trying to get through a reconciliation package to tackle some of Trump's bigger priorities, including immigration, energy, and also tax cuts bills. So this idea of just slowing down the chamber as a whole could pose larger problems to Republicans as they try to tackle their agenda.
Tyler, thank you so much for your time this morning. That's Bloomberg's Tyler Kendall looking out on basically what to expect this weekend. Trump hitting the road, domestic focus, but she ended there on reconciliation. And I was struck, Sarah, by what Trump said yesterday at Davos. If you make the products in the U.S., he repeated what he said downtown at the Economic Club of New York on the campaign trail, you'll get a 15% corporate tax rate. If not, you'll basically get punished. Do you start baking in a 15% corporate tax rate?
I think that's another one of those areas where this is a good start to say, hey, come and do this. We're going to give you a break. I don't know that he can do that without Congress. So I think that there's a lot of information that needs to come through there. But I think the idea of saying, come in here, it's almost like saying we're going to put the U.S. as a tax-free zone like you do in certain states. I think the idea is we would like to get more manufacturing back. We would like to get more things back here. And I don't know that those hard numbers are something you would ever bake in at this particular moment in time, but I think that ultimately you have to sort of see where that goes and whether or not that strategy is successful.
I guess the thing you can take solace, though, in, and this is something you've talked about a lot, Anne-Marie, is that the sequencing matters. And what we've gotten is a lot more chat on this idea of taxes, of the carrot, come in, we'll lower your taxes, versus tariffs. Again, him talking on Fox, saying he'd rather not use them. So in terms of what the priorities are and what importance are, even if we don't have taxes in hand at this moment, even if it requires Congress, it seems that the list of things that they want to get done, perhaps that comes above some of the tariff measures.
True, and it's a lot of spaghetti being thrown at the wall and seeing potentially what sticks and what Congress can get done. But it's a great point on the tariffs. Potentially, they know the sequencing. We have to get these tax cuts done before we can really put the walls up. Coming up in the program, we continue this conversation and more. Savi Sith of Raymond James as airlines see strong demand to the start of 2025. You're watching Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. Welcome to Bloomberg Surveillance. We are 2 hours away from the cash open. Equity futures this morning, as Jonathan Farrow would say, as he makes his way back from Davos, Switzerland. No drama here. Yesterday, though, S&P 500 futures notched its first record high for the year. There's a lot of policy coming out of Washington, D.C. that the market certainly likes, especially when it comes to traders clearly taking a sigh of relief, especially in places like Europe and Asia, when it comes to the signaling from the White House that right now, Donald Trump doesn't want to use tariffs. He will if he has to, but he doesn't want to go there. All right, let's get you some of the other individual morning movers this morning with Manus Cranny. Hey, Manus.
Anne-Marie, very good morning to you. Don't forget First Body popped in to see Boeing as well. It's the big take story this morning. But the numbers are so bad, they decided to pre-announce. This is Kelly Outberg going for a mini kitchen sink. They've done it once. This is a mini one. This is a graveyard of charges on commercial, on defense. Defense, $1.7 billion of a charge there. So they've still got $30 billion on cash. The stock's down 1.4%. The risk is this, you get cash burn. Yes, they raise capital, but is that enough? Is that going to see them through the year? What are they going to do with some of these defense contracts that are a bit weighty on them? Do they need to offload them? It's always good when the First Body pops in. Have a look at Texas Instruments. This company makes a mammoth amount of chips. 70% of their revenue comes from industrial equipment and vehicles. Yes, the top line was grand. It was $4 billion, $4.01 billion, way ahead of the street at 3.86. But it was about the guidance. They're going to make 94 to $1.16. Even if you take the middle of that point, it's still way below the estimate for the first quarter. So this is about a signals chip slump, which is enduring 9 straight quarters of a drop in sales. And they don't have the magic sprinkle sauce, that magical AI chip that can take them up to the heady levels of NVIDIA. I leave you with Novo. It's all about weight loss. This is the stock performance this morning. Their new drug is emicratan. Experimental, you take the shot. Over 36 weeks, if you take the maximum dose, you lose 22% weight loss. The placebo, I think I got the placebo, you gain 2%. Bloomberg Intelligence say, look, this reinvigorates the head-to-head challenge for the GLP-1s between themselves and Eli Lilly. And so it is really about sort of building the moat again around Ozempic for them at Eli Lilly.
Manus, I'm just going to say, thank God you got the placebo. That is something you do not need. Manus Cranny, thank you so much for wrapping up those individual movers this Friday morning. Under surveillance, President Trump reiterating, quote, massive tariffs on Russia and, quote, big sanctions if President Vladimir Putin doesn't end the Ukraine war. Trump also telling a crowd of world leaders and executives at Davos he's looking to partner with China to force a settlement. Interesting here. Trump is not backing down when it comes to Putin. He wants to meet him at the table, but he's saying the onus is now on you, Putin. And it seems that he wants to use China, which may be why the tariff story is so interesting this morning. He wants to use China to put that pressure, I'm sure not just on Putin, but also on Iran.
Right, because he can't come to China and say, we're slapping you with 60% tariffs, we're shutting down TikTok, and oh, by the way, can you help us and can you talk to Russia and give us a hand here? It is a different tone. not just on the China front. You were kind of getting at this, Anne-Marie. The fact that he's placing the onus on Russia. A campaigning Trump had said, I can stop this war on day one. And a lot of that rhetoric had surrounded Ukraine, maybe giving up more territory, maybe being more amenable to what Russia would have wanted from them. Instead, it's a different scenario. It's one where Trump is really looking at Russia to be the one that does something to end this war instead of Ukraine.
Well, I think it's one of those things where he flips the script a lot, right? So you start with this and then you go to that. And then that's what leaves people guessing. And that's the idea of, on the positive side, the idea is that you're negotiating and you're moving around so fast that people have to keep reacting to you. On the downside, it means that no one really knows what's going to happen and when that's going to happen and what it is. When you say I can fix X, how do I actually fix X, especially if I'm now flipping this? So I think it's just part of what we're dealing with and part of also the very beginning of this, which is, as you were alluding to earlier, a fire hose of information.
Fire hose of information when it's coming from Trump 2.0. This is now Trump White House. It's going to be 7-15 news cycles in a day. But the point you're making there is so important. Unpredictability when it comes to Trump foreign policy, and you've said this a lot, Danny, is a feature, not a bug. He does it on purpose. Also, we're watching this morning. Republican senators are still working to get Trump's cabinet picks confirmed. A vote is expected this evening on defense pick Pete Hegseth. And if lawmakers stick around through the weekend, Treasury pick Scott Bessent and Homeland Security pick Kristi Noem. Several other Trump nominees set for confirmation hearings or votes next week, including RFK Jr., Pam Bondi, Kash Patel, and Howard Lutnick. I think what's so important about this is that you see that for some of these, it's been easy. Senator Marco Rubio quickly became Secretary of State. Scott Bessent in the next few days will be confirmed. But until we get someone like Howard Lutnick, Jamieson Greer, all these individuals in place, how is he going to even enact his tariff policy?
Yeah, certainly. And maybe, again, February 1st looks like less of a realistic deadline, the one that he set on himself. Maybe it is April 1st because he needs those people in place. That's why I think also the confirmation hearing of people like Howard Lutnick are going to be really interesting because the narrative at this moment has been the adults are in the room. It is Scott Bessent that has the ear of the president. And that's why you don't see the most extreme of tariff policy coming down. What do we hear from Howard Lutnick in that confirmation hearing? Do we hear, as Terry Haynes has said, the team of rivals and maybe some different color that we could get from Trump come next week or even closer to April 1st that, again, it's not just, oh, the bark is worse than the bite, but actual some bite that he's going to have a new ear of once these people get confirmed?
Well, and I think that while they're waiting to get confirmed, they can certainly be talking, right? And that's sort of part of what's going on is, yes, those official confirmations haven't come, but it doesn't mean that they can't be talking and advising and doing whatever. And if you look at the February 1st, maybe that's now I've made some determinations and here's what I want, as opposed to here's what's going to happen. I don't know what the answer to that is, but I think that giving that a time frame also possibly pushes people to act faster. It's hard to tell because, again, the unpredictability is the base case.
You're right, though, Danny, to say that a lot of the onus is being put on Scott Bessent as really the adult in the room. Every conversation John and Lisa had, whether it was CEOs like Ted Pick, and they asked about Trump 2.0, immediately executives said, we feel really confident that Scott Bessent is going to be running the Treasury Department. Hopefully, potentially, he'll get confirmed this weekend, at least for market clarity. But when it comes to things like what Terry Haynes is talking about, these cast of rivals, how much is he going to potentially have to fight the Peter Navarros or the Howard Lutnicks when it comes to policy?
This thing, it works until it doesn't. The reason that we are saying that the adult is in the room is because what we've heard from Trump is different than a campaigning Trump, is different than a Trump on the campaign who said on day one he's going to take action, that he could slap tariffs on really quickly. The fact that that hasn't happened quickly, again, has been pointed to this, that it is Scott Bessent having the ear. So it works for these markets until it doesn't, and have we just lulled ourselves into a complacent state?
Also under surveillance this morning, Tesla. They're unveiling an updated version of its Model Y in the U.S. and Europe in a bid to boost sales. The EV maker earlier this month reporting its first annual sales decline in over a decade. So Elon Musk does a lot of business in China, but they're also making a lot of competition for him in other places.
I think this is so interesting that he's focusing efforts, I mean, why wouldn't you, on the U.S. and Europe, but does it show a shift to focus more on the U.S. and Europe than China, a place that he has the ear of policymakers? Look, we know he had a conversation with the vice president of China when he came for the inauguration, but he is in a scenario where help from policy from the Chinese will only get you so far. You have the BYDs of the world that are really eating Tesla's lunch. Even if you have the favor of China, even if you can get something like FSD more quickly into that market, doesn't matter when China is so advanced and more cheaply priced at this moment. So maybe you kind of have to concentrate on American and European markets.
Well, I think that one of the knocks on Tesla has been that they hadn't refreshed a lot of the models, especially in the US. And I think, I mean, yes, BYD is everywhere and their cars look beautiful and they're much less expensive.
And they're 10K.
So there's that aspect of it too. But I think that, to the extent that you need to refresh that, and you also had this massive first wave of adoption for people who really wanted an EV. And I think what the world is seeing right now is that absent both government help and or regulation, there is a limit to how many people want a pure EV as their only vehicle or as their first vehicle. And now you have to figure out how to make that more palatable. And this is where some of the hybrids and other things come in. Tesla's obviously not going to go down the road of hybrids, but to the extent that they have to now have something that's a little bit more exciting, because they came out first, it was very exciting. And then, other people start to get in there. And also you lose that first wave of first adopters.
Especially if they want to hit the sales target that they talked about in the fall, in the earnings call. Elon Musk said 20-30% more growth in Tesla vehicles this year. Well, it remains to be seen. All right, we're going to turn to airlines now. United and Delta both seeing better than expected demand to start the year, boosted by European travel and customer demand for premium options. American, however, still working to win back business customers as it struggles with high operating costs. Savi Saith of Raymond James writing, the common theme has been strong revenue trends to close out 2024, with these trends improving further into the first quarter of 2025. An uptick in corporate travel and industry capacity discipline appears to be driving this strength. All right, so let's get right to it. You have a lot of optimism going into this year when it comes to the airlines, but I want to start at the challenges of 2025, especially when it comes to things like the weather. How much has this hurt the main carriers?
Hey, yeah, Anne-Marie, it's definitely been a challenging start to the year, as you can see. And if you look at across the board, you're probably having about roughly 5% cancellations on average. That compares to about 1 to 2% cancellations in the fourth quarter, closer to 1%, and even 1% cancellations last year. Like, it's still early in the quarter, and we'll see how the rest of the quarter progresses. And the silver lining is it is January. Not a lot of travel happens. It's bad for those folks who get disrupted, but the airlines also have the ability to reaccommodate passengers more because the planes aren't as full. So a rough start to the year, and then you put the LA fires on top of that. But we'll see how the quarter progresses. It's still pretty early.
Well, Savi, apparently the good news is we're all getting on a plane to go to a conference in Miami for whatever reason.
Well, Shonali is.
Yeah, at least Shonali is. So that's one person for them, sadly. We all wish we were in that place too. But there was some confidence coming from these airlines, especially the ones that are international and have a really solid premium up offering. So what went wrong with American, Savi?
Yeah, if you look at American, their revenue guidance beat expectations just as much as you saw at United and Delta. So I think they're seeing the same strong revenue benefits that their competitors are seeing. Domestic, transatlantic, really strong, and premium doing really well for them as well. I think with American, it was a little bit on the cost side where the miss came in. We were all expecting costs to be a little bit higher. It was just a lot more concentrated. The year-over-year pressure was a lot more concentrated on the first quarter. If you look out to the full year, it's a lot closer to expectations. So I think with American, it was a little bit more timing, but the top line still very encouraging.
If I think about the cycle and the problems that the OEs have had, both Airbus and Boeing, on delivering planes, because of a variety of different issues, what is the point at which that stops and you start to see that capacity come in? Because I can imagine some of the costs may be maintenance costs, because we are running planes that are older because we're having trouble refilling that. What happens both to pricing and to capacity when that bottleneck starts to ease?
Yeah, you're right. The maintenance costs have been a burden, and not just maintenance costs, but the uncertainty around the timing of when your aircraft will return. The time it takes for maintenance taking a lot longer than it has in the past. But what I would say that the biggest pressure for airlines is labor costs. So, even if you see OEMs catching up and deliveries starting to come online, I think you're going to see good capacity discipline in the U.S. because at the end of the day, all these airlines need to pass through their higher labor costs, and that's what we're seeing here today. It's just a supply environment being rejigged to be able to support fares that cover their costs, and we've seen significant labor cost increases in the U.S.
When we had that pre-announcement from Boeing yesterday, Savi, we're still seeing the reaction in markets today, and you get this commentary that you got at their last earnings. that it's a kitchen sink moment. Finally, we expected it to be bad. They're just putting it all out there. How many of these can we have? At what point do we expect Boeing to actually start to turn around cash flow?
Yeah, it's a big task, and now I don't cover Boeing, so I don't have a view on when they might stop taking charges. But it's a big task on hand. I would say, talking to the airline management teams in the U.S. and Europe and Latin America, there's a lot of confidence in the new CEO and his ability to turn things around, but it does take time. So this does feel like, we're maybe the low point, but how quickly we get off the bottom is more the question that everybody has, and I don't think we have a clear answer yet.
Savi, how much is the currency market dictating where people are going and they're traveling to?
It's definitely benefiting transatlantic travel. You saw that much of last year, or even, some Pacific, like Japan has been a very popular destination, and I think the U.S. dollar has been a big driver of that. So the U.S. dollar remaining strong is a good thing for airlines with long-haul international travel and supportive of some of these kind of strong margins that we've seen in the regions.
Totally. Europe looks so cheap this summer. I think a lot of people are getting excited about that. Savi Sith of Raymond James, thank you for your time this Friday morning. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Bassick. Hey, Shonali.
Hey, Anne-Marie. We're looking at American Express. It posted a 12% increase in profits for the fourth quarter. Consumers spent more than analysts expected over the holidays, with transaction volumes on credit cards and other products issued by the firm rising by 8%. Meanwhile, fourth quarter net income came in at $2.17 billion, which was slightly missing estimates. The company expects full-year revenue to grow between 8 and 10%. Also watching shares of Novo Nordisk rising in European trading after the pharma company reporting strong results for its weight loss injection. Its new experimental shot delivered as much as 22% weight loss in an early-stage trial, boosting investors' hopes for the drug maker's pipeline. The shot combines two mechanisms for weight loss in a single molecule, unlike its previous treatment, Carisigma. Novo is also studying a pill version of the compound for future release. And Kendrick Lamar will have company during this year's Super Bowl halftime show. The Pulitzer Prize-winning rapper revealed that singer and frequent collaborator SZA will join him during his Super Bowl performance. While this will mark SZA's first appearance during the halftime show, Lamar first made his Super Bowl debut in 2022, you may remember, alongside Mary J. Blige, your favorite Danny, Snoop Dogg, Dr. Dre, Eminem, and 50 Cent. That's your Bloomberg Brief.
I'm still amazed that Kendrick Lamar won the Pulitzer Prize, but I'm pretty sure that year the Grammys didn't give him the best album. They gave him the best rap album, but they didn't give him the best album. I've seen Kendrick Lamar in person. I'm also a fan of SZA. Shonali, we need to educate you on some of the hip-hop out there. But this is going to be an exciting halftime performance.
It just is unfortunate for Drake. I just think about this. Drake has lost the battle. It is Kendrick Lamar reigning supreme everywhere, and I'm excited for this halftime.
First rapper, first non-classical or jazz artist to ever be awarded a Pulitzer Prize? Yeah, I think he won. All right, less of that, more of this. Up next, investing in America.
It's also reported today in the papers that Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion.
Ooh, $1 trillion, maybe, coming from Riyadh. That's next. You're watching Bloomberg Surveillance.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Under surveillance this morning, investing in America.
It's also reported today in the papers that Saudi Arabia will be investing at least $600 billion in America, but I'll be asking the Crown Prince, who's a fantastic guy, to round it out to around $1 trillion. I think they'll do that because we've been very good to them. My message to every business in the world is very simple. Come make your product in America, and we will give you among the lowest taxes of any nation on earth.
Here's the latest. President Trump telling world leaders in Davos he will push for a bigger U.S. investment from Saudi Arabia. The kingdom's state-run news agency saying Crown Prince Mohammed bin Salman made a $600 billion pledge to Trump on Wednesday. Former senior U.S. intelligence official Norman Rule calling the pledge, quote, powerful evidence that Riyadh believes the U.S. will remain its foundational security and economic partner for decades. Norm, thank you so much for joining us this morning. He's also part of CSIS. When it comes to the Saudis investing this amount of money into the United States, and now Trump upping the ante and saying, maybe we can get to $1 trillion, like the way that sounds better. At the end of the day, is just as Riyadh choosing Washington over Beijing?
Good morning. In part, this is Riyadh choosing Washington over the world, but this is also Riyadh choosing the American high-tech sector over the world. Saudi Arabia's drivers are the success of the Vision 2030 transformation of its society as well as its economy. It believes that artificial intelligence will accelerate that process, provide jobs for a rising generation, transform the kingdom's industries, and all of that goodness, all of that power will come from a long-term relationship with the United States.
It's not the only place that Trump made headlines when it comes to Saudi, Norm. He also said that he would ask Saudi to lower the price of oil. Is that relationship strong enough? Is what Saudi gets out of the U.S. when it comes to economic security, some of the things you're talking about, enough of an incentive for them to act in a way that might be against some of their economic benefit?
Well, it becomes more complicated. First, this is an OPEC Plus decision. There are some OPEC Plus members that might be willing to produce more, but some are at capacity. So this really just leaves Saudi Arabia, the Emirates, and Kuwait. But there's a bit of a tension here. The lower oil prices become, the less revenue Saudi will have to invest not only in its Vision 2030 domestic plans, but within the United States itself. So I think you're looking at oil prices that once they would say reach the $60s, really cutting into the amount of money that Saudi Arabia would have to put it to meet its investment promises to the Trump administration.
That's one of the contradictions of asking for more production if you think it's going to lower prices, because in the end, what you end up doing is saying, okay, where's that volume versus price argument? And so I think that they probably have the most spare capacity, but you could also envision that there might be a small give back on production because they are holding some back as opposed to a major give back on production. Do you have any thought about how that actually plays out in the real world as opposed to just a request?
Sure. The kingdom has two primary goals: market stability and maintaining a capacity to be a swing producer, driver to prevent any sudden shifts within the market. That will drive a relationship with Russia because they have a capacity to impact the market. But the kingdom actually has less control over what happens in the United States in terms of its market. So we're sort of reaching the end or the high point of what fracking can do. The kingdom can produce probably another 1 million or 2 million barrels on the market. The Emirates could do the same thing, and I think some from Kuwait. But I think in the end, stability in the market is going to be the driver that shapes where OPEC Plus goes.
Norm, when it comes to the three big adversaries of the United States, China, Russia, and Iran, we've seen President Trump in his first week really focus in on Russia and putting the onus on Putin to get to the table. What's the strategy when it comes to ending this war?
Well, I think the strategy is clear. First, he has assigned General Keith Kellogg, a very experienced national security official, to work this, and General Kellogg's work is continuing, but it is low profile. Second, he has gone to the Ukrainians and has said, you know, you need a deal. But at the same time, just as Trump encourages NATO to increase its spending against Russia, he has encouraged Ukraine to enlist 18 to 25-year-olds in its army. So I think Ukraine, he believes, is ready for a deal, but Russia has yet to come to the table in a meaningful way. And that explains the president's comments on Russia's, the pressure he would bring on Russia's economy, which are real. I mean, Russia is spending a tremendous amount of money on this war. We're talking over 40% of its budget is now devoted to military issues. Its labor market is being squeezed to the limits. You're looking at a collapse of foreign investment. It's lost markets. I mean, this is really a tremendous blow to any of the world's economy. And I think the president's views of I will put more pressure on that economy is how he plans to bring this forward.
Norman, thank you so much for your time this morning. Norman Rule of CSIS and, of course, former senior U.S. intelligence official Sarah Hunt, thank you so much for joining us this hour. What struck me at the end there is Norm made another good point, which is he's also telling the Ukrainians they need to do more. And what did he say last night in that Sean Hannity interview? He said Zelensky is no angel.
Yeah, but Zelensky has changed his tone when it comes to the U.S., too, talking about making a deal. So I think he also kind of understands this new environment that he's dealing with, too.
Yeah, push-pull. The next 100 days is going to be fascinating. Coming up in the program, Jay Pulowski of TPW Advisory, Kathy Bostanchik of Nationwide, Ashok Bhatia of Neuberger Berman, and Libby Cantrell of PIMCO. You're watching Bloomberg Surveillance.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Having Donald Trump come into office is a very welcome change, and we hope that we will let market forces drive.
Generally speaking, he's looking to stimulate investment in the United States and really foster more innovation, more growth.
A lot of the Americans at the moment are actually saying, I only want to be in the U.S.
Every marginal dollar around the world is looking at the U.S. as a significant opportunity.
A very strong U.S. economy is a good thing for the world and the world economy.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City for audience worldwide, good morning. This is Bloomberg Surveillance alongside Danny Berger. I'm Anne-Marie Hordern, also Jay Plowski of TPW Advisory joining us this morning. As Jonathan would say, it's Friday, so we got to get you to the weekend. John and Lisa are making their way back from Davos. They'll be back with you Monday morning. Markets this morning really relatively smooth sailing. We did have a fresh record high yesterday, the first for 2025. So really a rebound for what many were saying a dreary start to the new year. Now we're back into the fresh record mode. And while Jay Pawlowski, I know, doesn't totally agree with you and I, Danny, we have heard nonstop policy proposals, darts being thrown when it comes to potentially what we could see out of this White House, and everything from jawing Jay Powell and interest rates to a realignment in trade and potentially a softer tone when it comes to those tariffs.
But again, maybe this is a market that is a serial monogamist and can only concentrate on one thing at a time. And the thing maybe it's decided to concentrate on is a softer tone when it comes to China. Or as Ian Lincoln of BMO put it, this week was all about event risk. It was about inauguration and the many executive orders that we could see coming from Donald Trump. And there was an expectation that we would get something extreme. We didn't get that, so maybe the market is just sighing relief that it's a calm week and we can continue on without the drama.
Jay, do you like what you hear coming out of the White House?
Frankly, we're not paying a whole lot of attention, right? Because the president...
You might be the only one.
Yeah, and it's working great. I mean, it's been a great start to the year for us. And so, look, the president says many different things at many different times. That's a fact of history. You know, the job honing of Powell, that brought me back like 6 or 7 years. I'm like, wait a second, I've heard this before. I know interest rates better than anyone. I mean, okay, some people can pay attention to that. That's not really of interest to us. What's of interest to us at TPW Advisory is the melding together of two of our main themes. The first is our global long cycle, right? A long cycle of economic growth. And the second is our tripolar world of competition between Europe, Asia, and the Americas in the three critical areas of AI, climate, and defense.
When it comes to that point, yesterday on China, Trump did say this: we have one very big power over China, and that's tariffs, and they don't want them, and I'd rather not have to use it, but it's tremendous power over China. Is that music to you and your firm's ears?
Well, look, the way we view the world is that this tripolar competition is in those three areas. China has led the way in climate with its industrial policy. It now dominates the climate space. The U.S. tried to respond under Biden with the CHIPS Act, Infrastructure Act, IRA. One of the new president's first moves was to cut the funding of the IRA and the Infrastructure Act. And so now we're looking for Europe to respond. And our view is that with the German elections coming up, Germany will respond because it has to. It's been stagnating for 2 years. We expect China in March at the NPC meeting to provide further stimulus because it has to, not because of Trump, not because of Trump, but because it faces deflation. And it understands, yes, as a corollary, it has a massive trade surplus, which does leave it open to tariff risk. But they have done a great job of diversifying their exports away from the United States. And we've read estimates that even with 60% tariffs, the impact on China would likely be roughly 1% of GDP. Okay, now 60% of tariffs not going to happen because that would send inflation through the roof and blow up the budget deficit and all the other things. So to us, the two things that matter are fiscal space. Who has the fiscal space to compete in AI, in climate, in defense, and who has the governance capacity to do so? The U.S. has neither in this administration. It doesn't have the fiscal space, 6% budget deficit, doesn't have the governance capacity, and therefore we are looking for a broadening out geographically of the global growth cycle. Germany stimulating, China stimulating, better global growth, commodities breaking out, super bullish for our thesis. And what we're looking for next, and this is where we may see it in the next week or two, non-U.S. equities break above their resistance levels and signal that the global bull market, global bull equity market is also broadening out.
Well, what is doing well right now are U.S. stocks. Yesterday, it had its first record for 2025, another record for the S&P 500, although futures this morning are relatively unchanged. The global bond market, well, the U.S. 10-year yield there, 4.64%, basically starting off the week ending the week where we started off. And then Jay Pawlowski there just talking about crude. We are higher on crude, even though the President of the United States is telling OPEC, add more barrels to the market. Coming up, Jay Pawlowski of TPW sticking with us. Global stocks on track to end the week at record highs. We'll get more of his thesis. Kathy Pashtanchik of Nationwide looking ahead to the first Fed decision of the year. And Libby Cantrell of PIMCO on President Donald Trump's economic agenda. We begin this hour with stocks. Mixed, major average on track to close out a second consecutive week higher. Some investors breathing a sigh of relief as President Trump seems to back off aggressive universal tariffs. Jay Pawlowski of TPW Advisory saying, we anticipate year 3 of bull market type U.S. equity returns. We believe much tariff risk has been priced in. We remain singularly focused on the dollar. Common wisdom holds that tariffs are USD bullish. We are not so sure. Jay joins us now. Not so sure. The one place that is, even if you're not listening, the one place that is listening to Trump loud and clear, though, is the currency market.
Yeah, and look, the dollar is key to us, right? If the dollar rolls over, that's bullish for the non-U.S. equity exposure that we are focused on for 2025. Our feeling is that, as we wrote, as you noted, that the U.S. is going to be single-digit type returns for this year. That's what typically happens in year 3. Bull market needs to rest, earnings growth, no room for multiple expansion. As we wrote in our monthly, the title was American Exceptionalism at Risk. There is no room for mistakes in the U.S. That's the main thing to take away. Where there is room is in the rest of the world. And so the dollar rolling over suggests to us that it is starting to think about, okay, where are there opportunities elsewhere? And if the policy mix gets better in Germany, Germany's done nothing for years. No one's invested there. If the policy mix improves in China and growth continues to pick up, no one's invested there. China is, quote unquote, uninvestable. But here's the fact, and this is a fact. This is not just discussion, a fact. FXI, the large cap China ETF, has massively outperformed the S&P over the last year. Massively outperformed, up 45% in the last year versus the S&P up 27. KWEB, the China Tech ETF, has outperformed the NASDAQ over the last year. Nobody talks about it. but it's reality. And so whether or not there are tariffs put on China and Mexico, and here's the thing, this is why we say you don't really listen to President Trump. He's talked about tariffs all over the last couple of weeks. Mexico is up over the last month. China is up. The dollar is down. What does that tell? We like to pay attention to the markets, right? We want to follow not just the news, but the reaction to the news. As you pointed out, Emery, you know, Trump is out there talking about asking people to, you know, produce more oil. What is the Brent doing? Brent is up on the day. It's not worried about that. It's brushing that off completely.
Jay, there's so much to unpack there, but I just got to ask, is it ignoring wholesale completely, or is it ignoring, but also have something in your back pocket if it's not just bark worse than bite, if there are actually big tariffs put in place? Or do you just discount that completely and say, I'm listening to the market, I'm looking at earnings, I'm looking at Europe being underpriced, and anything coming from the White House next 4 years, I don't need to pay attention to it all?
Well, I mean, earnings is key, right? That's very important. And earnings are going to be good. And our whole thesis is this global growth cycle provides the underpinning for the global equity bull market through the earnings channel. And now earnings and growth come from the spending in the competition amongst Europe, Asia, and Japan, and the Americas in AI, climate, and defense. So these things all feed together. They're huge. And therefore, that's what drives us. Now, again, if there's 60% tariffs on China, yes, China is going to be affected. But the points, 2 points. One, anybody worried about tariffs in China is not invested in China, period. And that's why it doesn't react to the news. And secondly, 60% tariffs would destroy the U.S. economy. And so it's not going to happen. President Trump knows he was elected in large part because people really were upset about the inflation. Okay, so he knows, and his advisors know, look, I'm a global macro guy. Scott Besson is a global macro guy. When was the last time we had one of our own as a Treasury Secretary? I don't think it's ever happened before. So, I mean, that's great. But they understand there's very little room to maneuver in the U.S. 6% budget deficits, interest rates at 5%, you know, the dollar at an all-time high. Our view is that U.S. assets have been the only place to be in the last 15 years. All the world's money is here. It's priced for exceptionalism. It's massively priced relative to the rest of the world. And therefore, we want to say, okay, you can have that. And we still have positions in the U.S., so don't get me wrong. We still have positions. But our focus for 2025, 2026 is that the U.S. led the way. Now the rest of the world is going to catch up. The rest of the world trades at 13 times forward earnings. The U.S. trades at 22 times forward earnings. Earnings outside the U.S. are expected to be as good or better than the U.S. in 2025 and 2026. Nothing is priced in terms of better economic activity, better policy making. They have the fiscal space. Germany and China, gross debt to GDP in the 60% range. The U.S., 120%.
It's this idea that Michael Purvis talked about, that Trump making Europe great again. And we've heard it from other people, that the bar is low. I go back to the conversations at Davos. You heard from Christine Lagarde saying it wouldn't be pessimistic to say that Europe is facing an existential threat. You heard from Villeroy of the ECB saying that Trump should be a wake-up call for Europe to push structural reform. Casimir saying that Europe's competitive problem will get even bigger with Trump's economic policy. How much of this is, Jay, the bar is low versus you actually need to see Europe come together and put in some structural reforms? I know you're talking about Germany and the things that they can do, but how much of this does it need to be a Europe whole project to really make this region attractive?
Well, that's why we talk about the tripolar world of regional competition. It's not Germany, it's not the U.S., it's not China, it's regional, because no country has its own thing. And here again, the president, in talking about America first, is going against the tide in a massive way. And that's his brand, and that's what he does, and it's worked for him, obviously. But no country has what it needs to be successful in today's day and age. It's regional. It's who are your friends. And Europe has a very good position, but it hasn't like used its weight fully, right? It hasn't made that move to say, okay, we're fully European. We need to joint spend. We need to joint tax. They did a little bit with climate. They're going to do a little bit more with defense, but they're not embracing it fully. And so so they are nowhere really in climate, right? Their auto companies are getting destroyed. Germany's vaunted auto industry is in shambles, okay? They're nowhere in AI, nowhere. And they are thinking about spending more on defense. But here's the thing. Well, what happens if there is peace in Ukraine? Is that reconstruction bullish for Europe? Is that bullish for the euro? Is that bullish for rates? I mean, it seems like it would be. So to us, it's really the competition is sharpening. It's existential. It's AI. You have got to have it. It's climate. You have got to mitigate it. And it's defense. You've got to be able to defend yourselves. And that is the world we're in. And who has the fiscal space and the governance to do it well? China is in the lead, okay? Just look at AI, right? All the talk about AI in the U.S., China's just launched its large language model, DeepSeek, right? As good, according to independent experts, pretty much as good as anything the U.S. has, done at a fraction of the price, a fraction of the price. And we have spent years trying to block China from the high level of the semiconductor space called SplinterNet. And that's why we are in K-Web, because we think, yes, the U.S. is walling off its tech space from China. China is doing the same and walling off China from the U.S. Look at Apple. Perfect example.
Perfect. So we're going to talk about Apple in the next block. So
okay, well, real quick, Apple's market share in China is declining rapidly.
It is.
Okay, and therefore they are suffering, and their stock is suffering. China is going to compete. Asia is competing. Asia is integrating. China now exports more to Southeast Asia than it does to the U.S. It's in a better shape than it was 4 or 5 years ago to deal with President Trump. And President Trump, I think, probably understands that. But for us, again, global growth cycle, we're in year 2 or 3. We think it can go another 2 or 3 years. Global equity bull market, we're in year 2. We think it can go another 2 or 3 years. The key is the U.S. has been the lead. Now the rest of the world is catching up. We want to play in that catch-up, that laggard opportunity space. We like emerging markets. We think emerging markets are going to do very well. We think China is going to lead there. No one's invested there. 12 times earnings. The opportunities, I think, are really significant. And as I said, commodities breaking out is a real key to us. It's telling us that the global economy is going to be fine. And when these non-U.S. stocks break out, everybody's going to be a food fight. And we're already there.
All right, Jay, you're sticking with us for the rest of the hour. Jay Plosky of TPW Advisors. We want to get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Bassick.
Thanks, Anne-Marie. Firefighters in Southern California are making progress battling new wildfires with much-needed rain now in the forecast. Up to an inch of rain is expected as early as Saturday, which may bring an end to the drought conditions that have worsened in recent months. Still, several blazes remain burning across the state, with the Hughes fire sitting at 36% contained. The Palisades and Eaton fires are 75 and 95% contained, respectively. And more trouble for Boeing. The plane maker suffered more losses and charges in the preliminary fourth quarter revenue report. In a surprise announcement, the aerospace giant said its sales missed expectations as last year's strikes impacted results. Boeing is set to deliver its full earnings on Tuesday. And over in sports, Novak Djokovic shocked fans at the Australian Open after retiring from the tournament in his semifinal match against Alexander Zverev. Djokovic dropped the first set and had to leave the match due to a muscle tear in his left leg. Zverev moves on to face defending champion Jannik Sinner in the men's final. And over in the women's tournament, American Madison Keys shocked her #2 ranked opponent and moves on to the final, where she'll take on the world in #1 Arena Sabalenka. That's your Bloomberg Brief, Anne-Marie.
Thanks so much, Shonali. Up next in the program, the morning calls, plus Mandeep Singh on Bloomberg Intelligence as we look ahead to big tech earnings. That's next. You're watching Bloomberg Surveillance.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Good morning and welcome to Bloomberg Surveillance. Time for the morning calls. First up, Bernstein upgrading Netflix to outperform, citing its subscriber growth and rising operational leverage. Next up, we have TD Cowen raising its price target on Alaska Air to $110, seeing upside in its Hawaiian Airlines merger as synergies ramp up. And finally, Bank of America, they're getting in the news a lot lately, cutting its price target on Apple to $253, citing the weak macro environment and its staggered launch of Apple Intelligence. We want to stick with tech because investors will be bracing for big tech earnings next week. Meta, Microsoft, Tesla, and Apple all set to report. I agree with Jonathan on this. Bring the tech earnings up. You should have them the first week of the earnings period, especially NVIDIA, basically, at the very end. That's very annoying.
The bankers would be so sad for you to say that, Anne-Marie. Do they get a downgrade then?
Yeah, I don't know. It's just this is a little bit more interesting. And I also agree with John. I like that they come after the bell because you can read through what you want and then have your ideas and thoughts prepared instead of this fire hose in the morning. All right, enough of that. Mandeep, how's it going? Tell us, what are you most focused on when it comes to the big tech earnings?
Well, so there are two pockets here, and when I look at the setup, TSMC results were very strong for AI. Netflix results, price increases going through, really propping the top line. So Google and Meta really should do well in light of that. Google, because of their cloud acceleration we saw last quarter. I mean, Microsoft's the same thing. Inferencing revenue of $10 billion this quarter should be strong again. And all the signs are the cloud segment is what's accelerating. On the ad side, I think the TikTok uncertainty should benefit the likes of Meta more, as well as YouTube Shorts. So that's where I think the setup looks really strong. I mean, Microsoft, I think with all the drama that's going on, with Project Stargate and them not being piece of it, still they are very disciplined on CapEx. They've told us they're not going to go big on the CapEx side. And if they show a revenue acceleration on the cloud side, I think that should be a strong quarter for Microsoft as well.
What happens with Apple, though, Mandeep? There's just some extreme pessimism around this company over the past week and really so far over the past month or even more than that with shares down 11%. What is going on?
I mean, so there are a bunch of things, but I think the biggest factor is the tariff situation because they are the company that is most exposed to China tariffs, whether it's 10% universal tariff or some other number. They get half of their COGS are related to China. So any sort of, import on the tariffs will impact them. Clearly, not so much the likes of Google and Meta, although I would argue the tariffs will impact the data center build out as well. So there are all these dynamics. And look, Apple hasn't done much in terms of their own AI. They don't have their own large language model. So there are a lot of uncertainties on the software side when it comes to Apple, and that's what's playing on.
Mandeep, it's interesting what's going on in China. You talk about the tariffs, but Apple is losing market share rapidly in China to domestic producers as China starts to wall off its tech space from the U.S. companies, much as the U.S. has done to China.
Well, that's not a news story, though. So I would say, the whole thing came about last year as well, where they were losing some share in a quarter. Then the stock really ripped higher. So when it comes to Apple, what people have realized, it's very hard to move out of their ecosystem. You can delay the upgrade, but you're not going to come out of the Apple ecosystem. And yes, they're not signing up more people in China, but their install base is so sticky that it's very hard to argue that, Apple is losing share anywhere. And I would say the same holds true for China. I mean, their numbers have been steady. They haven't been growing as much as the other regions, but to my mind, it's more to do with the tariff uncertainty and the Apple Intelligence launch.
Well, I was just in Washington. Tim Cook was at the inauguration. Is he asking for a carve-out?
Also, I mean, the whole tariff situation is so uncertain. Like yesterday, there was news that there won't be any tariffs on China. So it's hard to really kind of pin your assumptions down how it's going to impact their COGS. But look, we know that the companies that manufacture their goods in China, and Apple is not the only one. I mean, a GM or even Tesla, they're exposed to tariffs as well. And like I said, the companies that are building the data centers, even those are exposed to some level, but Apple is the most exposed.
Yesterday at the World Economic Forum, Trump blasted the European Union in terms of their regulation on tech firms. Do you think these tech giants will have a friend in the White House when it comes to at least EU regulation in Europe?
I mean, I think if Trump plays tough, which he is, you know, with the regulators there, and he doesn't want the regulators to find these companies, it is a positive because that has been an ongoing problem, especially in the rollout of AI, because it involves using data for training. I mean, Meta has told the EU they won't even roll out their AI over there because they can't use the data. So clearly, I think it is a positive for big tech if he's acting tough.
Mandeep Singh of Bloomberg Intelligence, thank you so much for joining us. Danny, that's really Mark Zuckerberg's focus, isn't it? He mentioned this a lot on the Joe Rogan podcast.
Well, right, because you even see what they've done with their fact checkers. They got rid of them in the US, but notably, they've had to keep them in Europe, and that's because of regulation out of Europe. It is an uneven sort of application that they've had to have around the world. So perhaps what's happening is that by becoming closer with the Trump administration, they have a champion in the White House that can turn to Europe. And to Trump's point, speaking at Davos, answering Steve Schwartzman's question, that Europe has been unfriendly and he's going to threaten economic consequences unless things change.
John and Lisa said it a few times when they were in Davos. U.S. innovates, China replicates, Europe regulates. I think we'll see a lot more of that this year. Coming up next on the program, Kathy Bostancic of Nationwide and Ashok Bhatia of Neuberger Berman. You're watching Bloomberg Surveillance this Friday morning. Good morning.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
TGIF, happy Friday. It's been a week, first full working week of a new president. Danny and I keep talking about the fact that we think he is kind of touching, or at least talking about, rhetoric is hitting basically every part of global financial markets. We saw that on display yesterday in Davos. Jay Pulaski doesn't quite agree with us, but we'll get more of that in a little bit. This morning, futures a little bit softer, but yesterday we did have U.S. stocks hit their first record high of 2025. We're now 1 hour away from the cash open. Here's your morning movers with Mr. Placebo, Manus Cranny.
Anne-Marie, a very good morning. We get to the placebo effect with Novo in just a moment. The numbers were so bad they pre-announced. Kelly Ortberg told the market, I'd lost $5.46. The market was thinking I was going to lose $1.55. But it's interesting, we've only dropped 1 1/8. Again, this is a second quasi-kitchen sinking by Kelly Ortberg. This is a graveyard of one-offs on commercial airline, defense part of the business, $1.7 billion. The magic sauce is next week on the call. What are you going to do? How are you going to turn it around? By the way, the Transport Secretary nominee, Sean Duffy, has given a written statement. I'm not taking the cap off the MAX 737 production until those people who are qualified, well qualified in FAA, have given me the confidence to do so. And until you release the cap on the 737 MAX, this narrative is going to be hard to change. As I say, it's a graveyard of one-offs. Dreams go to die. Texas Instruments. When you produce for the industrial base, for vehicles, for huge industry, and you don't have the secret sauce for the AI chips that you can really squeeze the margin on, that's the story of Texas. What you've got here is going to be a bumpy road into the first quarter. You're going to earn between 94 cents and $1.16. That's way below the estimate of $1.17. But you've had 9 straight quarters of sales dropping on these big industrial chips, and therein lies perhaps a red flag to the overall momentum in the economy. 70% of their revenue is industrial and vehicle chips. You need the secret sauce. You need the NVIDIA high revenue chips to deliver. Novo Nordisk, when it comes to GLP-1s, they've got a new drug and it's doing really well. It's experimental. It's called emicretin. Take the high dose, you lose 22% weight in 36 weeks. If you take the placebo, of course, I was joking that I got the placebo, you gain 2% over the same period of time. But this is about, as Bloomberg Intelligence says, reinvigorating the head-to-head, I suppose, challenge with Eli Lilly and Zepbound. It is about building that moat in GLP-1s. Never mind the tech moat in chips. It's all about GLP-1s. Anne-Marie, good morning.
Manus, thank you so much. Manus Cranny for us. Looking ahead to next week, the Fed's first rate decision of the year is coming on Wednesday. Kathy Pashtanchik of Nationwide writing, quote, unwavering consumer resilience reinforces the consensus that the Fed will hold off on policy changes in the near term. However, we still foresee the Fed resuming rate cuts in the second half of 2025, lowering the Fed funds rate by a total of 50 basis points this year. Kathy joins us now. Now, Kathy, I could be cute and say, is this because Donald Trump is telling the Fed to lower interest rates? Tell us what you see in the economy that you think the Fed is going to be able to resume those rate cuts.
Well, good morning, Anne-Marie. Happy to be with you. So we still see a very strong disinflationary impulse in prices, and particularly we've been encouraged that service inflation, which has been the stickiest, is actually showing some retreat in improvement, and particularly its rental inflation. And given that it comprises such a large share of overall inflation, we think that is really encouraging and does allow the Fed and gives them room to start to cut rates in the second half of the year. Now there are some caveats around that, and one reason we think the Fed is going to wait out the first half of the year is because of some of the uncertainty as was spoken about on tariffs. Where we've actually seen inflation stall out over the last couple of months has actually been in the goods portion of inflation. Core goods are still falling, but at a slower rate. And of course, if tariffs are implemented and they're sizable, that's going to hit goods prices notably. So I think the Fed Reserve wants to wait and see. I think it's not just tariffs or changes in immigration, but also just the strength of the economy as we go through the first half of the year. But by the second half of the year, if we're correct, it gives them room to start to cut rates.
If they're waiting until the second half of the year, Kathy, I want to go where Anne-Marie hinted at. A Donald Trump who said that he would demand lower rates. What happens? What happens when you have a Fed that essentially, as soon as President Trump is inaugurated, they put the rate cycle on pause, the rate cutting cycle, rather?
Well, certainly we'll heat up the rhetoric and the pressure on the Federal Reserve. But, Chairman Powell has been really steadfast in trying to maintain the Fed's independence, and I expect that to continue. There's no opportunities really for new chairmen in the next 6 months, or even Fed governors, frankly. So I think that the Fed is going to be pretty immune to that pressure, which will be ratcheted up. But one thing I think that the administration has to keep in mind is if the Fed cut rates and let's say inflation was picking up or the economy was strong, you could get an adverse effect. What we've actually seen is long-term yields rise. And that's really what matters for corporations and for things like mortgage rates. So, I think you have to be careful what you wish for from the Federal Reserve.
Kathy, it's Jay. Do you worry at all about tariffs leading to inflationary pressures that force the Fed to hike rates rather than cut rates? Do you have any sense of the odds of Fed rate hikes over the course of 2025?
Yeah, this is a good question, and I know it's gaining some attention here. My sense, or at least our assumption, is that the tariffs that are enacted will have a moderate impact on inflation, meaning that they're going to be strategically placed, and they're not going to be. Will have a price level change, but not necessarily inflationary, meaning it's not year after year prices are going up at a very high pace. To put that in perspective, if we had 25% tariffs levied against Canada, Mexico, which is not our baseline, and it may not come to fruition, even then you're getting 0.5% added to inflation. Now that's a lot, but it would push us a little bit above 3%. And I think the Fed would also look through that. Again, as long as it's not year after year increases, the Fed would say this is a price level. It's actually a tax on the consumer and the economy, but not necessarily inflationary. So they wouldn't raise rates because of that.
So perhaps we all need to take a page out of Jay's book and stop listening to the president to make our market trading decisions. Kathy, is the more important thing to listen then, and not just listen, but see the action and the consequences, is immigration? Because when you open up your Econ 101 textbook, you learn something that goes along the lines of wage price inflation is the one that you get that concern of an inflationary spiral. Is that the more concerning area then than tariffs?
I would say that, it's certainly the impact would be higher wages. If we have a dramatic change to immigration flows, yes. But if it is targeted to the undocumented workers, it tends to hurt sectors more than the overall economy. So it would really impact farming, agriculture, and construction. That's where the bulk of the undocumented workers are right now. But overall, I don't think it's going to have a huge pickup to wage growth. Even though we have a tight labor market, it's going to be really centralized. So not overly worried. Now, if we had a complete, stoppage of immigration inflow, which is very unlikely, then that would be a different story. But, that doesn't look to be the path we're headed towards.
Kathy, thank you so much for your time this morning. Kathy Bostanjic of Nationwide. Turning to fixed income now, Ashok Bhatia of Neuberger Berman making what he calls two bold calls. The first is that the new U.S. government delivers above-trend growth while containing inflation. The second is that the bond market consequently shifts focus from inflation and monetary policy to growth and fiscal policy. Ashok joins us now. Ashok, I'm just getting back from Washington, D.C., though, and you think they can contain inflation, but all this fiscal policy they're talking about, tax cuts, deregulation, this is going to be a lot of spending. Isn't it almost a vicious cycle?
Well, we are in a bit more of an optimistic camp, and I think, what we're going to get, obviously, is, immediately these discussions on tariffs and immigration. And then, as you noted, we're going to turn to the budget and the spending and tax cuts. And our sense is that what we will get is a package where the market concludes, this spring that the deficit is being stabilized. We're running about a 6% fiscal deficit. And our view is that as long as we have this package of policies where the market can conclude it's stabilizing, we don't need deficit reduction, we just need stabilization, that's going to be enough of a support for bond yields. Bond yields have started, obviously, and I think you spoke about it, pricing in term premium and some of these risks. So if we get, I think, even just a little incremental good news on this, the bond market will take it as a positive and as a shift in the expansion that we've all been seeing of fiscal spending.
There's been so much volatility, though, Ashok. Is there not a degree that even if what happens is accomplished, that because of the volatility, there just necessarily needs to be a higher term premium, especially on duration?
Yeah, I agree with that. I think, the end game of this is a steeper curve with term premium. And we've seen, term premium, move from deeply negative levels. This was when we had very flat inverted curves and central banks buying of government bonds and, even more, external central banks buying treasuries. So it's come back up, and I describe it as that we're at moderate sort of levels of term premium. Certainly, I think if we're wrong and all we get out of the budget is tax cuts and more spending, there is scope for it to go higher. But on volatility, there is, and I think our central case is that, and it's similar to what Kathy was saying, that this is going to be a year of relaxation of inflation. It's going to be a year where the Fed can, reduce interest rates twice, maybe once, maybe twice. We're priced for a reasonable terminal rate. So if you get that from the Fed plus a little bit of deficit stabilization, that's a pretty strong outcome for the bond market. And I would think we'll see a little less volatility compared to what we've been seeing the last couple of years with term premium and the central banks in motion.
Ashok, it's Jay. Which do you expect to see first, a 10-year over 5% or below 4.4%?
Below 4.4%. I think it is more likely, and we think it's more likely at this point that you'll see some evidence of we saw the CPI print last month, and I think what Kathy, coming back to what Kathy said, I think it's some important comments there about what's going on with services inflation. We would add in what's going on with shelter inflation as well, also going to push inflation down. But, we think it's more likely the next few months bring, a little bit more stability in the jobs market coupled with lower inflation numbers. And, given where we are, that's probably worth, getting 25 basis points more and lower 10-year yields.
So to press you just a bit, so 4.4 is in the picture. Where do you see it going to? Is it 4.25? Do you see 4%? I mean, curious as to how far you think this can really go.
I think, our view is that the terminal rate, and this could be this year, it could be next year, the timing of this is tricky, but, ultimately we think the Fed's going to get down to about 3.5%. And if the policy rate, the Fed funds rate ends at 3.5%, that kind of, says the 10-year rate should be maybe 4.25. So I think that's a good kind of intermediate term fair value. And, recognizing that bond markets often overshoot on one way or the other, maybe you do see it down to 4%. But this is still, rates are positive. They're going to stay positive. And I think broadly speaking, this 4 to 5% zone is we're going to spend a lot of time over the coming years in this range.
Ashok, I also feel like what you're saying is perhaps music to people who have to put together a cross-asset portfolio. Is it your estimation that we're going to have a bond market that is calm, that is finally something of a haven, that you can finally prop up against risk assets for the thing that protects your portfolio? Are we getting back to some sense of normalcy?
That is our view. I think, we see, I think you're going to have a limit just given, the amount of rates that they could potentially decline. There's going to be a limit to these diversification benefits. But certainly, coming back to like 2022 and the hiking years, fixed income can have hedge properties against risk assets again. And so I definitely agree with that. And I think just picking up on one thing you said, too, on multi-asset portfolios, one thing I think, we're paying a lot of attention to is the dollar, obviously, coming off very strong levels. We're starting to see this year, and it's partly, maybe a little bit better message on tariffs, but some of the strength in emerging market currencies, a little bit, movement of the dollar weaker against the euro. These are pretty tentative moves, but in addition to rate stability, if you can get, at minimum, the dollar stop appreciating and maybe even get a little bit of contained weakness, that's something else that also introduces some new dimensions to these multi-asset portfolios, too.
Ashok, thank you so much for your time this morning. Ashok Bhatia of Neuberger Berman. Up next, we're going to set you up for the week ahead with the Fed decision around the corner and Donald Trump hitting the road. You're watching Bloomberg Surveillance.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I didn't. Go.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. In TGIF, we're going to count you down to the opening bell. Here's the trading diary for the week ahead. At 10 a.m. Eastern, we'll get you UMich sentiment. Tuesday, durable goods. Wednesday, of course, a Fed rate decision, followed by a Chair Powell press conference. We obviously know already, you can write those questions and what they're going to be. Probably what the president said yesterday, that he knows interest rates and rate policy better than him. Didn't name him, but we know who him is. Plus tech earnings from Microsoft, Meta, and Tesla. And Thursday, Apple and Intel report. Of course, ahead of next week, President Trump traveling to hurricane and fire-damaged areas of the United States today. His visits to North Carolina and Los Angeles mark the first trip of his second term. Joining us now is Libby Cantrell of PIMCO. So he's making a ton of news. It's the first full week, basically, working week of his administration. Slew of executive orders, jawboning the Fed, telling the Saudis to add more barrels to the market, and then last night, seemingly signaling to China that he has the power to tariff them, but he doesn't want to use them yet. What do you take away from all of this?
Yeah, I mean, it has been flooding the zone. You forgot about the big AI announcement as well. I mean, that in itself would have been a massive announcement that would have driven news for a week, and yet it was a little bit drowned out because of all these executive orders. I mean, obviously, a lot of our clients very focused on tariff risk. I think, taking some comfort in the fact that President Trump hasn't done anything at least definitive on China or other countries. I mean, we think it's a little premature to start celebrating, and we think the direction of travel here is very clear. They did issue an America First trade memorandum that was basically a roadmap for how they are thinking about trade. It goes from everything from kind of rewriting free trade agreements to looking at currency relationships to looking at outbound investment from the U.S. to China. So I think what we are telling our clients, and then also I'm telling our traders, is let's not sort of celebrate this too prematurely. This is a deep-seated ideology, as we've talked about. There's a revenue component here, but there's also, I think, he believes in tariffs. He believes in tariffs work in terms of reducing the trade deficit. As it relates to China, I mean, it is complicated, right? There are other things that I think the president wants from China as it relates to the Ukraine war, for instance. And I think that he is intentionally sort of slow-walking tariffs or actions on China. We should not conflate that, though, with no future action, because I do believe that tariffs will be increasing probably across the board, but also on China in particular.
Well, when it comes to the signal he's sending, maybe he's slow-walking it, that's been a huge relief rally, even just today, in Asia, in Europe, in global currencies. The dollar's much weaker. But when it comes to China, it's not just the war in Ukraine, it's also TikTok. There's so many levers he's trying to pull. Where does all of this stack up in terms of the priority list?
Yeah, well, I think that's an open question. And I do think, I mean, these are our different dimensions. I think different advisors care about different things here. Of course, as we've talked about, he has a cadre of folks who are advising him under Trump 2.0, who are also there under Trump 1.0, who don't necessarily trust the Chinese. They view that the Chinese do not honor the Phase 1 trade agreement. I think there's going to be a real review. I mean, in this memorandum, there's an order to actually look at the Phase 1 trade agreement, to kind of create a scorecard around that and to publish that. So I do think, again, this is, actions are likely coming on China. I do think the market, though, should celebrate the fact that it's going to be intentional. It's going to be thought out. It's going to be strategic, and maybe not sort of the worst fear that the market at least was predicting.
Can I just go back to where we started, this very simple fact that we got so much this week? I mean, it is a reminder of what it was like around last time, that you have him talking to reporters, making news, posting things on social media, making news, giving different speeches. It is a lot. What is your advice to your traders, to your clients, and how to sort through all of it, and what to pay attention to, and maybe what you can ignore?
Yeah, I mean, great question. I think, from a fixed income perspective, right? What drives bond yields, growth, inflation, currency, and of course, obviously the Fed at the end of the day in terms of the U.S. So anything that really will have a tangible impact on those drivers. A lot of these executive orders, I call them kind of more sizzle than steak. A lot of them are, for the sort of shock and awe value versus actually the substance value. Now, a lot of them will be more substantive, and I think even on the federal workforce, some of the things he's done in terms of the hiring freeze, rolling back the DEI, while that may have a long tail, that will have an impact in terms of, employment of federal workforce and potentially incrementally on the budget. At the end of the day, though, the big things that drive the markets are going to be, again, the big macro movers. A lot of that has to do with Congress. And we haven't, Congress, as Anne Marie and I lament, Congress is understandably trying to get their ducks in a row with navigating incredibly narrow majorities. And so, I think the focus will probably turn away sort of inevitably from him a bit and, onto Congress once they start proceeding with this reconciliation bill and taxes and spending cuts and what have you.
Now, let me, Jay here. I'm curious as to how important the foreign investor base is for treasuries. We have a tremendous amount of treasury issuance coming this year, dollar starting to weaken, foreign investors very heavily invested in U.S. assets. Is there any concern at all that perhaps this can build on itself and foreign investors become less interested, pushing the yields up and price down?
Yeah, I think that this has been a concern in the marketplace over the last few years around sort of de-dollarization, around foreign central banks sort of diversifying away from kind of dollar-based assets into a basket of other currencies and other sovereign assets. I'm not sure we've really seen a lot of data that actually supports that. In fact, when you did see sort of some foreign buyers kind of pull away over the last few years, you actually saw some domestic pension plans and institutional investors actually sort of filled that gap. But recently, it looks like, according to the data, that there has been more activity in terms of foreign central banks. And that's partly just because yields look pretty nice, right? I mean, it is the U.S. bond market actually, looks pretty attractive right now from both a nominal yield but also a real yield perspective. And if you think that maybe he's going to do something on tariffs, but it won't be the sort of the full kind of Monty on tariffs, then maybe you're sort of starting to dip your toe into the water. So I don't think we see that as a real concern. And again, there seems to be a lot of domestic demand that has supplemented that.
Does he wait for tariffs because he wants the good news that can happen with a reconciliation, what he calls one big, beautiful, powerful bill to come out? Is that what he's waiting on? Bake in the good news first to the financial markets and then potentially add in some of the not so great stuff?
Yeah, I mean, I do think there is going to be a consideration around sort of eating your vegetables and eating dessert, and I think trying to give both to the market, so they're not just trying to chew on one and not chew on the other. And obviously, as we all know, folks in this administration are very markets oriented. President Trump views the economy under Trump 1.0, the S&P under Trump 1.0 as part of his legacy. So I do think they're going to be mindful of all of this. Again, though, I wouldn't confuse this with the fact that we're not going to see tariff action. Right. And I do think maybe something that in the marketplace that's maybe not being taken as seriously is sort of the threat on Canada and Mexico. As we know, the USMCA review is coming up next year. It sounds like President Trump might want it to actually pull that forward, and the tariff threat might be sort of associated with that.
The review started. He's negotiating, Libby.
The review is
it's on.
Starting. And who will be negotiating that on behalf of Canada? Sort of TBD, yes. Obviously. But I do think that is sort of part and parcel of this. So while I think investors and we have been sort of focused on the potential China actions, they actually might be much closer to the United States, our neighbors up north.
Libby Cantrell of PIMCO, thank you so much. And Jay Plowski of TPW Advisors, thank you for joining us for this hour. Coming up on Monday, John and Lisa will be back with me. Seema Shah of Principal Asset Management, Victoria Fernandez of Crossmark, Neil Dutta of Renmac, and Oksana Aronoff of JP Morgan. This was Bloomberg Surveillance. Thanks for joining.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow. I'm not the right one to just do that.
I think you are.
Yeah. But with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of the regulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
All right, a little bit of a dip in futures after finally hitting all-time highs yesterday. Happy Friday. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, a softening stance. President Donald Trump says he'd rather not put tariffs on China. Futures fluctuating and the dollar drops. And we round out this earnings week with insight from the C-suite. The CEO of American Express tells Bloomberg that consumer confidence is up, and next hour, Verizon's CEO shares his outlook with us. And over in Europe, Novo Nordisk shares jump after an experimental shot delivered as much as 22% weight loss in an early-stage trial. Eli Lilly shares down a little bit in response. All of that and more coming up. Let's take a look at where markets are trading. Like I said, 30 minutes until the bell rings on this Friday trading session. You can see we're dipping a little bit. We finally reached that record high yesterday. We had a big rally into the close. Now we're coming off the boil a little bit. The S&P 500 down about 0.1%. Similar story if you take a look at the NASDAQ 100, and not much to say about the bond market right now. We're above 460, hanging out at those levels, but at least for right at this moment, Sonali, yields are unchanged.
For this moment, let's see where next week takes us. Of course, a lot of relief with those comments from the president. But let's talk about the earnings story still, because we do have more news under the surface. Texas Instruments dropping after it gave a disappointing forecast, and sluggish chip demand really impacting them now, down about 4.7% pre-market. Boeing also down after another quarter of losses. Surprise preliminary results were reported this morning. The stock now down another 1% pre-market. Verizon now on the rise, 1.3% higher. We're going to speak to Verizon CEO Hans Vestberg next hour. An AI announcement there, but also some stronger numbers in really big walk-up to earnings season that starts in full form really next week, right, Katie?
Yeah, it's going to be really interesting to see what corporate America delivers on the earnings front, what the Fed delivers on the macroeconomic front, because right now it seems like it's smooth sailing, of course, in the market. You take a look at what the S&P 500 has done so far this week. We mentioned that all-time high. The index up about 2% so far on a weekly basis. If that stands, Sonali, the S&P 500 is poised for the best start for a new president since Ronald Reagan was sworn into power in 1985. We've been talking about this Trump trade, the enthusiasm we saw after Election Day. It wavered a little bit, but now it's back in full force.
And it helps that you didn't see the brunt of the tariff strategy take force in the first week. It helps that yields have behaved, doesn't it? We're going to talk a lot more about this now with Jack Genesiewicz, who is the portfolio manager and lead portfolio strategist at Natixis Investment Manager Solutions. Like Katie said, it is Friday. And so you're watching earnings season underway. You have the market largely reacting to vibes, to what the president is saying in his first week in office. At what point does the earnings story also matter? Because you are seeing on a stock-by-stock basis some interesting reactions.
Sure, and I think, as you noted coming into this, it's the interest rate backdrop. That's a concern. It's been a tariff concern. You've got a little bit of softening on both fronts, and then it brings us right back to the earnings backdrop. And, aside from a few idiosyncratic stories there, I think, broadly speaking, the earnings game has been pretty supportive in here. And, it kicked off with the bank backdrop. They all basically came out and crushed it. And we're seeing, these bits and pieces of other areas of the market still coming in quite strong. Look at some of the retailers on the luxury side, right? Schmott, Burberry, they knocked it out as well. So I think in general, you're getting a pretty good undertone for earnings in here, and that's what matters.
So what does that mean for the setup going into next week? You have the big tech giants reporting. Does it mean that you lean in further to the mega cap trade, or does the broadening story make even more sense to you today?
I think you're going to get a little of both in here. When we sort of looked at what happened at the last week of the year, you had some de-risking going on. You had a sentiment reset. A lot of the surveys that we pay attention to certainly saw the bullish sentiment come off the boil. You had a little bit of selling that we saw from our ETF and mutual fund products that we're paying attention to. And if you look at some of the modeling we do with regard to the leverage players, they've actually degrossed as well. So you're coming in from a sentiment reset. And I think anything that you get with a positive backdrop in here probably still pushes the market higher. And I think it's a combination of a breadth widening out, and you're still going to get tech leadership as well in here. So I think a lot of things still can work in here.
Well, let's talk about what could upset the apple cart, because we've been in a Fed blackout period. Maybe that helps explain why we've seen some stability return to the bond market. That ends next week. We're getting into the heart of earnings season as well. And if the first 4 days of the Trump administration are any guide, there's plenty of more coming on the political side of things as well. How are you thinking about the different cross currents here?
Yeah, I think we have to really kind of look through a little bit with regard to that geopolitical volatility. Again, what's the underlying strength of the economy? It's going to be the earnings backdrop that's continuing to, I think, support the broader stock market here. You're going to get these headlines. You're going to get the Twitter bombs overnight. And it's just a question of, is this sort of going to be a little bit more bark than bite, so to speak? I think you can maybe take that with some of the things that we've seen on the tariff front, where you sort of expect the worst and hope for the best. And, we've had a little bit of that toned down. And I think that's just upside for the market in here. So you sort of have to look through some of the geopolitical noise and really focus on the underlying fundamentals here. The economy's still in good shape, and earnings are actually continuing to grind higher.
Yeah, now these Twitter bombs have turned into Truth Social bombs, which are then reposted on X bombs, but now we're just mincing words here, Jack. So, okay, so you're looking through a lot of the noise. You're focusing on the fundamentals. Talk, though, about some of the other forces outside of just the equity market. When you think about the bond market, as we've been saying, well-behaved this morning. This week, though, we've seen a little bit of a quiet climb at the long end. When does that start to become a problem? What levels are we talking about where you would start to get concerned?
Yeah, and that's probably the key here, because I think you can start to make all sorts of stories that can funnel its way back into ultimately that interest rate backdrop. And so, if you push closer to, I think, 5% on the 10-year yield, you're probably going to have the market rethink that backdrop in here. But, if you think about where we've been, we've priced out almost all of the rate cuts basically a couple of weeks back. So I think for the market to become incrementally more hawkish, you'd have to start talking about rate hikes. And I think that's a pretty big bar for the Fed to sort of get over. And so, as we sort of price out those rate cuts, you're talking about moving to rate hikes, probably big bar there. The market's probably at peak hawkishness. And so, when you start to pay attention to what's going on in the inflation data and look at that shelter figure, it continues to grind lower. That's a big component, of course, CPI. That's going to be a big headwind going forward for inflation resurging or reaccelerating in here. And as a result, I think it's going to be tough to see a market break higher in yields, but that's probably going to be the key risk going forward here. Higher yields at 5% level.
5% level. So what's the tail risk here? Is this idea that you can get meaningfully higher than 5% in your calculus as you make decisions in the market right now?
You know, there's a couple things to think about there. One, it probably has to really come down to a reacceleration in inflation, but you also have to consider the potential for the fiscal deficit, the bond vigilantes to come back in here and sort of take control of that bond market backdrop. So debt ceiling worries, you know, fiscal deficit continuing to widen out. That's the other risk that you could see from that tail perspective, where you could see that 5-year breach and continuing to push higher.
All right, Jack, great setup. Enjoy your weekend when you get there. That is Jack Janasiewicz of Natixis Investment Manager Solution. Meanwhile, let's get specific here and talk single stocks, because pharma giant Novo Nordisk absolutely soaring right now after posting some results on an experimental shot, which could add to the company's weight loss offerings. You take a look at Eli Lilly here in the U.S., also down a little bit in response. Of course, we're talking about Novo's main rival here, and it's really a two-way race. Let's digest the data now with Sam Fazeli. He is Director of Research for Global Industries and Senior Pharmaceuticals Analyst for Bloomberg Intelligence. So, Sam, of course, when it comes to Novo, when it comes to Lilly, their pipelines right now are under the microscope. Novo needed some good news, and it seems like we got some.
Oh, God, yes, they needed some good news. I mean, that stock is off. Well, it's almost halved. Of course, mathematically it hasn't. It's just less than, it's like 40-odd% down since the peak it hit back in the middle of last year, which is a big thing for a company that became the largest stock in the European space, and now, of course, is giving that back up to LVMH, I think. You know, as I keep calling this, it's snake and ladders. I don't know if folks still play that game, or do they still have that board game? But you work hard to climb, and then bam, you're off again. And it's a competition between who's got the biggest weight loss. Is it 23%? Is it 22%? Does Lilly have it? At the end of the day, we all seem to be skirting around the 23, 24, 25% range. And it all comes down to tolerability. You lose the weight, but how do you feel? Unfortunately, Novo didn't give us that data, but this is definitely a positive for them today.
Sam, I want to pull up a chart over 1 year for Eli Lilly and Novo Nordisk, because the gap has seriously widened. We're talking about a company, Novo Nordisk, that was the most valuable company in Europe. It has lost about a third of its value since the high. How did this happen?
Yeah, it was all about competition, data not being as good as they said it would be. And then, of course, Lilly missed a couple of quarters, and everybody started worrying, oh my God, is that demand that we all expected, i.e. 100 million, whatever number of patients could be benefiting from these weight loss drugs, which is not my favorite way of calling them. They are much more broadly active than just weight loss. Nevertheless, that's what led to this, a little bit of uncertainty. And then Novo, of course, came and missed its own target in the last readout, which was CagriSema, if you remember, just before Christmas. They said we're going to get 25%. They ended up at about 23% in the best case assessment of that data set. So folks started worrying. And Lilly's got a lot more strings to its bow. So that's why you see that differential in performance.
Sam, we have to leave it there. We thank you so very much for your time. Of course, a big story of the morning. That is Sam Fazeli of Bloomberg Intelligence. Now, another big story of the morning. Want to bring you some breaking news. Mark Zuckerberg says Meta's CapEx this year is going to be $60 to $65 billion. The estimate was $51.3 billion. And you do see Meta shares reacting down pre-market about 1%. He said this in a Facebook post. He says this will be a defining year for artificial intelligence. He says that he believes that Meta AI will be the leading assistant to serve more than 1 billion people. He is pitching the prospects here, Katie, of Llama 4 to be a state-of-the-art model here. Of course, we know that he has a lot of differences in how he views the future of artificial intelligence compared with others.
Well, let's just restate those numbers, because they are enormous. $60 to $65 billion. Again, the estimate, like you said, for $51 billion. It's interesting to see the stock fall. We know that Meta has come under a lot of scrutiny from shareholders for their spending. That was the story of 2022. We entered the year of efficiency. That has led to outperformance. But now, I don't know. It seems like the year of efficiency, a distant memory, and now they're spending big to get in the game.
Yeah, we can see that spending come back. They have also outperformed their rivals, so maybe they have a little room to get this done. We're going to talk more about that story and others. Stick with us. More markets ahead. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
All right, we also have our eyes on Boeing this morning, out with a surprise announcement ahead of their earnings next week. Last night, they said that they're suffering another quarter of fresh charges and losses. The results highlighting, of course, that long road ahead for the new CEO, Kelly Ortberg, as he tries to stabilize the U.S. aircraft manufacturer. Let's break it down now with Benedict Kammel. He leads Bloomberg's global aviation coverage. So we've kept our eyes so trained on that commercial airplanes unit. It seems like maybe we should have also been taking a look at what's going on with the defense business as well.
Yeah, that's right. There are absolutely multiple fires at Boeing. And as you said, the commercial business is what people have been focused on for a good reason. I mean, that's the business that suffered quite stunning losses last year. We had the strike. That was painful. And that all contributed to that really dismal fourth quarter. But then there was a big charge at the defense business, the mid-air refueling tanker, the new Air Force One presidential plane that's delayed. All those things contributing to these charges. And really, wherever you look at Boeing right now, there's a lot of costs, there's a lot of losses, and as I said, another dismal quarter for them.
However, is some of this bad news okay news if you consider that they're trying to bite the bullet a bit here with this pre-release?
Yeah, that's probably right, and they did the same thing last time. So last time they came out with those substantial job cuts, so they really sort of kitchen sinked it, as it were. This time, a little thinner on the details, so we really have to wait for Tuesday to get the full narrative. We'll hear from Kelly Ortberg, the CEO. We'll hear from him what he has to say about how he plans the road forward, how he plans to stabilize the business. That's really what people want to hear. How is he going to get out of these unprofitable contracts? How does the build rate build up over the next year? They are really depressed right now in terms of the output of their commercial aircraft. So a lot of people want to sort of put that year behind them, the 2024 year, which everyone agrees was not a great year for Boeing, and really think about, okay, what is the road ahead for this company? How can they stabilize the business? How can they really get aircraft production back in order? How can they get out of these unprofitable defense contracts? So a lot of questions for Kelly Ortberg. He's sort of taken the sting out of it with that pre-announce, but there's still a lot of things to go over on Tuesday.
Yeah, absolutely. Will be a very interesting earnings call to tune into, to say the least. But give us a lay of the land when it comes to the competitive landscape. It feels like the only serious competitor for Boeing is Airbus, of course. How has Airbus been capitalizing on this moment this year and then some?
Well, if you look at 2024, Airbus delivered more than twice as many aircraft as Boeing did. So that gives you a sense of just how it has tilted towards Airbus. At the same time, Boeing might be in a difficult position right now, but they still have $500 billion of planes on order. So there's a huge backlog there of unfulfilled orders. So people are still optimistic that if they can get their act back together, they have a good chance of getting back into that duopoly. And as you said, there's really only two players in this market right now. It's Airbus and it's Boeing. Boeing needs to be careful that they don't slip and sort of become an also-ran. The Chinese are not standing still. They have a plane called the Comac 919. That's a plane that's not certified outside of China yet, but that's a matter of time. And at some point, the global industry will take a hard look at that particular product and might sway that way as well. So Boeing really has to defend its turf here, as I said, if they don't want to sort of slip.
Yeah, great point there on China. Don't take your eyes off that country either. Benny, have to leave it there. Our thanks, of course, to Bloomberg's Benedict Kamel. And meanwhile, we'd like to make a clarification. The other day, we got news that Stellantis will produce its new mid-size pickup in Illinois. It also announced investments in its Ohio and Indiana facilities. And to clarify, product decisions announced by Stellantis on January 22nd won't affect current production in Canada, and no jobs or manufacturing work in that country are being moved to the U.S. as a result. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is
indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Now we want to bring you some more of that breaking news. Meta planning a major investment in artificial intelligence. In a Facebook post, CEO Mark Zuckerberg says the tech giant will invest up to $65 billion. $65 billion is $15 billion more than the estimate out there. The average estimate was about $51 billion. Mandeep Singh of Bloomberg Intelligence joins us now on that CapEx figure. You are seeing Meta shares reacting, but this was one of the better performers over the last 12 months in the Magnificent Seven. Can they afford it? Are they basically telling investors to be patient? We have bigger ambitions.
Well, what's transpired in the last 1 week, you know, with the Project Stargate, and even before that with Microsoft saying they are going to spend $80 billion in AI CapEx this year, is forcing the likes of Meta to raise their CapEx. I mean, I expect Google to do the same when they come out with their earnings. They'll probably raise the CapEx because when you look at the aggregate number from the 4 hyperscalers last year, they raised their CapEx by about 45 to 50%. So this year consensus was like, it's going to decelerate to 20 to 25%. Well, guess what? It's going back to 50%, which is what Meta has guided to now, and what Microsoft is doing. So I expect the other hyperscalers to follow.
Well, talk to us about the history of Meta spend here. We were talking a little bit about the year of efficiency and how that was really welcomed by investors. That's been over for a while, and now you see these big, aggressive CapEx numbers come out again. When it comes to the investor perspective, how important is it going to be where they spend the $65 billion?
Well, we know everyone wants to build the biggest compute cluster. I mean, Elon Musk built a 100,000 GPU cluster. Now everyone is talking about a 1 million GPU cluster. And look, the bigger cluster you have, it helps you with the scaling laws. At least that's the prevailing narrative. And everyone feels they want that NVIDIA allocation. Nobody wants to miss out on NVIDIA allocating a certain number of GPUs. So for that, you have to raise your CapEx.
I feel like it's hard not to make the mistake of reading too much into things right now. The fact that he made this announcement on Facebook and not in an investor filing really strikes me, because many years ago, that wouldn't have even really been allowed. It feels very Elon Musk to do that sort of thing. Is this a way to also show people that he's going to be communicating this way more often from now on?
I mean, look, investors care about, you know, what the company plans to do in terms of monetization and their investments. And with Meta, the question remains, how are they going to monetize their Llama model? And if he wants to interact with, you know, everyone through Facebook or X or Instagram, it doesn't really matter. But it comes down to Meta being that social media provider, not having a cloud business. How do they actually monetize all this investment? And it's going to be through their family of apps. But the big difference is Google and Microsoft have a cloud business where they can monetize all these investments. Meta does not, and he has to explain that.
All right, Mandeep, always great to speak with you. Appreciate you stopping by on this breaking news moment. Again, that news out from Meta, that CapEx spend is going to be higher than expected, up to $65 billion. The estimate had been for around $51 billion, so boosting up those levels to try to get ahead on AI. Meanwhile, let's take a quick check at futures here. Of course, we're minutes away from that opening bell. You can see we're pretty much unchanged on the day, Shanali, but it's been quite a week for the S&P 500, up about 2% as of yesterday's close. We finally hit those record highs. The NASDAQ 100 also pretty much unchanged. The color's green, but the numbers aren't too inspiring. The Russell 2000, a little bit more of direction here, down about 0.4%. And it's not even worth talking about the bond market, but it's going to be next week.
Sigh of relief. Got through the first week with very little volatility compared to what was expected. But of course, those small caps hitting a wall, I've got to say. I feel like you might have emotions. I have emotions.
Yeah, you know, those little guys, they, I'm sure that they were cheering on President Donald Trump yesterday, calling for lower interest rates. I would love to be a fly on the wall in next week's policy meeting at the Federal Reserve, but In any case, we're 4 minutes away from that opening bell. Coming up next, we'll discuss the market moves with Sarah Ketterer of Causeway Capital Management. This is Bloomberg.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we've focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that, not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
All right, we are moments away from the start of trading on this Friday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. Of course, we're counting down to the end of the week. That has been huge for the S&P 500. The first full week of Donald Trump's administration. Of course, we've gotten a lot of news when it comes to immigration, when it comes to tariffs, when it comes to AI. You add it all together, and somehow the S&P 500 has found a way to rally by 2%. That is the best performance for the first week of a new president since 1985. That was, of course, the week that was heading into yesterday's close. You take a look at where we're trading as today kicks off. A bit of a breather. We got above 6,100 yesterday on the S&P 500. We hit a fresh record high. Some of that momentum is fading a little bit right now. The S&P 500, I'm going to go ahead and call that unchanged. You could round big tech up to 0.1% higher if you're feeling optimistic. The tech index in the green right now. I can't say the same for the small caps. As Shanali said, hitting a little bit of a wall when it comes to the Russell 2000, currently down by about 0.1%. We were down a little bit more when it comes to that pre-market trade. We'll see what happens. between now and 4 p.m. Meanwhile, let's get to some of the individual movers because Texas Instruments dropping after a disappointing earnings forecast hurt by still sluggish chip demand and higher manufacturing costs. Shares currently off by about 5%, Shanali.
Yeah, more earnings this morning that we're keeping an eye on here. But first, watching Meta. We are watching after CEO Mark Zuckerberg says his company will invest between 60 and 65 billion in capex related to AI in 2025, which is well above the figure analysts had been projecting. You are seeing a rise in the shares now, up on more than 0.3%, half of 1% now. Interesting after the initial decline that we saw in the reaction. Also watching American Express because the credit card company reported fourth quarter expenses that were higher, and you now see Amex down about 0.7%. A close eye on expenses. Interesting move in Amex, of course, which has been otherwise a darling. Let's take a look at Amex with Bloomberg Technology co-host Caroline Hyde, who spoke with the company's CEO earlier. And Caroline, so interesting here because the numbers themselves were good in terms of the top line, but to get those customers in the door, you have to spend more, don't you?
Yeah, you've got to market to them. You've got to offer them some nice little perks if you're going to be upgrading to a flashy new corporate or indeed consumer card. And they have been signing up yet more and more people when it comes to the gold cards that you also know well at Amex, but whether or not corporate spending is up. I think more broadly, this is a company that's coming bang in line with expectations. They're raising their dividend. They're seeing profits up about 12%. And they actually think this sort of growth is sustainable. Really optimistic CEO Steve Squeri about where we're going to see the future of 2025. This momentum that he saw in the fourth quarter, he thinks is likely going to stick. Consumer confidence is building. And what I think is interesting is also business confidence is building as well. Big businesses are spending more. Corporate card business have been more positive. And even the small businesses in particular have been better in the fourth quarter. He thinks that momentum with the regulatory changes, with the new administration, with inflation looking like it's coming down, is going to be there to stick.
And so we're talking about spending a lot this morning. We'll ask you specifically about Meta, but where is Amex spending right now when you think about where they're trying to get ahead?
Okay, nice flow into Meta because it's tech. They are investing in marketing and they want to ensure that you're being hit no matter where you see digitally advertising for Amex and thinking about getting a card. But you're all, and it's Millennial and Gen Z that are really picking up on these cards in particular. But then it's about the digital trends. It's the fact that they're having to get more talent. When he says they're spending on digital, what they're doing is they're spending on talent. He's getting more AI expertise in the door. We're having more people doing coding. He's using artificial intelligence, whether it's coming in to ensure whether they're preventing fraud or whether they're helping on customer service. But that does take talent. So they're having to up their spend and commitment to tech and talent more broadly.
You know, speaking of spend, going back to Meta, you are seeing this announcement come ahead of big tech earnings next week. How does it really set the bar here, the expectation that you could expect more spending, and not just by a little bit, by a lot?
I love that you bring that up, because why not save this for next week, for the earnings? He kind of wants to catch a bit of a moment on Threads and Facebook instead of a regulatory news service instead. And he really is dialing into this fact that we've heard from Microsoft that they're going to be spending more than 80 billion in terms of capital expenditure on AI. We've got this big announcement coming from the likes of OpenAI, SoftBank, and indeed Oracle about the commitment to AI infrastructure. Here's Mark Zuckerberg saying, we're going to be having data centers the size of Manhattan, basically, that we're going to be building out, and that's going to cost money, up to $65 billion. Now, the market had thought he'd be spending about 52 billion, and some analysts, Bank of America, had seen about 58 billion in 2025. This is a marked uptick. And also, for someone who's trying to crimp down on less productive workers, remember, they're going to get tougher on who they're firing, letting go of, he does want to see more talent coming in the door. And again, it's about AI talent.
Yeah, there you have it. Caroline, great reporting as always, both on American Express and Meta. I know you'll have much more on Bloomberg Technology. That is Bloomberg Tech co-host Caroline Hyde. And you can take a look at Meta shares right now. After that initial sticker shock of how much they're going to be spending, shares have actually turned around, now higher by about 0.8%, initially sinking about more than 1% when we got that headline. But investors looking into the details and maybe liking what they're seeing. Let's keep the conversation going now with Sarah Ketterer. She is Causeway Capital Management CEO. And Sarah, it's great to have you with us on this Friday. Let's start with CapEx. Of course, that big headline coming out from Meta. We know that American Express also has their own spending plans to try to get ahead on talent, on tech. As we head into the real heart of earnings season, how much of a microscope are you putting companies' CapEx spend plans under? Because you think about the tale of the past earnings season, especially with big tech, that ROI was a big question mark.
Yeah, I agree. It remains a question mark, and our Causeway analysts and portfolio managers are scrutinizing all this spend. I think where we're particularly curious is what the enterprise applications would be for all of this AI effort. It's just very early days. But as you noted, the market's rewarding the spend. It's just sort of ironic, given these are supposed to be very cash flow generative businesses. But there are plenty of parts of the market that have been left behind in this AI frenzy, and I think that's of even greater interest to our team.
So where are those other areas? It's interesting today because you parse through the moves in the NASDAQ 100, and we know a day doesn't make a trend. But I was wondering, off the heels of Meta's news, how much you would see others rise. Broadcom is actually right now your biggest gainer in the NASDAQ 100. Raises the question, if you're going to capitalize on the AI boom at this point in time, do you buy the people that are investing in all that CapEx or the ones that are the recipients of it?
Well, in general, several of those stocks, you mentioned Broadcom, are at very high valuation. So if you are going to take an extremely optimistic view, they may be attractive. But there are lower risk ways, and this is what our team is particularly good at, of taking advantage of the technology without having to spend quite so much in terms of earnings and cash flow multiples. An example would be the power and industrial semiconductors, companies like Infineon or Renesas. They're very weak right now, but they too are going to be huge beneficiaries, not just of a renewed auto cycle, but of data centers, ultimately in robotics, automation.
Well, that's so interesting that you're specifically focused on auto suppliers here, and you see bright skies ahead for some of these companies that you name. The auto industry, there's a lot of concern right now when you think about tariffs on Canada, on Mexico. You think about how interconnected the North American auto industry is. When you're taking a look at all the up arrow factors for these stocks, how do you factor in possibly the threat of these tariffs?
Well, tariffs certainly loom large. 15% of the autos that are bought in the U.S. are made in Mexico. So Mexico is important. But the automakers have other problems. They have margin compression. My colleague who covers autos for us at Causeway, Reed Ross, tells me about the really difficult time these autos are going to continue to face because they have all kinds of cost increases and price discounting. But nonetheless, the content within each auto, as autos become more connected to the consumer, to each other, semiconductor content rises, as well as connector content. And that's what we find really interesting. Stocks like Active, for example, very low, and yet their future is extremely bright. They're splitting out their wire harness, their electrical business from the more advanced, higher growth side of the company. So underneath the surface, if you look beyond this slump in autos, there's some very interesting trends happening. Electrification, EVs, and there are ways to take advantage of that at much lower price to earnings multiples and price to cash multiples than you're paying, for example, for some of the big AI winners.
I have a broader market question for you, Sarah, because if you look around, yes, we are finally having a market that has been back above its record highs, taking a breather today, but the breather that's been taken by this market has been weeks long. If you think about how long it's taken to get back over that 6,000 level for the S&P 500. So now that we're at these heights, what kind of attitude do you take to the market? Do you think that it's all rosy from here, or do you think that there's going to be some sort of pullback that would cause a better entry point to enter this market?
This is a very difficult question because overvaluation can last a long time. We've seen this many times in the past. And the point I'm making is lower risk by ensuring you have valuation support. It's at the heart of everything we do with Causeway, but it's really having that margin of safety, especially when the U.S. market is at this extremely high level. Relative to bond yields, U.S. market is looking extremely expensive. And that means it's an enormous market. So there's plenty for us to find. And again, whether it be in the power semiconductor area or in connectors, there are these fascinating companies that do benefit from the trends that are somewhat inevitable and yet trade at very low valuations. So we're taking those valuations and being very conservative, ensuring that we've got protection in the event the market does take a breather.
All right, Sarah, great to speak with you. That is Sarah Ketterer of Causeway Capital Management. Meanwhile, let's get back to some of these movers. It is a heavy earnings day, believe it or not, on this Friday. So let's take a look here at CSX. Shares falling on an earnings miss. The railroad is facing headwinds amid pressures from hurricanes and also that key bridge collapse. You can see shares currently down about 3%. Also, keep an eye on Boeing here. Had been lower pre-market, of course, after it came out with those surprise preliminary results and showed another quarter of losses, but shares recovering a little bit. You're also taking a look at Eli Lilly. I would show Novo Nordisk here because the news is that Novo Nordisk reported that its experimental shot delivered as much as 22% weight loss in an early stage trial. Novo shares absolutely soaring, up about 7.7% right now. Lilly initially had fallen in the pre-market on this news. These are the two companies in that race to develop a next-gen GLP-1 weight loss drug, and that race intensified this morning. But we should also talk about Meta, of course, that big headline that they're going to spend up to $65 billion on CapEx, about $15 billion more than analysts had anticipated, but Meta's shaking it off right now.
They're totally shaking it off, turning it around. If you look at the NASDAQ 100, which is down on the day, the top 5 gainers include Meta and also Broadcom. And if you pull up one of our favorite functions, SPLC on the Bloomberg terminal, you could see that supply chain. And you do have Meta representing 4% of Broadcom's revenue. So very interesting to see that move in synchrony.
Yeah, definitely. That $65 billion has to go somewhere. And it was a great question you asked Sarah about, do you invest in the company that's spending the money or the recipient of the money? And I'm sure for some investors, the answer is why not both?
I'm sure some people going way down the supply chain and figuring out the energy to providers to Broadcom to figure out that Meta investment. Anyways, a lot of things shaking up. We have more markets for you up next. Stick with us.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Listen carefully. Can you hear the rhythm in the market?
markets. Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
All right, welcome back to Bloomberg Open Interest. A quick check on the market. We're about 16 minutes into the session, and we do have some green to talk about. The S&P 500 up by about 0.1%. It's interesting to see the NASDAQ 100 lagging right now. You now have Meta shares higher, as well as Broadcom, as well as Apple, but still the benchmark overall unchanged. And then you take a look at the small caps, just can't get out of bed on this Friday. The Russell 2000 currently down by about 0.2%. Meanwhile, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Netflix getting raised to a buy over at Bernstein. The analyst cites increasing subscriber growth and increasing operational leverage, with the streaming giant reporting nearly 19 million new subscribers earlier this week. Next up, we have Guggenheim Securities upgrading Restaurant Brands International to a buy, saying that the stock's recent slump is overdone. The analyst says that management is making the right strategic moves. That's good for about 0.1% gain, 0.8%. Again, happy Friday. Finally, a different story over at Brinker International. That is the parent company of Chili's. It's getting a downgrade over at KeyBank Capital, with the firm cutting its rating from a buy, saying that the stock's valuation leaves little room for error and is well beyond a realistic bull case scenario. Harsh words translating into a 2.5% drop. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's time now for the Wall Street Beat. The hedge fund world will converge in Miami next week at Global Alts 2025. Brian Corbett, president and CEO of the Managed Funds Association, joins us now from Washington. We'll be in Miami. I will be too. There are a lot of people headed down there, really from around the world. But I do want to start with where you expect a lot of the attention to be focused, because of course we are now past week one of the Trump administration. Right. You have put forward a lot of priorities when it comes to the acting SEC chair in the meantime. But if you had to kind of hone in right now, just to priority number one, what is it?
Yeah, I think the priority is to really turn the page on the Gensler regime and move forward with policies that are focused on supporting our public and private markets. Let's reduce the red tape that's been put in place over the past few years. Let's stop regulating by enforcement. I'd say secondly, is embrace alternative asset managers as an important market participant that helps drive economic growth. And lastly would be to support pro-growth tax policies like preserving the current treatment of carried interest, which is important to innovation and financing small and medium-sized businesses.
You know, it's interesting. Some of the rules are already in place. Of course, there was a lot of rulemaking that happened under the former SEC chair, and you had really contested a lot of it. It got quite litigious. Yes. Are there some rules that you'll look to eliminate? I know that you're already asking to delay, for example, some of the compliance reporting deadlines that are associated with some of the more recent rules put forward. Would you look to get those completely eliminated instead?
So you're absolutely right. Under Chair Gensler, there were 20-plus rules targeting our industry. We sued on 3 of them. We won 2 lawsuits. So as we move forward, we are asking immediately for Acting Chair Mark Ueda to delay implementation of 2 of the more problematic rules. We're also asking him to withdraw an appeal. On the last day in office on Friday, Chair Gensler appealed a court case that we won, and we are asking the SEC to immediately withdraw that appeal.
Yeah, it seemed like it was a rush to the finish for the SEC last week. I want to talk a little bit more about these new rules because one of the concerns that you express is that it could increase concentration risk in the hedge fund industry. But new rules aside, is that a concern for you anyway?
No, I think markets are competitive. There's new market entrants. One of the concerns we've had, frankly, with all of the Gensler regulation over the past few years is that it was such a heavy overhang on the industry that you actually saw the SEC causing concentration because of their rules. It was too costly, too expensive for new funds to launch. So as a result of what the SEC did, the big were getting bigger. So we think it's important to reduce that regulatory overhang and create, once again, a vibrant market system where you see a lot of new entrants and you see creativity in the markets.
Well, that's an interesting point to make because then do you see new funds going to come to market this year at scale? We have already seen a lot of that last year despite the regulations.